Hello friends, welcome to this part 3 of CA Final AFM expected questions marathon. Till now we discussed bond valuation, equity and business valuation, derivatives, Forex we discussed, then we discussed advanced capital budgeting as well as IFM. In this part, we are going to discuss interest rate risk management, portfolio management and mutual funds as well as mergers and acquisition and some miscellaneous questions. If left out, we will discuss these questions also. See, so here are the topics for interest rate risk management I have given here. Okay, we'll quickly go through the FRA, interest rate futures, interest rate options, and we have interest rate swaps. In that, swap arbitrage is important for this attempt. Then there is swaptions, a combination of swap and option, AIC swap and overnight index swap. Then there is one RTP question, Drilldip question, currency swap related question. These are all the things which we are going to discuss in the interest rate risk management. Shall we start quickly? No. So question number 27 is about FRA agreement. FRA, forward rate agreement. I'll briefly explain the nuances of the forward rate agreement before we start discussing the question. See what happens. In the interest rate risk management, we are studying the chapter interest rate risk management. Here, see. Two situations possible. I am a borrower or I am a depositor. Assume you are a borrower. Mostly borrowing related questions only being asked in the examination. So assume you are a borrower. You borrowed, you go to the bank and you ask for money. They say that if you want to borrow, today there is 2 months rate is given, say 9%. 6 months rate is given, say 8%, or say 9 months rate is given 10.5%. Some rate is given, quoted by the bank. Now you see, what is the understanding? If you borrow for a period of 2 months, you will have to pay interest 9% per annum. All these interest rates are annualized per annum interest rate. Are you all understanding? Now, if you want to borrow today, for a period of 6 months, you will pay 8% per annum. If you want to borrow, for a period of 9 months today, which means from today, for a period of 9 months, 10.5 will be the interest rate. Are you all having the clarity? So this is all the interest rate given, which means I can present it like this. This is the timeline. Say today you are, month 0, and then here is a 2-month period, or let's make it 3 months, 369 would be ideal. Then let's make it 6, and then we make it 9 months. Are you understanding? Now what they say, you are standing here today. Now you want to borrow money, but what I say, I don't want money today. If I want to borrow today, yes, 9% will be the rate. I already know what is the rate is going to be. I am going to pay. So the lock-in interest rate will be 9 spot rate. Spot interest rate will be 9%. But the problem is, I don't want money today. Assume you want money only if, from the starting of the 3rd month or beginning of the 3rd month. Say, let's say you want, this is 6 months period now. For this 6 months period, you want money. This 6 months period, you want money, not for this period. Are you all understanding? So I want money for a period of 6 months from, which means after a period of 3 months. So this is called as, 3 into 9 FRA. This is called a 3 into 9 FRA, which means, in FRA terms, it is called as 3 into 9. What is the understanding? I want a money for a 6 months period after a period of 3 months till the 9th period, which means for a 6 months period beginning from 3rd month till the 9th month. Are you listening? So if this is the case, can you tell me, can I borrow at 9%? No. Because all these rates are spot rates. Which means these are all the prices, these are all the interest rate quoted today, and not for tomorrow, which means not after 3 months. After 3 months, you don't know what will be the interest rate. Are you understanding? Hence, you are exposed to interest rate risk. If you are a borrower, you will feel that the interest rate might increase. In that case, I have to pay more interest. So you are fearful of interest rate increase. I will go for FRA. FRA is one of the strategy for interest rate risk management. So what is this FRA? Very simple. See, now I want money for a period of 6 months. After 3 months, I want, this is the position now. What I do, I take FRA contract. Now I have 2 banks, say SBI, and there is a Citibank. Now in this SBI, see, I'll explain how the FRA works. FRA is a separate contract than the original borrowing or lending contract. Are you all understanding? So SBI, you borrowed, assume 50 crore rupees or 50 lakhs rupees, some amount you borrowed from SBI today. Okay, you don't know what would be the interest, but I want to hedge my interest rate risk. Are you all understanding? Now now you go to Citibank, you try to enter into FRA contract. You try to enter into FRA contract. It is something like derivative contract. What will happen now? Very simple. Okay, suppose you want to buy FRA. Now, as a borrower, you will go long FRA, you will buy FRA. FRA is nothing but, okay, see, here is a customer, here is the banker, here. What do you do? FRA is a rate whereby you agree to pay a fixed rate of interest, okay, with respect to the MIBAR or reference rate, which means I agree to receive MIBAR. I agree to receive MIBAR or prime lending rate or LIBAR, any rate. This is called as reference rate. This is, okay, I call it as floating rate, which means I don't know what will be the rate prevailing after a period of 3 months, but what I say, whatever might be the rate, I will pay you 8%, I will give you 8%. Are you all understanding what I'm trying to say? Which means, okay, this is a separate transaction, this is FRA transaction, separate transaction from the cash transaction, original transaction. See, already you have taken a borrowing loan, okay, you can enter into FRA. Or even a person who has not taken a borrowing at all, loan at all, can also enter into FRA. This is the very, very important aspect. Are you all understanding? So assume I'm just a speculator. I can take FRA, I can enter into FRA and do the transaction. Okay, the FRA will be settled. The net cash settlement will happen. How does FRA will be settled? Just like futures, net cash settlement will happen. Sir, how this net cash settlement will happen? Very simple. Okay, say today you want money after a period of 3 months for 6 months period, 3 into 9 FRA. You entered into, this is called as 3 into 9 FRA. If you entered into 3 month FRA, what do you say? Whatever might be the interest rate prevailing after 3 months, I say that I will pay you a fixed interest rate of 8%. Okay, in return for MIBAR, whatever MIBAR prevailing on that date, I will pay you 8% interest. Now, two scenarios possible, two situation possible. This is MIBAR. Okay, this is floating rate. I don't know what will be the MIBAR after 3 months. After 3 months, what happened? Situation number 1, situation number 2. Situation 1, what happens? MIBAR turned out to be the reference rate, which means on the date, floating rate turned out to be, okay, suppose 7%. And MIBAR in the situation 2 turns out to be 10%. Are you all understanding what I'm trying to say? Which means you say, okay, after 3 months, real MIBAR comes to 7%, but I agreed to pay how much? I agreed to pay 8%, which means loss for me. Are you all understanding? See, originally you agreed to pay 8%. If the real interest rate is more than what you agreed for, you will gain, because instead of paying 10% interest rate in the situation to assume 10% is the MIBAR. Instead of paying 10%, you will end up paying lower rate of 8%, hence you will have gain. So when MIBAR, real MIBAR turns out to be 7%, you will have loss. Are you all understanding? The differential amount, okay, what is the differential amount? Extra amount, 1% extra you need to pay na? The 8% you agreed to pay minus 7%, the 1% is loss na? This, okay, while entering into FRA itself, you will have the notional principal, which means that FRA is not real transaction, net cash settlement will happen. What they say, okay, it will have some notional principal amount on which the differential loss on the percentage will be applied. Are you all understanding? So there is notional principal, assume there is 50 crore. Because say 50 crore I have taken, if I am a hedger, I would have taken 50 crore borrowing. For hedging the 50 crore borrowing, I will take somewhere around 50 crore of, okay, the notional principal. Assume my position, okay, is only 30 crore. My exposure, my borrowing is only 30 crore. Now I will take notional principal as 30 crore as near as possible. Sometimes, okay, if a speculator, okay, even without having a single rupee of borrowing, you can also enter into FRA by taking notional principal of 50 crores. Customized contract, you can OTC contract, you can, okay, customize it. So assume the notional principal is 50 crore. How to compute now profit and loss? How to compute profit or loss? That is the issue now. FRA transaction, have you understood? Now how to compute the profit or loss? Notional principal amount 50 crore into, okay, the real rate or the reference rate, real rate, which means the floating rate, which actually on the date of what transaction, it turns out to be say 7% in this example. So real rate minus FRA rate, float, okay, this is reference rate minus FRA rate. Okay, this is notional principal into the differential amount. Okay, real rate is 7%. Okay, the FRA rate is agreed upon rate is 8%, which you overpaid now. 1% loss will be there. And this is not the only thing. See, this is annualized percentage. Again, This 8% or 7% is always per annum, per annum. In the entire subject, whenever you see the interest rate, it is per annum, and annualized interest rate, per annum. So what you do, but your transaction, your hedging period is only for 6 months, na? Very simple, yeah. After 3 months, in our example, after 3 months, you want only a period for, only for a period of 6 months. Agreed? So 6 months period, how will you do? Into 6 by 12. Are you all understanding? This is how your net loss will be computed. But here is the only catch, okay? What is the happening really? There are two important dates for the FRA. This is very important to understand swap also, hence I am connecting here. FRA, what happens? See here. Sorry. See. FRA transaction, really what happens, you see, in all the interest rate transaction, you borrow today. Assume, this is, I just showed you, now I'll come back to that. See here. This is 0 to 9 months. Say this is 3 months. This is 6 months. What happens really? You borrow today for a period of 6 months. Assume this is you borrow today for a period of 6 months. Now, if you borrow today for a 6 months interest rate will be quoted as say 9% per annum. Okay. This is the quoted interest rate. Tell me children. Now, this interest rate, what will really happen? Now, you borrow today. Today itself you agree. Okay. How much interest you need to pay tomorrow? Are you all understanding? Really speaking, when will you pay the interest for this borrowing? After 6 months only. Okay, the settlement will happen. This I call it as settlement date. Are you all understanding? Okay, this I call it as, okay, reference date. Okay, and this I call it as settlement date. Settlement date. Are you all understanding? This is very, very important because, okay, the reference date on which this, okay, the quoted 9% per annum, the date on which the interest rate will be fixed at, this is also called a fixing date. Okay, interchangeably called as fixing date. Say the date on which the interest rate will be fixed at for the ensuing transaction. I call it as reference date. Okay, the reset date, also called as reset date. In case of swap, you will understand. Also called as reset date. And this is called as settlement date. This is called as settlement date. Are you all understanding? This clarity you should have. Now, for example, if I go to the bank, today itself I can enter into say after 1 year, how much interest is to be paid. Today itself you agree. This, okay, date is different. The settlement date is different. Now tell me children, what will happen? On this settlement date only, the numerator is there, na? The net proceeds, the what notional principal into the differential amount, the rate into 6 by 12, which you do. This is the net settlement. This will happen. The cash flow will be happening on which date? Okay, trade data, settlement date, which means after a period of 9 months, this will happen. Really speaking, the quantification of the put it simply, okay, the settlement of this amount will happen on the last day, which means on the end of 9th month. But the quantification of the settlement amount will happen at the end of the 3rd month itself. On that date itself, you will know how much is to be settled. So, which means here, notional principal into reference rate minus FRA rate into 6 by 12. This will be the cash flow after a period of 9 months. If you discount it for 6 months, at the prevailing interest rate, what is the prevailing interest rate after 3 months? That is called as a reference rate, which means 1 plus reference rate into 6 by 12. Okay, 6 months reference rate also will be annualized into 6 by 12. Okay, which is nothing but you discount the 9 months cash flow to bring it to the end of the 3rd month. Are you all understanding? Today itself you will know how much is to be the gain or loss in terms of present value. You will be understanding. This is what is given in your institute module as formula. Now shall we look onto the question? You will be very, very clear. Shall I? Okay, now. See, now take question number 67. You will have absolute clarity. Later swaps also we will discuss again. See, Mrs. Parker and Co. is contemplating to borrow an amount of 60 crores for a period of 3 months in the coming 6 months time from now. The current rate of interest is 9% per annum, but it may go up in 6 months time. The company wants to hedge itself against the likely interest rate. Now you understand, everything will be very, very clear. Okay. The company's bankers quoted an FRA at 9.3% per annum. What will be my final settlement amount if the actual rate of interest after 6 months happens to be 9.6, 8.8? Are you listening? Now, the question is a little bit different from our example. In our example, I told that, okay, we will need money for a period of 6 months after 3 months. Here, what they say, we will need money only for a period of 3 months, but after 6 months. Are you understanding? So, this is what is example. 0, 3 months, 6 months, and 9 months. What they say, you want money for just this period. You want money for just this period. Okay, and you want only after this period, 6 months time, not today, right? This is what they are asking. Okay, 60 crore for a period of 3 months after a 6 months period time. Okay, current interest rate 9% per annum. Tell me, children, what is this current interest rate? Relevant or irrelevant? Irrelevant. Why? Because you are not going to borrow today. You are not going to borrow today. If I borrow today for a period of 3 months, 9% per annum is the interest rate given in the question. But you are not going to borrow today. Hence, this spot rate is irrelevant. The spot rate is irrelevant. Now, he thinks that it may even go up further. It may even become higher than 9%. Then he goes for FRA. Now, the company's bank quoted 9.3. Now, what is this 9.3? This is FRA, quoted FRA or agreed upon FRA. As per the agreement, this is the rate. Okay, I agree to pay to the banker whatever may happen to the floating rate. Are you all understanding? Reference rate, real MIBAR, LIBAR, whatever may happen. This I agree, I will pay to the bank. This is what is the situation. Now, what they say, simple settlement about profit and loss in terms of present value, you find out if it turns out to be 9.6%, if it turns out to be 8.8%. See, final settlement amount, it is quantified on what date? This date itself. This date itself, it will be quantified, even though it will be paid on after the period of 9 months. Are you all understanding? What is the N? Notional principal. Nothing new. I already discussed. Notional principal into RR means reference rate. Okay, minus FRA rate. Okay, into date by. Okay, this is date to month divided by. Okay, date or year, days or year, number of days or years. Very simple. If question given in days, now you consider days. Okay, they will be giving you. Consider 360 days or consider 30 days. Now 30 by 360. If nothing given, you will take 365. Or you can take in months. If question is giving you months, here 6 months, after 6 months, after 3 months, like this, months is given. No, okay, specific date is not given. So what you will do? You will take months. So what I will do is here, okay, here month, number of months, okay, divided by 12, like this I will take, divided by 1 plus reference rate. When you discount, it is very important. You will take the reference rate in the denominator. Reference rate in the denominator. Why? Because that is the rate prevailing after a period of, which means the loan starting of the borrowing period. So that is the reference rate. 1 plus reference rate into, again, this you will do. Okay, but not this. Okay, reference rate into, what is that? Balance period 3 by 12. In our case, it is 3 by 12. Now, see the solution. 60 crore is the notional principal. Again, why I call it as notional? Notional because this is not. That is why this is important. FRA transaction, okay, need not be attached with the real borrowing or cash transaction. That is a separate transaction. Are you all understanding? Even without the real borrowing or depositing, you can go to any bank and enter into FRA. Are you all understanding? That is why they say notional principal. Okay, 60 crore, this is not real principal. 60 crore into 0.096 is the reference rate minus the FRA rate into 3 by 12. Why? Only 3 months I need loan. That is the loan period. Okay, into 3 by 12 divided by 9.6 into 3 by 12. I discount only by 3 by 12. Now what I do? I discount this 9 months cash flow and bring it to this 6 months end cash flow. Are you all understanding? Why? This is the period, okay, by which the loan will be starting, on which the loan will be starting. Are you all understanding? So this 3 months period is crucial. Okay. So 60 crore into 0.075. Okay, I'll get divided by 1.024. I'll get minus 4,39,453, a loss of 4,39,900. This banker, see, what does this negative value indicate? The banker, okay, will pay Parker and Co. a sum of 4,39,453. Are you all understanding? See, actual interest rate, yes, actual interest rate happens to be 9.6 in this case. So we have two situations. Situation 1, 9.6%. Situation 2, 8.8%. What? This is the real, the MIBAR, whatever the floating rate will keep on changing. Now, it may even be 9.6, it may be 8.6. Now, tell me, children, what is the agreed upon FRA rate? FRA rate is how much? FRA rate in this case, how much we agreed upon? 9.3%, 9.3%, 9.3%. FRA rate is 9.3. So, I agreed to pay 9.3. But real interest happened to be 9.6. I save 0.3%. I save means I'm making a gain. The other party has to compensate. The Citibank, the other bank has to compensate me. Are you all understanding? This is profit for me. Hence, this banker will pay Parker and Co. a sum of this much. Are you all listening? Yes, it is not minus. Okay, this is not minus. Okay, because that is wrongly typographical error. No issue. Because a reference rate minus FRA rate. FRA rate is lower now. So I will be gaining. That is why it is positive. So the banker will compensate me. How much? 4,39,453. Now, next case, if the actual rate of interest after 6 months happens to be 8.8%, what will happen? Okay, very simple. Okay, you have to compensate the banker because real interest rate 8.8, but you already agreed to pay higher interest rate of 9.3. You will lose 0.5 interest rate. 0.5% into 3 by 12 into notional principal 60 crore. If you discount this 1.22, okay, why? Because the 3 months discounting, if you do, you will get the present value. Are you all understanding? 7,33,853. Now, here only I want to clarify. In this question, they have discounted, but in some question, they have also mentioned the 9th month cash flow, real cash, settlement day amount, they have mentioned, okay, without discounting. But they have made the change. At present, if the question is asked regarding profit or loss, now use this method. Are you understanding? Discount always give a note also. Now, it might be possible that students may solve the question on the basis of days. Okay, this is just clarification. Now, shall we move on to the next question? Question number 68. Take question number 68. May 18 RTP. Very, very important question. Okay, the following market data is available. USD per Japanese yen is 116. Now, deposit rates given for USD and Japanese yen. Okay, 3 months deposit rate, 6 months deposit rate. Okay, if you can tell me, what are all these deposit rates? Okay, these are all FRA rates, spot rate. Are you understanding? Which means, what is understanding? If you deposit for a period of 3 months, starting today, you have to deposit at 4.5%. If you want to deposit for a period of 6 months, starting today, you can deposit at 5% per annum. Are you understanding? Which means for 6 months, not 2.5% per 6 months period. This is the US deposit rate, Japanese deposit rate given. Forward rate agreement, yen is nil. So yen, you don't have to consider this yen at all. Okay, FRA only for USD they are concerned with. That's why they have taken a FRA for yen is nil. Okay, what should be the 3 months FRA rate at 3 months forward? Very simple. What they are asking? 3 into 6. This is the understanding. They are testing 3 into 6 FRA. How to write it? Okay, you want to borrow some, or you want to enter into FRA after a period of 3 months for a transaction to take place after a period of 3 months. Or a period of 3 more months. Are you understanding? So transaction period is only 3 months, but that will not start today. That will only start after a period of 3 months. Are you understanding? So what should be by 3 months FRA rate? See, now I may ask, sir, here I have given 3 months rate to 6 months rate. 3 months rate is given 4.5%. 6 months rate is given as 5%. Sir, they are asking 3 months FRA rate. Why can't it be 4.5%? No, the 4.5% is the rate for 3 months. Okay, but if you only start today, are you understanding? So, for borrowing or lending, if you deposit your money today for a period of 3 months, this is the rate. If you deposit today for a period of 6 months, 5% is the rate. But what they are asking, what would be the FRA? What would be the fair FRA quoted by the bank? Okay, if you want to transact after a period of 3 months for a period of 3 more months, are you understanding? 3 into 6 FRA, if I want, what will be the quotation? Okay, this is nothing new. Okay, elaborately I have discussed in the bond valuation. How to compute the FRA, how to arrive at the FRA, I would have discussed in bond valuation chapter. I have put it a fixed income security. Okay, separate comprehensive revision series. I have put it in fixed income security. Timestamp also given. There I have put forward rate computation. There is something called as forward rates. There I would have discussed the forward rate, because in bond valuation we will discuss how to compute the forward rate. The application of the forward rate, there itself I have told you. Okay, we will apply this in interest rate risk management, FRA. Are you understanding? And interest rate swaps also. Now, see here what happens. Again, I will briefly tell you what are all these. These are all YTM, similar to YTM. Are you all understanding? Which means, see, 6 months interest rate. 6 months interest rate is given as 5%. Okay, 3 months interest rate is given as 4.5% per annum. How it is to be taken? Very simple. I'll just show you again. See, interest rate risk management, I have not separately covered under revision video or not. That is why I'm trying to explain here, so that in examination, so many students will have confusion in this chapter, specifically interest rate risk management. I'm taking some time to explain. If you are already thorough with it, you can, okay, skip the portion, just listen to the question solution. Or if you already know the question, you can directly skip the video itself. You don't need it. Okay, this is just given for those who have not, okay, attended this lecture properly. Okay, the interest rate risk management, the concept, those who have missed it, for them only I'm recording this issue. Okay, see here. Tell me, children, what happens? Okay, this is a 9 months period, 6 months period in the question. Right, this is 3 months period. Now, what they say, for a period of 6 months, what is the annualized interest rate? I have 5% interest rate, 5% interest rate per annum. Are you all understanding? For the period of first 3 months, 0 to 3 months, this is 0 to 6, this is 0 to 3 months, I have interest rate of 4.5% per annum. What is forward rate? Now, what is the interest rate derived from the current spot rate yield curve for a period of 3 months, after a period of 3 months, this is a question mark. Are you all understanding where the forward rate is to be computed? Very simple. I know that if I want to borrow for a period of 3 months starting today, I know that I can borrow at 4.5%. If I want money for a period of 6 months, okay, for a period of 6 months, I know that I can borrow at 5% interest rate. But I don't know, okay, what I need to take interest rate, okay, after a period of 3 months, for a period of 3 months. Are you understanding? This is called as forward rates. This is called as forward rates, actually derived from the spot rate, spot yield curve. Okay, the spot yield only they have derived, just like YTM. I have discussed detailedly in the bond valuation chapter. Now tell me how to find out. Simply say, tell me what happens now. Okay, what do you do? 1 plus, see, this is the bigger period. Take bigger period time frame. Okay, you know the rate. Are you all understanding? So 1 plus R, this I call it as 1 plus R. Okay, this I call it as 1 plus R into, say this is 6 months period, now 6 by 12. Are you all understanding? This I call it as interest rate prevailing for a longer period is equal to, okay, 1 plus rate. What is the rate prevailing? See, very simple. What is the 1 plus rate prevailing for the first 3 months? What is the rate prevailing for the first 3 months? 4.5%. Up 1 plus R into, okay, 4.5. This is 4.5%. I know that now. So I can write it like this. R1. R1 is what? 4.5%. 4.5% into 3 by 12. Are you all understanding? This is the first period rate into second period rate. Second period rate, what I will do? 1 plus R2. Let us take R2. I don't know the rate. I need to find out. Agreed? And it is for 3 months period. Yes, it is for 3 months period. Are you all understanding? Now, this 2 months period, you multiply it and find out the 6 months period. Agreed? Now, what they say, okay, this R also, you know, 5% per annum. Agreed? Now, 1 plus this R2 into 3 by 12. Like this, if you find, you will get the, okay, 1 plus 5% into, or 5%, 0. Okay, 0.05, like that you can write into 6 by 12 divided by 1 plus, okay, 4.5%. or 0.045 into 6 into, what is the 3 by 12. Like this, if you do, okay, you will get the R2 value. If you solve this, okay, this plus you take it there, minus 1. Okay, if you solve this, you will get the annualized interest rate, then 3 months interest rate. Are you all understanding? 3 months interest rate you will get, then can annualize rate. That is what they have solved it here. Are you all understanding the solution? Okay, see here. Now, see. First question, what should be the 3 months FRA rate at 3 months forward, which means not today, you want 3 months rate, but after a period of 3 months, what would be the rate? Okay, very simple. Okay, how to compute? See here, 1 plus 0.5 into 6 months period, total period you will take, equate it is equal to 1 plus first period, 0.045, I know that, into 3 by 12, plus 1 plus R, I can say R2, I don't know what will be the R2, I let the R be R2, which means the interest rate be R2, I don't know what is the period now, for which I want to compute, I put it as R2, here I 3 into 6 now, very simple, this is, okay, 3 months period till the period of 6 months. Okay, into 3 by 2. If you solve this, you will get how much? 5.44% per annum. Are you all understanding the computation? This is how we will compute. Now, next part. This is first part. Next part, they're asking the 6 and 12 months Libars are 5% and 6%, 6.5% respectively. Bank is quoted 6 by 12 USD FRA at this rate. Is there any arbitrage opportunity? Is there any arbitrage opportunity? Now, okay, there is 3 things. Hedger may enter into FRA. There might be a speculator entry to FRA. There might be also arbitrage opportunity. Very simple. The 5.44% which you compute, this is called as fair, okay, a fair interest rate. Fair interest rate. Okay, that is the fair FRA rate which should be prevailing for a period of 3 months after a period of 3 months. Are you understanding? This should be the fair FRA. Now, just like I told you in the derivative market, the quoted FRA, the FRA will be quoted by the bank. Citibank will give you the rate, okay, at which you can trade with me. After a period of 3 months, they will give you the FRA rate. This rate need not be same as what we computed like this. Are you all understanding? This is called a fair rate, which should have been the rate considering the yield today. Considering the 5% and 4.5%, this should have been the rate. But the real quoted rate will be same, will not be same, maybe same. Maybe different also, maybe, okay, overvalued, undervalued, which means maybe more or less also. That is what they have found. Is there any arbitrage opportunity? If the quoted FRA is same as the fair forward rate, there is no arbitrage opportunity. But if the quoted FRA is more or less than, okay, the FRA, real FRA, there will be arbitrage. That is what we need to compute. Very simple computation. Okay, here 6 See, 6 and 12 months Libars are 5%, 6.5%. What is the meaning? 6 months Libar na 5%, 12 months Libar na 6.5%. This is spot rate. If you borrow for a period of 6 months, 5% per annum is the interest rate. If you borrow today for a period of 12 months, 6.5% is the interest rate. But you want to borrow for a period of 6 months after a period of 6 months. Are you understanding? In this case, first you need to find out fair FRA here. Then you compare with the quoted FRA of 6.5 and 6.75. Okay. Then you will find out the arbitrage gain or loss. Shall we compute? Very simple terms. I will tell you when there will be arbitrage opportunity. If the fair FRA comes in between these two numbers, then there will be no arbitrage opportunity. Are you understanding what I am trying to say? Which means you compute the fair FRA. First step of arbitrage is to compute the fair FRA. That is what they have computed. See here, future value of 12 months from now, this is the fair FRA, 1.065. Bigger term, here 6.5% is there, the 6.5 and okay, 5%, they are equating. So 6.5% bigger term, 1 plus 0.065 is equal to 1 plus 0.05 into 6 by 12 into 1 plus, okay, the balance 6 months period into 6 by 12. If you solve, you will find out that 7.8% is the rate. Now tell me, the 7.8%, if it is coming in between these two numbers, where is this two number? Yes, FRA 6.5 and 6.75. If it is coming in between these two numbers, there is no arbitrage opportunity. Are you understanding? It will be range bound. If it is breaching the range, if it is going outside the range, you tell me, children, what will happen? There will be arbitrage opportunity. The arbitrage opportunity. Hence, what happens if it is undervalued or overvalued? See, the bank is quoting, okay, FRA at 5.5 and 6.75. Therefore, there is an arbitrage opportunity of earning an interest at 7.5% annum and paying 6.75, which means highest, this is the deposit rate, this is the borrowing rate, because this is deposit rate, this is borrowing rate. Okay, if you can borrow at 6.75%, are you all understanding? Yes, quoted FRA is given. Okay, you can enter into this FRA by paying 6.75 to the bank. And real, the fair FRA is 7.8%. You will gain. Are you all understanding how to compute the gain or loss? Very simple. See, what will you do for arbitrage? Borrow. Okay, there are 2 6 months period here. Assume there are 2 6 months period. Agree? This is 0. What do you do? Borrow here. Okay. 6 months borrowing. Okay. What is the rate? 5% is the rate, I think. What is the spot borrowing rate? 5% per annum. So what do you do? Borrow, first step. Borrow for 6 months period. Okay. Point 2, invest the borrowed amount. Invest the amount. Okay. Amount borrowed for 12 months. 12 months extended period you invest. Again, third step, what you do? Then, sir, if I invest after 6 months, I need to pay. After 6 months, I need to pay. Okay. Again, you borrow this amount. Are you all understanding what I'm trying to say? Again, you borrow for a period of 6 more months. 6 more months. Are you all understanding? Now, you see what happens. Okay. What they say, borrow for a 6 months period first. Okay. How much? $1 you borrow, assume. You invest it for 12 months period. At what rate? 6.5. Deposit rate you will deposit and you will realize 1.065. Are you all understanding? 1.065 you will realize ultimately. That is no one issue. Second thing, you have borrowed for 6 months period at 5%. The 5% per annum for 6 months, how much it is? 2 point? How much is that? 2.5%, 1.025. Are you all understanding? So 1.025 you will need to repay after a period of 6 months. Why? First 6 months you borrowed. Agreed? Now what I do to repay that, I again borrow 1.025 for the balance 6 months rate at FRA rate, at the quoted bank quoted 6.75. At this quoted FRA rate, I will borrow again. Are you all understanding? So 1.025, 6.75 by 2. First you do 6.75 divided by 2. How much is the rate? 3.375. Agreed? This 3.375, again I will, this rate, this 3.375%, this I will borrow again here to fulfill this amount, which means 1.025. What will be the repayment amount? Will be maturing to 1.03375. How much is that? 1.025 into 1.03375. 1.059. 1.059 or rounded off. This only the answer solution rounded off to 1.06. Are you all understanding? This is how you got 1.06, which means So first, step by step, first step, tell me what is the step? Borrow for 6 months period. You borrow for 6 months period. What is the interest rate? 5% per annum. 2.5% for 6 months. So borrowed 1 rupee. What do you do with the 1 rupee? Invest. Invest for 1 year prolonged period. At what rate? 6.5% quoted in the bank. They have given 12 months period. What is the deposit rate? You deposit the 1.065. Okay, after 12 months, you will realize the 1.065, but after 6 months, you will realize the 1.025, which means 1 rupee you have borrowed now. You have to pay 1.025 along with the interest you have to pay now. What I do, I pay that, but after 3 months, I don't pay out of pocket. Again, I will borrow. I will borrow 1.025 and I will pay them. I borrow for 6 more months. Are you understanding? At what rate? The quoted FRA by the bank. Quoted FRA by the bank, which is 6.75%. If 6.75% is the per annum, then for 6 months period, it is 3.375, which means 1.25 I borrowed for the second period. Okay, into 3.375%. That is the interest I have to pay. So how much total borrowing, maturity value of the borrowing will be, how much I need to pay out of pocket? 1.059. This 1.059, I will pay by, from the deposit maturity, I deposited 1 rupees. This would have been matured to 1.065. From this amount, I will repay the borrowing. 1.059. The balance amount is profit. Are you all understanding? Net gain of 0.005 is a riskless profit arbitrage opportunity. Are you all understanding how the arbitrage works? Okay. This is all about the question. I'm proceeding. You can go through question number 69. Electrospace is a... See, once again, we'll start with question number 69. Okay. Electrospace is a consumer electronics wholesaler. The business of the firm is highly seasonal in nature. In 6 months of a year, firm has a huge cash deposit, and especially near Christmas time and other 6 months from cash crunch, leading to borrowing of money to cover up its exposure for running the business. It is expected that the firm shall borrow a sum of 50 million for the entire period of slack season in about 3 months. Very simple. What they say, this company, okay, if 6 months time is there, the 6 months period, okay, this is a whole 1 year period, and they say that this 6 months period, okay, is good time, especially near Christmas. Okay, then the other 6 months time will be cash crunch. Okay, they will be experiencing cash crunch. Company will be having trouble. So what they will do, they will borrow 50 million for this period. Are you all understanding? And the slack period is coming, which means the 6 months time period. This is slack period now. Okay, when they will borrow now, that is coming after a period of 3 months. Say this is now, okay, today. This is today. You are sitting here. They say after a period of 3 months. Okay, next to 6 months is coming now. This is going to be the slack period. Are you understanding? So what they say, they want to hedge their position. A bank has given FRA. Okay, FRA position. Now, what is this FRA called? If you want to go, right, this is after a period of 3 months. Now, 3 into 9 FRA. 3 into 9 FRA. How? After a period of 3 months, they will need money for a period of 6 months. So I write it as 3 into 9 FRA. First, FRA starting period, the loan starting period. Then, okay, the loan ending period, 3 into 9. Are you all understanding? Now, the spot FRA given, 3 into 6 FRA given, 3 into 9 FRA given. Which is the relevant FRA? The 3 into 9 FRA. Are you all understanding? Okay, other two are given to confuse you. Next. The 3 month, okay, 50,000 future contract maturing in a period of 3 months is quoted at 94.15. This is interest rate futures. I'll make a brief discussion. This is about FRA, which you already know. This question is about FRA versus futures contract. Which hedging is better? This is what they want to find out. Okay, they've given details about FRA first. Then they're giving the details about futures contract. 3 months, 50 euro futures contract maturing in a period of 3 months is quoted at 94.15, 5.85%. I'll tell you what it is, so don't worry. You are required to determine how a FRA shall be useful if the actual interest rate after 3 months turned out to be 4.5, 6.5, which means ditto same question what we did in the previous question. Okay, what will be the gain or loss? Okay, if FRA turned out to be 9.5, first the reference rate or MIBOR or PLR turns out to be 4.5 and 6.5. What will be the actual interest rate? Effective interest rate, which means actual borrowing or lending happens in cash market. Apart from that, the FRA market, you have gain or loss. This you adjust to the main borrowing. Okay, find out the net interest cost. Okay, how 3 months future contract will be useful if for the company if interest rate turns out to be as mentioned in RTA. Are you all understanding? Now, See, FRA, I'll solve first FRA, which already known now. So we'll quickly finish it off. A futures contract, I'll have few small discussion, 1 or 2 points just, then after we'll solve. See, by entering into FRA, firm shall effectively lock in interest rate for a specified future in the given day 6 months. Since the period of 6 months is starting in the 3 months, the firm shall offer 3 into 9 FRA, locking borrowing rate at 5.94%. 5.94%. They have given a borrowing rate. This company is wants to borrow, wants to deposit, borrow. So borrowing rate will be applicable. So 3 into 9 FRA, borrowing rate 5.94 is the lock-in FRA, locked in FRA. Now, see what happens if the real rate turns out to be 4.5 and the real rate turns out to be 6.5. In the first case, when the rate, 1 second, is clear? Okay, yeah. Now, if the actual real rate turns out to be 4.5%, if the reference rate turned out to be 4.5%, FRA 5.94%, you have agreed to pay a higher rate, you will incur a loss. That is why you given loss in positive terms, the gain in negative terms. This is opposite, no issue. Given the solution like this, loss means 1.44 is the loss. What is the net payment amount under FRA? 50 million notional principal into differential amount 1.44 into 6 by 12. Half a year. How much is the value? 3,60,000. Are you understanding? So interest after 6 months on 50. You see, this is the payment or receipt as a compensation. This is the compensation amount. This is the I told you the gain or loss net cash settlement. That is the compensation amount. This is the original loan or receipt. Original loan borrowing repayment will happen at the real rate, whatever is prevailing on that date. Are you understanding? See, the 4.5%, the MIBAR turns out to be 4.5% on the date, so which means on that date, that will be the actual payment amount. If you are a borrower, you will have to pay interest. You will pay interest at what rate? Rate prevailing as on that date, real rate. Are you understanding? Now, the reference rate which you have taken. The forward rate, the difference between forward and reference rate, you apply in the notional principle, you calculate 1.44, this 3,60,000. It is just a compensation, gain or loss, which means if you have to pay compensation, you will pay out of it. If you receive compensation from the bank, you will receive as a customer. Are you understanding? So originally, how much you need to pay as interest? 11,25,000 plus you make a payment of how much? 3,60,000. Original interest amount for the original cash market segment, which means the original borrowing. How much is the amount? 11,25,000. Apart from that, customer is incurring loss. How much is that? 3,60,000. Total comes to 1125 plus 3,60,000, 14,85,000. Are you all understanding with this? Next, if the rate turns out to be 6.5, original borrowing will happen at 6.53, which means original the interest payment will happen at 6.5%. No doubt about it. But this one, the compensation you have to see the rate turns out to be 6.5. What is the agreed upon rate? 5.94, which means I have agreed to pay a lower interest rate. Actual interest rate is higher. Gain or loss, gain for you. How much is the gain? Notional principal 50 million into 0.56%, the differential amount into 6 by 12 or 1 by 2, that is 6 by 12 is equal to how much? 1,40,000. This 1,40,000 is gain. You will reduce from the net payment amount, which means originally, the cash segment, you will have to pay interest at what? Agreed upon the real rate 16,25,000 is 6.5% you will pay. Apart from that, here from the futures market, you will have a compensation received, paid compensation received. You will adjust. How much is that? 1,40,000. So 16,25,000 minus 1,40,000. Effectively, 14,85,000 is the net payment. Are you understanding? In this option also 14,85,000. In this option also 14,80,000. What is happening, sir? Very simple. The 14,80,000 divided by 500 million, is not into 12 by 6. If you annualize it, this is nothing but 5.94%. Agreed upon interest rate FRA. That is why FRA is key rate. Whatever rate you agreed upon with the FRA, you lock in FRA with the bank. How much is that? 5.94%. This will be your actual outflow, irrespective of what happens. Are you all understanding? Which means whatever may happen to the interest rates tomorrow, I will be hedged. My position will be hedged. I'm not worried about it. 5.94% will buy net amount. Are you understanding? This is the benefit of FRA. Next, now we shall move on to futures. The futures market. Now you have to carefully observe what is given here. See what they say. See, I will take the data related to futures market alone. The second part of the question asks 3 months 50,000 future contract. The contract is 50,000. future contract maturing in a period of 3 months. Contract maturity period is 3 months. Quoted at 94.15. Listen to me, friends. Futures, interest rate futures. Okay, our future normal equity futures, same way it is, it will be there. But the only change is the underlying asset is interest bearing instrument like bonds. Okay, the fixed income security, T-bills, bonds are there. Na? These are underlying security will be interest bearing security. Interest bearing security. Okay, I don't want to go deep into that. Anyway, understand that if it is quoted at 94.15, understand that it is nothing but interest bearing bonds. Okay, and what is the interest rate? Now, very simple, 100 minus 94.15. Like this, you need to understand. For example, if 94.15 is given, quoted now, what is understanding? 100 minus 94.15. How much is that? 5.85. This is the bracket they have given. This is nothing but 5.85. Like this, you need to find the interest rate. So, interest rate futures to find out how will the quotation will be given in the rupee terms 94.15. Now, what is the understanding? 100 minus 91. If it is given as 97, what is the meaning? 3%. Which means, see, you have to decide whether you have to sell futures or buy futures. See, as a borrower, I'll tell you what is the strategy. As a borrower, you will require money. You will pay interest tomorrow. You will pay interest in the future. You will receive interest in the future. You will pay in the future. Understood? So if you are paying in the future, means sell future. Pay means sell. That is what you need to understand. The interest rate futures are you understanding the strategy. So as a borrower, if he wants to hedge using interest rate futures, whether he will sell futures or buy futures or sell interest rate futures, are you understanding? Now, what is the meaning of this 94.1? Sell the party A Limited, okay, agrees to sell, okay, interest rate futures at 94.15. What is the meaning? He has agreed to pay interest at 5.85%. Are you understanding? Whatever might be the LIBOR tomorrow, I agree to pay interest at 5.85%. Are you all understanding? Pay interest. This is nothing but selling 94.15. Okay, a bond. Okay, see, it is nothing. See, interest bearing security you can buy, or the interest payment is there, you will pay. Are you all understanding what I'm trying to say? Okay. See, very simple. When you invest in bond, you will receive interest. When you invest in bond, you will receive interest. Correct? When you sell bond means when you issue bond. Okay, what you have to do? You have to pay interest. Are you all understanding? Like that, you need to understand. Okay, so he has to agree to pay 5.85% as interest. Okay. Now what they say? If the real interest rate turns out to be 4.5% and 6.5%, if you have agreed to pay 5.85%, what is the real the benefit or loss from the futures contract? See, very simple. Here, one thing is there. Future contract, if you see, the problem is the maturity mismatch. See. Now, for how many months I need funds? 6 months is the slack period. For 6 months I need money, but the problem is futures contract are only for 3 months. So what you should do? Increase the number of contract. There is a maturity mismatch. Okay, unlike FRA, you cannot. It's a FRA is a OTC contract. You can enter into bank. Okay, what do you say? You can enter into FRA with bank for your specific number of requirement. What say? If you want money for 6 months, now you can go and enter a 6 month FRA. Here what happens? 3 into 9 FRA. Here what happens? Okay, in the futures, it is an exchange traded instrument. You go to the stock exchange. It is traded in stock exchange. These bonds. So stock exchange, it is having a maturity of 3 months. Now you cannot change it. So what you can do is that you can double down the 50,000 contract on number of contracts you can increase. Number of contract you can increase to hedge your position. Are you all understanding? 6 months requirement can be hedged by 2 contracts. Okay, 2 contracts of 3 months. 2 contracts, okay, of carrying this maturity value of 3 months. Okay, are you all understanding? See here what I say. Since the firm is a borrower, it will like to offset interest cost profit on future contract. Accordingly, if interest rate rises, it will gain. Hence, it should sell interest rate futures. All the story you forget. Only thing is, what is the strategy? If you are a borrower, okay, think like this. If you are a borrower, you are going to pay interest tomorrow. Pay interest means sell interest. Sell futures means pay interest. That is the understanding. Okay, number of contracts you should double down. Amount of borrowing divided by contracts into duration of loan. Duration of loan here is 6 months. Up 6 by 3 into 2. Like this you need to do. Are you all understanding? So here 500 million is there. Divided 50,000 is the contract size. Into 6 by 3. Total, instead of 1,000 contracts, if assume the maturity period is 6 months, you would have only you would be only taking 1,000 contracts. Instead of 1,000, you need to take 2,000 contracts. Are you all comfortable? Okay, the final outcome under futures contract, if the interest rate turns out to be 4.5, tell me, children, if real interest rate turns out to be 4.5, but you have agreed to pay 5.85, you have agreed to pay 5.85, loss again, loss will be there, very simple, loss will be there, that is a positive. Okay, 94 prana. See, 100 minus 4.5, 95.5. What is the loss? 50,000 into 2,000 into 1.35 percentage. The differential amount will be the loss into 3 by 12. How much is the loss amount? 3,37,500. Apart from that, this is loss from the futures market. How many legs I have? I have 2 legs. I have cash market position, futures market position. Real borrowing or depositing will happen at what rate? Real rate, 4.5%. So 50 million into 4.5 into 6 by 12, 11,25,000. Apart from that, I will have a loss from futures market. This also I need to pay. This also I need to pay. This compensation I need to pay to the other party. This I need to pay to the lender. 11,25,000 is interest. Total how much? 14,62,500. Are you all clear with this? Next, come to the second position where interest rate turned out to be 6.5. Okay, interest rate turns out to be 6.5, but I only need to pay how much? 5.85, which means gain or loss? Gain in the futures market 0.65%. 50,000 contract size into 2,000 into 0.65 into 3 by 12. I get the loss as I get the gain. How much? This is the receipt put as negative. 1,62,500. How much is that? 50 million into 6.5 into half. Okay, 16,25,000. This is the real cash market, the payment amount. Then here you have a receipt of 1,62,500. 1625 minus 1,62,500, 1462. Irrespective of what happens, okay, my locked in interest rate will be 5.85%. 0.85%. That's the beauty. Okay, now with this we are through with the interest rate future. Shall we move on to one more question? Okay, one more question related to interest rate future. A simple straightforward question only. Okay, asked in one of the I think November 23 examination they have tested, and May 21 RTP also given. It was mock test paper, it was tested. Very good question. In March 2021, XYZ Bank sold some 7% interest rate futures underlying notional 7.5 coupon bonds. See, underlying asset is bond, interest bearing bonds. Okay, the exchange provides following details of eligible securities that can be delivered. Security given, various securities given. Quoted price of the bond. This need not be the fair price. Quoted price of the bond, which means the bond is quoted in the derivative market. Okay, it is quoted now. These quoted the listed price of the bonds. Conversion factor. Conversion factor is given. Okay, what is conversion factor? I'll tell you. See, recommend the security that should be delivered by the XYZ Bank if future settlement price is 1,000. So very simple. Future settlement price is 1,000. Future settlement price is 1,000, which means you will take 1,000 as settlement price. Apart from that, securities will have conversion factor given by the exchange. The exchange will give you the conversion factor. What is conversion factor? I'll tell you. See, you want to hedge through the interest bearing bonds, but the bond will have varying maturity. If you notice, the first security 7.96 Government of India bond 2024 maturing at 2024, 26, 30, 27, 28, 29, like this various maturity period there. Interest rate also different 7.96, 6.55, 6.8, like this. Coupon also different. Are you all understanding? Coupon, maturity, everything is different. That's why exchange publishes for each and every bonds. Okay, what is the conversion factor? These conversion factor, if you apply to respective bond, every bond will have their own conversion factor. If you apply the conversion factor to the value, you will be getting the equivalent amount for bringing in a parity. Are you all understanding? Comparability. For comparability, what you should do, this conversion factor, every bond is different. You cannot compare as such. Are you understanding? Can you compare a 2024 expiring bond with 2026, 30, 27 expiring bond? You cannot do that. Coupon rate also different. So how can I hedge, sir? How can I hedge using interest rate futures? Question arises. That's why stock exchanges will publish these conversion factors. What you should do, this you will consider, and apply it to the settlement price. Apply it to the future price. That's 1,000. Settlement price, normal price will be 1,000. This 1,000 you apply to the conversion factor. You need to apply. Then, you compare with the quoted price of the bond. Are you understanding? Now, the bond which is having a varying coupon and maturity will have obviously different prices. You cannot compare prices as such. So, what I will do, I will have this future price as 1,000. I use the multiply the conversion factor with this price. Are you all understanding? This price I will multiply. And then compare with this price. Then I will decide which one is okay, lower price or higher price and decide which one to buy. See, XYZ bank shall choose the cheapest to deliver bonds from the basket of deliverable bonds, cheapest to deliver bonds. So, whichever is the cheapest, I'll select. Okay, which gives maximum profit computed above. Very simple. Security given, first column. Just understand what they have done. Future settlement price is same for all. Future settlement price will be 1,000. But what will be changing? Conversion factor will be changing for each bond. Just now I told na, apply the conversion factor to the respective settlement price, which means you will get the settlement 4 is equal to 2 into 3. So settlement price into conversion factor, you get the number which will be comparable to the traded price of these bonds, actual price of these bonds. So 1037, 906, 990, 964, all these are there. I can compare this now, okay, fourth column with fifth column price of the bond. You see 1037, this is 1037.4. What is the profit? What is the profit? Very simple. Okay, the profit is 0.4 minus 0.4, which means because, see, this is the future price minus spot price. Futures price minus F minus spot price is negative, na? Okay, that is why minus 0.4. Then futures price greater than spot price or less than, so again negative. 919.5 minus 877 positive. 42. Okay, like this you will compare these two and find out the profit. Are you understanding? 6 maximum profit of the bank. Can we explain? 6.8 Government of India 2030. I think this one. Yes, this one. Okay, the maximum profit giving. Okay, bond. Same should be opted for. Are you clear with this interest rate? Now you may ask, sir, here. Okay, why this is minus? Very simple. Just sold some interest rate futures. Again, as a borrower, you will sell interest rate futures. When you sell interest rate futures, you will benefit from the actual rate dropping, increasing. Very simple. Yeah, you sell at this price. Now, what? See, very simple. You sell at this price. Actual price turns out to be this much. Now, if you sell and if you counter close the buy position, so sell at 37. I at 37.4 loss. Like this, you need to understand. Okay, that is why I sold. It is sell position. Earlier they have taken. Okay, question number 27. Now, this is a question related to swaptions. I think it is a question related to swaptions. Okay. Now, anyway, swaptions are those instruments which have, okay, the interest rate options as well as swaps. Interest rate options as well as swaps, which means swap instrument, as I told you, it is nothing but series of FRA. It is nothing but series of FRA. FRA only one time will happen. FRA exchange, okay, for a fixed, for a floating rate, FRA is nothing but a rate which you agree to pay, a fixed rate for a floating rate. Like this, you will understand now. Now, once you do FRA, okay, swaps are nothing but series of FRAs, which means for a period. Say for example, 3 years you are entering into swap. Every 6 months, okay, you will pay fixed, you will receive MEBA. Are you understanding? Next period, 6 months period, which means 6 months period will be there inside the 3 years. Apo, there will be reset date. On that date, every reset date, what will happen? Exchange will happen. Periodically, exchange will happen. One has to pay fixed interest, other has to pay floating interest. Like this, exchange will happen. Are you understanding? This is called a swap transaction. FRA, already I told you, you agree to pay 8% fixed rate. In turn, you will receive floating rate, MEBA, LIBOR, any rate. Okay, now this is called as FRA. Okay, now what they say, okay, this is a question where they combine swap as well as, okay, FRA. Are you all understanding swap? Which swap as well as, what do you say, options, swap as well as options. Options, there are two options, cap option, floor option. The same call option and put option is only called as cap option and floor in case of interest rate. Are you all understanding interest rate risk management? Cap means, what is the cap? Okay, call option. This is call option. Floor mean put option. Okay, a combination of cap and floor is also called as collar strategy. Where, okay, this question is about collar, I think. Floor and, okay, interesting, a collar strategy. Selling a floor, buying a cap. Like this, if you mix both these strategies, it is called as collar strategy. It is called as collar strategy. Are you all understanding? Okay, these things you have. Now, shall I move on to a question? This is the basic requirement. We'll just quickly discuss the question. Okay, we cannot explain everything in one go, so I'm predominantly discuss the question, assuming you will know, you know already all these things, right? So XYZ Incorporation issues a 10 million floating rate loan on July 1st, 2018 with resetting of coupon rates every 6 months. This is important. Now, 3 years is there, and this is July 18. Assume this is, yes, 3 years sell, 3 years flow. Okay, now what they say, 3 years, how many 6 months period is there? six months period is 6 months period is there. Every 6 months exchange will happen. Every 6 months exchange will happen, and you will see that at the end of each and every 6 months, what is the prevailing MEBA? Are you all understanding? If it is okay, see what is the difference between a swap and interest rate FRA and interest rate cap? Na? In FRA, both the parties will have obligation, which means the person who is paying fixed rate, he also cannot back up, and the person who is paying floating rate, he cannot also say that I cannot pay. Are you all understanding? But in case of the interest rate cap option, what the person can say, na? If you have agreed to pay 5.8%, if you have agreed to pay 5.8%, assume the interest rate is 7%. What you will do? Exercise your cap, exercise your call option. An interest rate worth 8%, you have agreed to pay 6%. You will exercise and pay only 6%. Are you all understanding? That's why it is cap, which means maximum limit. That's why it is cap. Yeah, before, after that, you cannot go beyond that interest rate. That is called as cap. Agreed? Now, there is another called as floor, which means assume you have agreed to pay 2%. Assume agreed to pay 5%. Real interest turns out to be 4.5%. Real interest rate turns out to be 4.5% or below that interest rate. Are you all understanding? Now, what will you do? What will you do? Will you exercise your right to sell, or will you lapse? Will you exercise your right to sell? Yes, I will exercise my right to sell and benefit from the option market, floor option. Are you all understanding? Which is floor interest rate option. Anyway, we will see here through the question. You will understand. See, it will take a lot of time to elaborately discuss all this. We will quickly rush through the questions alone. Briefly, you will understand through numbers better. See, resetting of coupon rates every 6 months equal to LIBOR plus 50 basis point, LIBOR plus 0.5, L plus 0.5% is the understanding. If L is 7%, it will become L 7.5%. KYC is interested in a collar strategy by selling floor and buying a cap. What he is doing? Selling a floor, buying a cap, selling a put option, buying a cap option, which means buyer, as an option buyer, the person has to pay the premium. As an option seller, he will receive the premium. This you need to remember. XYZ buys 3 years cap and sells 3 years floor as per the following details. Notional principal amount. Again, notional principal will be there for swap transaction, just like FRA. Swap is nothing but series of FRA. FRA, you have notional principal. Swap also, you have to apply some notional principal to it. That is why 10 million is the notional principal. Reference rate is 6 months LIBOR. Strike price 4% for floor, 7% for cap. 4% for floor, 7% for cap. Premium is 0. Why they have given 0? Nah, sir, you have taken both the strategy, floor as well as cap. You have some premium, na? Yes, but what they say, since premium paid for cap, as a cap holder, I need to pay premium. As a floor, as a floor seller, I will receive premium. But what they say in this question, it will become 0. Net premium is 0 because assume both to be same, which means premium received is same as premium paid. Need not happen like this. Ideally never will happen. Anyway, they given in the question. Using the following data, you are required to determine effective interest paid out at each reset date, the average overall effective rate of interest per annum. Very simple. What they say, reset date, various reset date given, various reset date, LIBOR given. This is nothing but floating rate. This is nothing but floating rate. Every reset date will change. Swap rate, every reset day, whatever is the rate, the next reset date, the settlement will happen. Now, for example, 31/12/2018 is there. Now if you see, when they are starting the swap, they see when they are entering into swap, issues this much floating rate on July 1st. And the sells 3 years old and details on July 1st. If you see that, it is starting on July 1, 2018. It is starting on July 1, 2018. So the first, if you see the reset date, it will start from 31st/12/2018. Are you all understanding what they say? 31st/12/2018, it will start ideally. But here if you see, the LIBOR rate is there, na? Yes, the LIBOR rate is what? 6%. Ideally, I'll tell you what here. Here 1, 2, 3, 4, 5, 6. Here 3. Only 6 dates are given. Remember this. This is important. Why? Because actually speaking, in a swap transaction, that rate which you are agreeing today, this reset date, for example, 1st July is there, 1/7/2018 is there. On that date, whatever is rate prevailing, that only will get settled on 31/12/18 actually. But like this question is there in your institute ICA material itself. Are you understanding? But this question where they only, so therefore see the question properly, where they have given only 6 rates, 1, 2, 3, 4, 5, 6 rates, what you should do, okay, you should only take these rates. You should only take these rates. Are you all understanding? Which means they have assumed that the 6% rate is the earlier agreed upon, like that you will assume and calculate. Are you all understanding? This settlement rate directly given, like this you will assume. But really speaking, in swap, what will happen? 1 July 2018, some rate will be given, assume 5%. Now, that 5% only will get settled on 31/12. Like that, rate prevailing on reset date will get settled on the next reset date. Are you all understanding? The cycle will continue. Hence, they should ideally give 7 dates here from 1/7/2018, then 31/12. This is irrelevant actually. 36/2021 is irrelevant because anyway, only 30/12/2020 rate will be settled on 36/2021. Hence, that will be irrelevant. Anyway, they have given. If this is the thing they have given, now you should assume that 6% is to be considered for, okay, settlement rate you should be considering. Now, see what they have done. Okay, here, once. Now, the payoff of each leg shall be computed as follows. Cap receipt notional principal into rebar on reset date minus cap strike price into number of days settlement period divided by the floor payoff. Okay, notional principal, floor strike price minus rebar reset date. But this depends on exercising or lapsing. If you are exercising, you will do that. If you are lapsing, you will never consider it. Are you understanding? I will show you just what. See here. See what happens. Can you see it properly now? This. Can you see this fully? See. Now, okay, see what happens. In case of cap option, see first reset date, let's click 31/12/2018. Libor rate is 6%, which means the current Libor rate is 6%. Now, what do you do? This is the transaction which happened in the, okay, cash market. What is happening? Real interest payment will happen now. Yes, that happens at Libor plus 0.45%. How much is that? Okay, see, principal amount into 6.5. Libor is 6%. Now, the interest payment 6.5% into 184/365. You will get the interest payment. Okay, now come to the option market. Okay, what happens to the cap? Will there be any cap receipts? I am a cap buyer, correct? Now, you have to compare the Libor with the cap at 7%. So you compare the Libor with 7%. You have agreed to buy Libor at 7%. Will you buy, exercise your right and buy? No fool will exercise and buy at 7%. When the okay, a 6% for the Libor, no fool will agree to pay 7% interest. Are you all understanding? So buyer will not exercise. So lapse now the value will be 0. There will be no gain or loss. Floor payoff. See, floor happened at 4%, right? To sell. Okay, happened at 4%. You tell me, you have a right to sell at 4%. A Libor worth 6 na. Are you listening? Which means, okay, the buyer of the floor, will he exercise? Will not exercise because this, see, the real Libor rate is 6%. Okay, the exercise price is only, floor exercise is only 4%. The option buyer, put option buyer or floor option buyer, will he exercise his right? He will never exercise his right. Are you all understanding? Why? Because in the open market, he can sell for 6%. No fool will exercise and sell for 4 lower percentage. Are you all understanding? So he will lapse. Hence, if he lapses now, my payoff will be nil. Okay, it is also nil. Are you all understanding? So why I am a seller of the put option. When buyer doesn't exercise, I need not pay anything. Are you listening? This will be nil. Again, effective interest is same as this interest rate. Next, come to the 30th June. 30th June, what happens? Libor is 7.5%. Okay, real market, Libor plus 0.5% interest payment happens. Libor 7.5 plus 0.5, which means 8%. Interest payment, okay, 100 lakhs into 8% into 181 into 181 divided by 365. You will get the interest amount. That is not an issue. Now come to the cap option and floor option. Cap option. See, cap option, you will compare Libor and the cap exercise price 7%. Cap exercise of 7%. See, a Libor worth 7.5, right to buy at 7. Will he exercise? Will he lapse as an option buyer? I will exercise now. So, what is the differential amount? 0.5. 0.5% is the gain now. Very simple. 0.5% gain now. Tell me, children, what will happen? See, 100 lakhs into, okay, what is the gain? 0.5%. 100 lakhs into 0.5%, 50,000 na, into 181 divided by 365. You will get the cap receipts. Cap receipts. This is the gain cap receipts. The cap holder will only exercise beneficial The other party will have to pay the compensation. So I will receive the compensation. I will receive the compensation of 24,795. I will pay the interest of 3,96,712. Net interest payment, okay, will be reduced. This minus 24,795, you will get 3,71,917 effective interest. Are you all clear with this? Next to 3112. Okay, again, I don't want to explain. This is normal interest. There is no cap or floor. Okay, we will not have any issue. Very simple terms. I'll tell you what happens. If the LIBOR rate comes in between the cap and floor exercise price, there will be no exercise. You see the 7 and 4% in between. Okay, if the 7.5 is exceeding the 7%, hence cap will be the beneficial. Cap you will exercise. If it is below 4%, then the put option holder will exercise and I have to compensate. As a seller, put option seller, I have to compensate. Floor option seller, I have to compensate. See, very simple. So 5, no event. 4%, no event. Come to the 31/12/2020. Here the LIBOR turns out to be 3.75 plus 0.5. Now, real interest rate market 4.25% you will pay. 100 lakhs into 4.25% into 184 by 365. You will get the real interest payment. Are you all understanding now? Cap you will never exercise as a holder. Why? Because you will exercise at 7%. No, a LIBOR worth 3.75. You have a right to buy at 7%. No one will exercise and buy. So that will not happen. Now come to the floor option. What happens to floor option? You tell me. Floor option. The option buyer will have a right to sell at 4 when it is real LIBOR is only 3.75. Will he exercise? Yes, he will exercise and sell at higher price. Will he sell at higher price? Which means the buyer will have the benefit. The buyer will have the benefit. As a seller, I am losing. I have to pay. I need to pay interest. I need to receive interest. Pay interest. That's why floor payoff. It is actually pay interest. Actually speaking, okay, here it should have been minus. Okay, it should have been minus 24,758 because it is receptor. This column, all these are payment. Hence, it will reduce the amount. So, 3,96,712 minus 24,795, it is 371,970. In this case, what happens? Floor payoff. Floor payoff, which means you have to pay compensation to the floor option buyer. Okay, here also payment, here also payment. So, add this 214, 247 plus 12,603. You will get 226,850. Are you understanding? Last, no event. The total effective interest rate comes to 1663,698. Okay, and the average annual effective rate of interest shall be how much? 1663,698 effective interest divided by capital 100 lakhs. Okay, into 365 divided by 1096. This amount interest is earned over a period of just 365 days. 1096 days. 1096 days. Are you understanding? This is the total interest earned over a period of 1096 days. If I annualize it, 3 into 365 by 1096, I'll get an annualized return of 5.54% per annum. Are you all clear with this? Take the next question. See, XYZ Limited borrows 50 million of 6 months LIBOR plus 10%, a period of 24 months. The company anticipates a rise in LIBOR. Hence, it proposes to buy a cap option from its bankers at a strike rate of 8%. The lump sum premium is 1% for the entire reset period. Okay. And the fixed rate of interest is 7% per annum. The actual position of LIBOR during the forthcoming reset period is as under, which means the reset period 1, 2, 3 and given. You are required to show how far interest rate risk is hedged through cap option. For calculation, work out figures at each state up to 3 decimal points and amount nearest to it should be part of working. Very simple. This question is about cap option. Now, cap option, what they say, okay, this X Limited borrows this much amount. For that, it enters into cap. Now, for example, at present, okay, the LIBOR is there, and what it feels really, okay, it enters into a option contract, or to say the cap contract, where it has a strike price of 8%. Strike price of 8%, which means very simple. You have agreed to pay 8% interest. What happens really? Okay, net cash settlement will happen. If the real interest rate is more than 8%, the differential amount will be settled. Are you all understanding? So, which means if assume LIBOR is 9%, so 1% will be the differential, 1% per annum. So, every period, 0.5% will be settled. Are you all understanding? Same way, 8% is the strike price agreed upon rate. 9.5 now 1.5 and 1.5 divided by 2 for 6 months means it is 0.75%. Like that, if it reaches 10%, now it will be 1% per annum, 1% per period, or 2% per annum. Are you all comfortable? So now question is just a 2 years contract period is there. Okay, only 3 reset dates are given. Why so? Because initially, okay, the interest rate caps works like that, which means if you enter into cap, okay, effectively for the first 6 months, the interest rate is already known. Are you all understanding what I'm trying to say? Which means first 6 months, what is the interest rate? It is already known, right? So you don't, it is fixed. So there is no variability, there is no risk involved. So risk actually starts from the, okay, first reset period. So first reset period will be there. Then there is first reset period in the sense after the 6 months period. So very simple. I'll just show you what happens really. This is 2-year period now. Today you are starting year 0. Then there is 6 months, 1 year. Then there is 1.5 years, another 6 months. Then there is 2 years. Okay. Now what they say, this 6 months period, there is no risk at all. There is no risk because already you know the rate. Are you all understanding what I am trying to say? This 6 months period will be exposed to risk. This 6 months will be exposed to risk. Okay. This 6 months period, what will happen? At this point, okay, the end of the first 6 months period, you will have the reset of 9%. Assume 9%. Now, this you will compare. This you will compare with the prevailing, okay, the LIBOR, prevailing LIBOR, you will compare with the strike price. Okay, and the compensation will be there. This is one period. Are you all understanding? This compensation is actually for this period. Understanding what I'm trying to say, even though it will be compared here, but it will be settled here. Like this for this period, okay, here it will be compared, settled here. For this period, this will be taken and compared and settled at the end of the 2 years. Are you all understanding? So, clearly speaking, first 6 months period no risk. Thereafter, 3 reset period will dictate the terms. Okay, now let us see what happens. But the premium is lump sum premium of 1%. This is how it is. Actual premium is 1%. It will be paid upfront. Premium will always be paid for option upfront, which means 1% of this amount, okay, will be premium. Yes, premium. So 150, the 15 million, which is 150 lakhs pound into 1%, 0.01. This is the total premium. But what I will do is that I will allocate the premium in 4 equal annual installments. Are you understanding? Even though the premium will be paid upfront, okay, it is for the total contract period now. Okay, it's a normal practice in the either. What I do is that I'll just allocate the premium in 4 equal annual installments. What you should do? Divide it by present value annuity factor, just like you computed EAB or EAC. Na? How you should do? Okay, present value annuity factor at what rate? Okay, at what rate? At prevailing rate. What is the prevailing rate? Fixed interest rate of 7% interest per annum. Are you all understanding? Fixed interest rate will be 7%. Now you should discount using that rate because every period it will keep on changing. Fixed rate only you are going to pay. So fixed interest rate of 7% you are taking. Okay, so you take 7% interest now. Present value factor 7% of 4 years. Actually, 4 years now. See what happens. 2 years now. 4 period. Okay, 6 months period, and the 7% I told you when you convert the annual data into 6 months period. Okay, what you should do, it is 3.5% per 6 months. Okay, you convert the data. So 3.5 for 4 periods. If you do the present value annuity factor, how to do it? 1 divided by 1.035, okay, is equal to 4 times plus GT. How much you are getting? 3.671. Okay, this is what you will get. Okay, are you all understanding? Comfortable? 3.671. That's what they want. So 1 lakh. What is that? 15,000. I think. Is there any 50 lakhs into 1%? How much is that? 1,50,000. Yes, yes. This is 10 is missing. I guess. One second. 1,50,000 is 1,50,000 divided by 0.6. How much is that? 40,860. See here, this 1,50,000. 10 is missing, nothing great. Okay, 10 is missing. 1,50,000 divided by 3.671. We get 40,861. Equated premium. This is equated premium. Okay, whenever you are comparing, this you should, okay, net it off. This premium you should net it off, and net benefit or loss only, net gain or loss only you need to compensate, compute. See, reset period, first reset period at the end of the 6 months period. Okay, first reset period will come. Additional interest due to rise in interest rate. What should be the compensation? Very simple. 8% is the strike rate. Interest rate happens to be 9%, which means interest rate increase up. Okay, you have 9% interest, which you agreed to buy at 8%, which means the other party will pay you compensate. Tell me, compensation will be paid or received? Okay, amount received from the bank. Amount received from the bank. Bank amount will be received. Bank will pay you compensation. Why? Rise in interest rate. I have cap option, which means maximum interest rate can go only up to 8%. Okay, more than that, now I will exercise the cap and the net benefit I will get. Are you understanding? Compensation from the bank. How much is the compensation? 75,000. How they have computed? Very simple. 1,150 lakhs into the additional 1%. Agreed? This 1% is period for 1 year, 1% per annum, right? The interest rates are annualized, so 1,50,000 divided by 2. How much is that? 75,000 pounds. Okay, like this. So every period you will compute the amount. 1,12,000. How they compute the second period? Very simple. You have got 9.5 or 10%, 9.5%. What is the 8% is the strike rate? MIBOR terms out to be 9.5. How much the bank will compensate? 1.5% per annum. So every 6 months now 0.75%. 150 lakhs into 0.75%. How much is that? 1,12,500. Are you all agreeing? Okay, this is the next last one. Okay, you have 10%, not 2%, 1% per annum. So 1,50,000. 150 lakhs into 1%, 1,50,000 is the compensation received. Now, this is the compensation received. Actually, this is premium paid to bank. It should be outflow for me, right? This could have been shown in bracket for further understanding. Okay, this is outflow. This will be remain same. First transaction is not there. Don't ask, because it is okay. There is no risk involved. Hence, there is no uncertainty involved. There is no cash flow, cash inflow or outflow. No need to pay compensation or receive compensation. So here it is premium this much, and this much. Are you understanding? So total of the premium 1,22,583. Okay, total of this much is how much? 337,500. Okay, net compensation to be received how much? 2,14,917. Now, what is the understanding? Very simple. These are all the transaction which happens in the options market or derivative market. Are you all understanding what I'm trying to say? This is the net benefit, arising from the cap option, purchase of the cap option for this person. Okay, if you see for this company XYZ Limited, if you see actually he borrows 15 million for 6 months in Liban at 10%. The cash transaction is separate, which means that the company has to pay LIBOR plus 10% interest for the borrowing. That will remain same. That will not change. But the point is the exposure amount, the outflow amount will reduce to this much, amount over a period of this 2 years. Are you all understanding what I'm trying to say? 2,14,917 is the amount, will be reduced from the net payment amount. Interest originally, agreed upon interest, borrowing interest, that payment it will reduce. So it will be hedged. Thus from the above it can be seen that interest rate risk amount to this much will be reduced by this much by using the cap option. You are listening what I'm trying to say? Interest rate risk originally was this much, that would be reduced to 2,14,900. This is what is happening in of cap option. Okay, now shall we move on to the next question? Okay, question number 73 is swap gain or loss. Very simple and straightforward question. Okay, and most of the every an alternative attempt they used to test this. Anyway, IB, an Indian firm, has its subsidiary. See why I put only this question. Swap question, one question is there, but still I feel this time currency option, one Drilldip question is there, RTP question, that they might test. Okay, I think it is very much due. They can test that. That's why I think interest rate arbitrage rather than putting interest rate arbitrage, I put a currency swaps there. That is more important than this. Hence I put the simple question here, that more or less they can test that. Okay, IB, an Indian firm, has its subsidiary in Japan, and Zaki, a Japanese firm, has its subsidiary in India. So Indian firm has a subsidiary in Japan, another firm, Zaki, a Japanese firm, has subsidiary in India, and face the following interest rate. Okay, see, IB has this much interest rate. IB has a INR floating rate of this much. Zaki has a INR floating rate of this much. IB has a Japanese yen fixed rate of 2%. Jackie has a fixed rate of Japanese yen fixed rate of 2.2%. Are you all understanding what I'm trying to say? Okay, this is the data that is being given. Now, Jackie wishes to borrow rupee loan at a floating rate. Jackie wishes to borrow, rupee loan at a floating rate. Why? For its subsidiary. If Jackie has a subsidiary in India, it wants to take a rupee loan, and that too at a floating rate. But problem, what is the problem? Okay, for a foreign country, okay, for Jackie, what happened? The Japanese-based company floating rate, okay, rupee borrowing rate, floating rate is more than the Indian company's floating rate. Are you understanding? If the same floating rate taken by the IB Limited, Indian company, the floating rate is only, okay, BPLR, how much is that? 0.50 plus 0.50. Okay, here 2% is extra. Okay, since it is operating in a foreign soil, it has to pay 2% extra. Wishes to borrow, and IB wishes to borrow Japanese yen. The IB, okay, company has Japanese subsidiary, na, it wishes to borrow for that. There also, if you see, it wishes to borrow Japanese fixed rate, but problem is that it can only get the fixed rate at what rate? See, what is that? Yes, borrow Japanese yen at fixed rate. Japanese yen and at fixed rate. It wants to borrow at 2%. It wants to borrow at 2%. Okay, IB wants to borrow. Now, at present, it has taken a floating rate. It wants to borrow a fixed rate. Okay, the amount of loan required by both the firms is same at the current exchange rate. A financial institution, Maya, arranges swap and requires 25 basis points as commission gain, if any, to be shared by firms equally. Okay, you are required to find out whether a swap can be arranged which may be beneficial to both the firms. What rate of interest will the firms end up paying? Very simple. What, see, we can try like this. Okay. See, IB is there, and here Jackie is there. Okay. Now, IB is an Indian firm, subsidiary in Japan, right? Subsidiary in Japan, it has subsidiary in India. Now, what they say, INR floating rate for IB is how much? Okay, this much. Lower floating rate. INR floating rate is this much. Okay, already it has taken a floating rate. Assume like this, it has taken a INR floating rate. But, okay, the IB wishes to borrow Japanese yen at a fixed rate. It wants to borrow Japanese yen at a fixed rate. It wants to borrow Japanese yen at a fixed rate. But Jackie, what happened? Okay, it wants to borrow what? Rupee loan at a floating rate. Rupee loan at a floating rate. INR floating rate. Jackie wants to borrow INR floating rate, but it has BPLR plus 2.5%. At present, what is the rate? It has to pay, if it is the case, it has to pay BPLR plus 2.5%. This you keep in mind. This, if you want to buy, how much it wants to buy? Rupee. What is that? IB wants to buy Japanese yen fixed rate, 2%. Okay, the target rate. Okay, this is the current situation. If it takes this, IB takes Japanese yen fixed rate, it has to take a 2%. Jackie, if it wants to take an INR floating rate, now it will be at BPLR at 2.5% without entering swap. This is the situation if it does not enter into swap transaction. Are you all understanding what I am trying to say? What they say? First, you enter into swap transaction. First of all, if there is any arbitrage opportunity in swap, how to find out whether there is arbitrage opportunity in swap? Very simple. What do you do? I just rub this everything. Now you tell me. Okay, the formula for this is nothing but change in fixed rate divided by minus change in variable rate or change in floating rate. Very simple. What is the difference between the floating rate? Tell me, what is the difference between the floating rate? 2%. Agreed. See, for floating rate of IB is BPLR plus 0.5. Floating rate of Jackie is BPLR plus 2.5. What is the difference? 2% is the difference in the floating rate. What is the difference among these in the fixed rate? If it wants to borrow, okay, this can borrow 2.25, this can borrow 2%. What is the differential amount? 0.25. Are you all understanding? So 2% is the difference there. 0.25% is the difference here. Are you all listening what I'm trying to say? What is the difference between the difference of these two? Which means, okay, change in floating rate. What is the difference between change in floating rate minus change in fixed rate? Are you all understanding? Now, the negative positive sign is not important. The difference is only important. So here change in floating rate is 2%. Change in fixed rate is 0.2%. If I, sorry. Okay, if I subtract this, what I will get? 1.75. Are you all understanding? Net benefit which can be derived from the swap transaction is 1.75. Out of this 1.75, that to 25 basis point, which means 0.25% bank dealer's margin. So what is the formula for arbitrage? Okay, change in floating rate minus change in fixed rate minus dealer's margin, if any. The dealer's margin given in the question is 0.25%, which means you will deduct it 1.75 minus 0.25. How much is that? 1.5%. This is the net benefit from the transaction. Benefit, okay, this is the arbitrage gain, total arbitrage gain. How should I distribute this arbitrage gain? They have given, the gain, if any, has to be shared by the firms equally. Are you all understanding? Now see the question, that's all. Question is, though the company IB has an advantage in both the market, but it has comparatively more advantage in the INR floating rate market. Company Jackie has a comparative advantage in the JPI fixed rate market. However, company IB wants to borrow at the JPI interest rate, and company wants to borrow in the INR floating rate market. This gives rise to the swap opportunity. Very simple. IB raises INR floating rate this much, Jackie at this much. Total potential gain, the differential, N differential and INR differential. This minus 2 minus 2.25. Just now I computed now, it's nothing but 2 minus, what is that? 0.25. 1.75 minus the dealers. This is the total amount, 1.75 now. Dealers commission minus 0.25 if you reduce, less bankers commission, you have to be reduced. 1.5 will be shared equally. This 1.5% will be shared equally, 0.75%, 0.75%. Are you all understanding? Now what they say, yes, the beneficial swap can be arranged. This swap, if 1.5, what will happen really if 1.75 and 0.75 direct? Now very simple. What happened? If originally borrowed from the market, see, for IB Limited, what happens, you see, IB wants to borrow at a Japanese fixed rate of how much? 2%. Are you all understanding? So 2% IB will borrow. But I have swap benefit of how much? 0.75, which means effectively I can borrow even at 1.25%. Effective interest rate is 1.25. I get a gain, swap gain of 0.75. I have to pay 2%. Net payment amount is how much? 1.25%. Are you all understanding? Same way, for Jackie, what happens? Borrowed from the market, BPLR 2.5. It has no option. It has taken the loan now to BPLR plus 2.5%. But because of the swap transaction, it can reduce the interest rate risk. How much? 0.75. How much is that? 0.75. You reduce it. How much you are getting? BPLR plus 1.75. This you are getting. Are you understanding? So when you distribute the swap, effectively it wanted BPLR plus 2.5. It got reduced to BPLR 1.75. 0.75. The swap gain. It can utilize effective interest rate comes down to just BPLR plus 1.75. Are you understanding? Simple and straightforward question. One more question, 74, all-in cost swap. These are all straightforward, simple question. I think because last time they asked FRA, I think they have tested FRA recently, and before that also they tested. So I think this time more or less swaptions can be tested, and this what do you say, the swap arbitrage can be tested, and these all-in cost, and we have one more daily compounding, that is overnight index swap. These two can be tested. Simple area only. See, quickly we can, through within 5 minutes we can finish up. See, suppose a dealer quotes all-in cost for a generic swap. All-in cost, now all the cost included, the price quoted will be total cost. Again, 6 months LIBOR flat. If the notional principal amount of the swap is 5 lakhs, calculate semi-annual fixed payment. Very simple. See, 8% against the 6 months LIBOR. With swap, always you agreed upon fixed interest rate to receive a MIBOR or floating. This is a compensation for the MIBOR floating rate. One person will pay the fixed rate, other person will that person will receive floating rate. Now in this case, 8% is the fixed rate person is paying, and MIBOR he will receive flat. The notional principal is 5 lakh. See, which means the settlement will happen, the differential amount gain or loss will be settled. Semi-annual fixed payment, how much should be there? Very simple, notional principal amount, all-in cost 8%, but in the all-in cost, they have given the generic swap always will be based on 30 by 360 day, the day convention market. It is 30 by 360, even though 31 day, 30 day. It doesn't matter. 30 by 360 is the convention. Day convention is a separate topic. Now, anyway, so here 5 lakh into, what is that? 5 lakh notional principal into 8% into just 30 by 360 is for 1 month. So you get how much? See, this is half month, this is for 6 months. Now, this is 20,000. Are you all understanding? That is what they are asking now. Semi-annual fixed payment, how much is that? Because again, 6 months labor, 6 months, every 6 months I have to pay. Now, what is the semi-annual fixed payment? What is the payment to be made? If annual payment is 8%, it will be 4%, and the 30 by 360 should be applied, which means Okay, that is 30 by 360. Na? 30 by 360, number of days to be taken as 30, year to be taken as 360. 30 into 6 months period, 180 into 180 divided by 360 you have to consider. That is the point. Next, floating rate payment. You see, find the first floating rate payment for one above if the 6 months period from the effective date of swap to the terminated comprises 181 days and that corresponding LIBOR was 6% on effective date of swap. Are you all understanding? Effective date of swap only 6% LIBOR was there and it comprises 181 days. In that case, what will be the floating rate payment? Very simple, floating rate payment. Okay, see, notional principal into LIBOR into this. LIBOR will be there. Prevailing LIBOR is 6%. They have already given 181 days given. Here, fixed payment you will consider the 30 by 360. Floating rate, whatever is the days given directly, you will consider. So 181 divided by 360. 5 lakhs into 6% into 181 by 360, you will get 15,083. So this party will pay 20,000 fixed payment for which he will receive how much? 15,083. Are you all understanding? So net amount, what I am getting, 20,000 I need to pay. I will receive only 50,000. Okay, net amount 4,917. Are you all? That is simple and straightforward. In the two above, if the settlement is net basis, how much is the fixed rate payer paid to the floating rate payment? Which means you see here, that is why I told you. This, if you notice, here I say fixed payment, correct? Here MIBA. So this party A Limited assume what is the dealer? Okay, cost what is that? Okay, they have not given this. Dealer quotes this much, but assume A Limited is entering into the swap. Fixed payment is agreed to pay 8%. Whatever is receiving MIBAR was 6% and 181 days was given. So put it simply, this party A Limited has to pay 20,000 on a fixed basis, will receive variable 15,083 anyway, because it depends on MIBAR, it may change, which means if compensation is net basis, you don't need to pay 20, you don't need to receive 15. Ideally, okay, the other party, you have to compensate more, 4,917, you have to pay more. That is already there. Now 20,000 is the your payment. Okay, a MIBAR worth 15,083, you only paying 20, you are paying additional amount. That itself shows that you are compensating. Are you are understanding? Anyway, this is the all-in cost, simple and straightforward question. RTP January also they have put it. I don't know why they have put it. Very simple question only. Okay, derivative bank entered into plain vanilla swap through an OIS, overnight index swap. Okay, this is also very simple, straightforward concept only. On a principal of 10 crores and agreed to receive MIBAR rate for a fixed payment of the principal. Again, the same happens. Yeah, fixed payment. Okay, notional principal in 10. What is the 10 crores? And then for a fixed yes, receive MIBAR. This is MIBAR on an overnight floating rate. Okay, MIBAR means there are so many MIBARs available in the market. MIBAR, Mumbai interbank offer rate, London interbank offer rate, plain, it's all reference rate. Okay, based on the interest rate changes, the MIBAR gets published every day. If you see stock exchange, okay, it will get published in the stock exchange after 10 a.m. Okay, there will be so many MIBARs published. 7 or 10 MIBARs will be published. So 1 month, just like your bank, in varying interest rate, varying maturity period, interest rate will be published now. 1 year interest rate, 2 year interest rate, 3 year, like this. 1 month MIBAR, okay, 1 day MIBAR, 1 week MIBAR, everything 7 day MIBAR, like this it will be published. What they say, okay, I am agreeing to pay fixed amount, okay, at the end of the period for a overnight index MIBAR, which means everyday MIBAR. Are you understanding? So compensation will be computed for every day. Okay, the swap was entered into on Monday 2nd August and was to commence on 3rd August 2021 and run a period of 7 days. Respective MIBAR rates for Tuesday to Monday are given. Very simple. Or see, every day MIBAR we will publish. Just now I told you, each day we will consider the respective MIBAR. See, this is 7.75, I think, not 77.5. That will never be like this. 8.15, 8.12. Okay, 6 days are given. Now Tuesday to Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and then you have Monday, which means, see, I have 7 days, Tuesday to Monday. How come rates are only for 6 days? Don't think. The Saturday and Sunday will be same rate. Saturday's rate will be carry forward to Sunday also. Are you all understanding? Saturday's rates will be carry forward to Sunday also, which means here what I call it as Saturday, just 7.98 rate is there, that I take for 2 days, Saturday as well as Sunday. I'll compound for 2 days. Okay. If derivative bank received 317 on net basis, see, very simple. Okay, see, this derivative bank entered into plain vanilla swap, which means it received, okay, the compensation net settlement. What is the understanding? If you are paying fixed and if you are receiving MIBAR and you are receiving 317 as more, okay, the receipt is more. Now, what is the understanding? You have paid less fixed, more fixed. Ideally, you have paid less fixed, it seems, because maybe you are receiving more. That's the swap bill. Well, let us say. So, as settlement, calculate the fixed rate. See what they're asking. The fixed rate in the earlier question we did all in cost 20,000 was the fixed payment amount. Agreed. What the receipt was 15,083 or something. 4917 was the net settlement amount. Here what they are asking, you will calculate the total MIBAR receivable using the compounding overnight index swap rate is given. You will use these rates and compound the amount, and you will find out what is the total MIBAR receivable. Agreed. And you have the settlement amount also given in the question as 317 net settlement receipt. Using this, okay, you will find out the fixed rate as the balancing number. That is what is the question. The previous question what they did, they have given you both the number and asked you settlement amount also. Okay. In this question, they have given this number, MIBAR number, what you receive, and the compensation which you receive, that also they have given. You need to find out how much you have paid. That if you annualize, you will get the interest rate. That will become the fixed interest rate, because interest rate will be annualized. Here you are paying only for 7 days. That you will consider and find out. Shall we see? Very simple. Sunday is a working day. Sunday is a holiday. Work is rounded rupees and avoid decimal working. Okay. Work is rounded. Anyway, consider 365 days in a year. No issue. Answer. Now, one by one you will consider how this happens. Overnight index swap, how happens? I tell you. Principal amount of this much is there. 1,000 lakhs is there. Okay, 10 crore is there. MIBAR will be applied 7.75. Yeah. Yes, this MIBAR will be applied on principal. Okay, how much is the interest? 21,233 will be the interest per day. How the computation? 10 crore into 7.75%. This is annualized interest. You need interest for 1 year, 1 day, 1 day. This is overnight index into 1 divided by 365. You will get this number. Are you understanding this interest? Now what happens? The second day continues from the first day. So 10 crore is there. 10 crore plus interest will be added. This principal amount plus interest. Interest on interest will be there. So second day interest will be compounded. Every day the interest will keep compounding. And then at the end of the year, you will find out the net floating receivable amount. Are you all understanding interest? Total interest amount will be receivable. Are you all having the clarity? So 10 crore plus 21,233 you will add it. Okay, then you apply the MIBAR 8.15% again. Okay, 10 this number into 8.15 divided by 365 for a 1 year, Wednesday. If you find for Wednesday, you will find 22,334. Again, this interest you will add up here. So 10 crore 21,233 plus 22,334 into 8.12% into 1 by 365. Again, for 1 day, again, your interest you will find out. Are you understanding? Like this, you keep compounding. Only change it. See here, Saturday and Sunday, you will apply the 7.98% 2 days, which means 10 crore 87,618 into 7.98% into 2 by 365 if you apply. Let me just cross verify. Okay, 10 crores 87,618 into 7.98%. This is the total annual interest into what do you do? 2 divided by 365. That 43 764.33, rounding off 43,764. Are you all understanding what happens? So the Saturday and Sunday 2 day interest will, market Sunday is a market holiday. So you'll assume the Saturday rate to be prevailing on Sunday. You will compound it. So 43,764. Again on Monday, okay, you add it. Then apply 8.15% per annum divided by 365. You'll get 22,358. Total interest comes to 53,740. This I call it as floating interest rate. MIBAR. Total MIBAR I will receive how much? 153,740 according to this overnight index swap. Now, this is happening. Now, how much you need to pay? That is what is the question asking. So, this you will receive plus this you will receive minus yes, the C. Here you are receiving this amount. Okay. Now, fixed interest rate. What happens? Net settlement. What they say? If derivative bank received this much amount on settlement, derivative bank received this much amount on settlement. Now, what you should do? See, floating rate is more than fixed rate. That's why your net receipt. Yeah, very simple. In the previous question, fixed rate was more than floating rate. Fixed rate was more than floating rate. Net payment was more. That is the understanding. Correct? This much amount was the payment amount. Here what they say, this is the floating amount we have found out. Net receipt is this much. They are saying 317. If that is net receipt, you will receive this as well as this. Means what you should do? You should subtract. Are you all understanding what I'm trying to say? Okay, this is the amount. fixed rate will be lesser than floating rate interest. So you should subtract. How much is that? 153,423. Okay, is the value 153,423. 153,740 minus 317. This should have been shown like this. Okay, minus 317. You will get 153,423. Now, next. This fixed rate, if you do this, you will get 8% as fixed rate. Sir, how will you compute it? No issue. See, very simple. 153. What is that? 153,423. Okay. This is the, you have to find out the rate. This is the amount. What is the capital involved? 10 crore. That is 1,000 lakhs. Lakhs. This is there. For how many days interest this was there? Okay. 7 days, 8 days. See here. Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday, 7 days. So what do you do? Into, this is 7 days, into 365 divided by 7, into 365 divided by 7. Are you all getting 0.07999? 0.07999. Like this, you'll get other rounded off to 8%. Nothing but 8%. How you got? Very simple. 153,423 is the interest for 8 days. Agreed? So this is the interest amount divided by capital. What is the capital? 10 crore, or what is that? 1,000 lakhs. Okay. Then what is that? 1,000 lakhs. Yes, 1,000 lakhs. What is that? 153,423 divided by 1,000 lakhs. Yes, 1,000 lakhs into 365 divided by, you want to annualize it. You have to annualize 365 divided by 7 days. 365 divided by 7, you will get the 8%. Are you all having the clarity? Shall I move on to the last question of this segment? Interest rate, currency swap. Very, very important question. Interesting question also. Okay. Now, Drilldip Incorporation, a US-based company, has won a contract in India for drilling oil field. The project will require an initial investment of 500 crore. The oil field, along with the equipments, will be sold to Indian government for 740 crore in 1 year time. Since the Indian government will pay the amount in Indian rupee, the company is worried about the exposure due to exchange rate volatility. You are required to construct a swap that will help the Drilldip to reduce the exchange rate risk. Assuming that Indian government offers a swap at swap rate, which is $1 is equal to 50 in 1 year, then should the company opt for this option, or should it just do nothing? The spot rate after 1 year is expected to be 54. Further, you may also assume that Drilldip can also take a US loan of 8% per annum. This is a question that is being asked. See, very simple. What I'll understand, first we will try to understand what is the transaction here. Okay, then we will understand the numbers. See, the US-based company, this is a US-based company, wants to, do some activity here, contracted India for drilling the oil field. It is India. Okay, it wants to do the drilling for oil, right? But initial investment, US, the company will bring its initial investment. How much initial investment it requires? 500 crore is required. This 500 crore I have in US, the company is in US, so it will have dollar. It will have dollar. Assume equivalent dollar. Today the exchange rate is 50. Today the exchange rate, what they given? Yes, a spot rate which is $1 is equal to 50, which means the equivalent amount 500 crore. 100 million. What is the amount required? I think it is 50 So 500 crore. 500 crore. 500 crore divided by 50. How much is that? Lakhs, 1,000 lakhs, 100 million. Yes, in million it is 1,000. 1,000 lakhs it is 100 million. Are you understanding? Dollar 100 million. This is what is required. Now, this what they will do. The US company will take $100 million. It will convert it at 50 per dollar. Then at 50 per dollar, what it will do? It will convert the rupee and invest in Indian, the project. Then the project will generate a return of total, the government sold to an Indian government after 1 year. This happens today. I'll just show you what happens. See, this is US based company. This is India. Here, this company wants to do a oil drilling for an investment of 500 crore INR. This is INR, very clear with it. It is INR. For this INR, today it wants to invest. Initially, it wants to invest 100 million the dollar will be required. $100 million will be required. Agreed? To convert. So $100 million it will take, and then convert it at rupees 50 exchange rate, 50 per dollar today's exchange rate. It will convert, put the 500 crore in Indian. This is happening today. This is happening today. After a period of 1 year, what will happen? After 1 year, okay, after 1 year, this 500 crore project I invested, this will give me 740, 750 or 40, yeah. What is the question? 740. Okay. So after a period of 1 year, this project will give me 740 crores. This project will give me 740 crores. Are you all understanding? Government will give me 740 crores. Now the problem is, if you don't do anything, assume you don't do anything, what they say, see, the 740 crore will be the, what is that? The benefit derived from the project, the inflow derived from the project. Now, how much is the cost for US company? This is US company. Agreed, cost $100 million. It should be in dollar terms. Okay, any country, it will find the NPV in its home currency. Are you all understanding? Ultimately, the NPV will be computed from the from the native country's perspective. Okay, so US company, the company will find out in dollars what is the NPV, net benefit. So $100 million it's spent. When it comes back, 740 crores it will receive. Agreed? It will receive. What is the benefit? 740 crore. But the 740 crore after 1 year, if I go to the exchange market, I need to convert this 740 crore back. The exchange rate has increased to 54 per dollar. 54 per dollar. Now tell me, 740 crore. Okay, 740 crore divided by 54 is the exchange. What will happen? Okay, what is that? 137. Yes, 137. See here. 137,03,703, which means effectively what is happening? Yes, 137 million. I can say this as, okay, 137 million. In terms of million, I'm just taking, so the comparability will be there. Dollar 137 million. Are you all understanding? This will be the inflow. This will be the inflow, which means I put 100 million. I got how much? 137 million. So net benefit is 37. 37 million is the net benefit. Are you all understanding what is happening? Net benefit derived from the project is 37 million. Let's say what happens in case I enter into swap contract. In case I enter into swap contract, what is happening? Okay, the Indian company, okay, the Indian government, what they say that your 500 crore, I can guarantee at 50 exchange rate, what is prevailing today itself. Are you all understanding? You spend 500 crore, for this 500 crore capital, okay, at 50 rupees, I will keep you this as 50 per dollar, 50 per dollar exchange rate, I will offer this. Are you all understanding? Which means entire 740 crore, you need not convert into 54. What do you do instead? You convert 500 crore, I will guarantee you at 50 exchange rate, 50 per dollar exchange rate. Are you all having the clarity? So 50 per dollar exchange rate for 500 crore. Now 100 million, I will guarantee you to repay back. Agreed? So you give me 100 million, I repay you back 100 million. So what is exposed to risk? Only 240 crore balance is exposed to risk. Are you all understanding? Which means total benefit I get from the project is 740 crore in Indian rupee. Idhila 500 crore, what I say, this is guaranteed by the Indian government at the exchange rate of 50 per dollar, which is as good as current exchange rate, which means this current exchange 500 million, if you convert, this will be available at $100 million. Are you all understanding? Which means balance 240 crore alone I am exposed at 54 rupees. This I need to convert it at 54 per dollar. Tell me children, how much it will be there? 40 crores divided by, okay, what is that? 54. How much is the amount? 44 million. 44 million. Are you all understanding what I'm trying to say? So 44 million is exposed to this risk. 44 million is only exposed to interest rate risk. That is what they're saying. Now see, Okay, now you see the solution, you will understand. The following swap arrangement can be entered into Drilldip. Swap a US dollar loan today at an agreed rate with any party to obtain Indian rupees to make initial investment. After 1 year, swap back the Indian rupee with US dollar at an agreed rate, 50 rupees. Okay, in such a case, the company is exposed only to a profit earned, which I told you, 240, which means a 500 crore initial investment will not be exposed to risk. Only 240 crore will be the issue. Okay, with the swap. See what happens with the swap. Buy 500 crore at spot. Okay, initially what happened? 500 crore you need a buy. $1 is equal to 50. You buy 100 million. You invest year 0. Okay. What happens after 1 year? Swap 500 crore back at agreed rate with government at 50. 100 million you will receive back. So this is the outflow. This is the inflow. Agreed. Now sell 240 crore at US dollar. $1 is equal to 54. Okay, 240 crore at $1 is equal to 54. Now how much it will be? 44.44. Just now we compute. This is there. Now, after 1 year, you need to pay interest. That is, see, after 1 year, you need to pay anyway interest. You will assume that this amount is not there. Opportunity cost. This amount you invested, 100 million, opportunity cost should be taken. Which means this 100 million into how much? This 100 million into 8% you will consider, because the USD loan is at 8%. If you are taking 100 million, I assume you will take the local loan from the US market. How much is that? 8% given. See here, given as US loan at 8% per annum. Drilldip can also take US loan per 8%. This is opportunity cost. Now, see what happens. At 8% per annum interest you will pay. Now, how much it will be? 8 million. So total, what is the interest? See, 100 is getting, you are getting 44. So 100 you are getting from the project, which is getting from the by way of swap government is giving you. Then 44 you are getting through the you are exposed to interest rate risk. You are getting 44 for the 240 crore which are gained as profit. But you have reduced 8 crore because opportunity cost should be reduced. So 136 effectively, 136.44 will be the net benefit and 100 will be the net cost. So net result is net receipt of 36.44. If hedge is given, if hedge is considered, if hedge is taken by of currency swap, this is the solution. Next, without the swap, if you don't enter into this hedging transaction or swap with the government, what will happen? You see, buy 500 crore, swap 100 million, that will be same outflow. Inflow 137.04, that also we saw. Apart from that, interest you have to pay an opportunity cost we consider. In the example when I showed you, I did not calculate interest because, okay, anyway, we are going to see that. That's why I did not do that, because it is same under both the options. Are you all understanding? Anyway, so 8 we have to reduce. How much is that? 129.04. Are you all understanding? Which means if you don't take hedge, what happens? Okay, your net receipt is only US dollar 29.04 million. But if you hedge the position, okay, you will have additional this much. Okay, you will have the receipt of 36.44 million. Hence, you will make a gain. Since the net receipt is higher in swap option, the company should opt for the same. Are you understanding? So with this we are through with the interest rate swap. If these interest rate risk management as a whole, so these are all the area which you need to see thoroughly. If these questions, at least these questions you see, I can very much assure you that 8 to 10 marks question can be tested. I feel interest rate, okay, earlier they used to test in one attempt, then they leave for 1 or 2 attempts like this, it was there. But nowadays interest rate risk management, every attempt they're asking one question. Okay, so very important. Little bit time taken, but important. Please go through and finish the revision properly. Okay. Next, we will try to discuss the portfolio management. Okay. So portfolio management. These are all the general topics given in the portfolio management. I feel this could get tested. Apart from that, we will discuss question answers also. But predominantly, see here, Markowitz portfolio theory I have given. Optimum portfolio based on Markowitz portfolio theory. The Jan 26 attempt they tested. Optimum portfolio based on Sharpe single index model. Now they could test the optimum portfolio based on Markowitz theory. Then portfolio risk and return basic questions can be tested. Then covariance and correlated related questions. Portfolio beta. Okay, the big data will be given regarding 2 securities, and then we will ask to compute the portfolio beta. Okay. Then there is average return of portfolio CAPM based question. Beta using regression model. Krishna Limited question is there. I have included the material. Okay, portfolio risk, Sharpe single index model question. Even though they have recently asked that, but still one question ideally is to be done from Sharpe single index model. Then beta computation. Okay, this one beta computation related question. Characteristic market line and alpha. To find out the alpha. This alpha is different from Jensen's alpha. This is what the alpha Because beta into Rn bar is there na in your sharp single index model. That alpha I am mentioning here. Okay, arbitrage pricing theory, very, very important this attempt. Okay, because it was asked a few attempts back. Very much relevant for this current attempt. Securities lending scheme. Okay, stock lending scheme can be tested. Right. This is all about portfolio management. Let us go through the questions quickly. See. Question number 77 for discussion. The historical rates of return for two securities over the past 10 years are given. Calculate the covariance and correlation coefficient for these two securities. 10-year data given for security 1, security 2. How to find out covariance and correlation? See, very simple. First, to find out correlation, actually you need to find out the covariance. I already told you. So correlation is nothing but covariance divided by correlation, but covariance of these two security, divided by sigma 1 and sigma 2. Sigma 1 and 2 means or A or B. These two securities, security 1 and security. If you divide the covariance from the by the standard deviation, you get the correlation. So this formula first you need to understand. Correlation is equal to covariance divided by sigma A into sigma B. This you have to apply and find out the correlation. For that you need covariance na. That is what you need to do. See, covariance, when the covariance can be found out in two ways. When probability is given, when probability is not given. Okay, like this I've given in the notes, you can go through. Okay, detailed discussion, everything I've done in the portfolio revision. Okay, some 7 to 8 hours I've put it freely in the YouTube itself. Comprehensive revision series playlist there. There you can go through if you don't. Okay, if you want to learn deep, you can go through those videos. If you don't want to, okay, if you just want to revise this, use this question access. See, now this question already I discussed anyway. I'll just briefly discuss what happens here. 10 years data given. What you do? Simple. Okay, you compute the standard deviation. Those columns which you will open. Okay, which means a year. Then you have security return x bar you will find, which means here R1 and R2, two securities, security 1 and security 2, any number, they have assumed it to be R1. Then return of the first security. R1 means return of the first security, return of the second security. Okay, like this you will find. Then you will find the R1 bar. Are you all understanding how to find mean? This is mean when, okay, number of years data given just a simple average. Okay, add all this, you will get 148 divided by 10 n. You will get the 14.8. This is nothing but x bar. So next x minus x bar you will find out. Okay, this column. So this is the return, actual return. This is x minus x bar. What is the deviation? Okay, then what we will find out? R minus R bar the whole square. Till now, okay, everything remains same. Okay, when you find out the standard deviation, you will find out the year. X minus x bar the whole square. Are you all understanding? And you'll get the total summation of it. How much? 207.6. Thereafter, to find out standard deviation, what will you do? Okay, square root of x minus x bar the whole square. Now here R1 minus R bar the whole square. Okay, divided by n. This if you do, you will get the standard deviation. That's what they want. 207.6 divided by 10, square root of it. Okay, you will get 4.56 as standard deviation. All this remains same. But when you compute covariance, just you need to do, okay, product of the deviation. Very simple. Same way you find out for R2. Okay, years, then R2 minus R2 bar, then R1, what is that? Okay, this is R2, typing mistake. R2 minus R2 bar, the whole square. Okay, that is the last column. Now what you do? Okay, this is the, this column you will do to find out standard deviation of the R2, forget about it, no issue. What you do next, that is important. 1, 2, 3, 4. This is the fourth column and this is the sixth column. You multiply with this. Are you all understanding? This is nothing but fourth column into sixth column. Product of the deviation. Very simple. See here, minus 2.8 into this is minus 1, minus 21. What is that? Okay, this is the deviation. Okay, R1 minus 1 second. What they have done here? R1 minus R1 or the whole square. Okay, this is wrong only. Okay, no issue. See, this is R2 minus R2 bar square only. Okay, the R2 minus R2 bar square. But what you should do here, product of deviation. In the product of deviation, column 4 into column, column 3 into 1, 2, 3 into column 4, 5. What is that? R2 minus R2 bar. Yes, 3, 4, 5, 6. Column 3 into column 6. Product of the deviation alone. Don't square it up. What you should do? This first column is there now. RM minus RM bar. This into R2 minus R2 bar. Which means minus 2.8 minus 1. Okay, I got confused with the positive 1. That is why I tried. What is that? Okay, no issue. Minus 2.8 minus 1 into minus 1. Okay, how much it is? Plus positive 2.8. Are you all understanding? Sign is very important. In case of standard deviation, when you square it up, sign will vanish. Here sign is important. So product of deviation as such you will consider. Like this, for every year you will find the product of the deviation. You find out the summation of the product of the deviation. Here can you see the covariance formula? Simple. What do you do? Okay, summation, the product of the deviation divided by 10. Okay, and divided by 10. How much is that? Minus 8. See, what is the summation of product of deviation? Minus 8 sigma. Okay, this sigma na summation sigma. Okay, x minus x bar into y minus y bar, or security 2 minus 2 bar. How much is that? Minus 8 divided by n. You will get the minus 0.8 as covariance. This is called as covariance. Now, standard deviation, you will find out routine computation, standard deviation of security 1, standard deviation of security 2. Thereafter, correlation formula is nothing but covariance of these two security divided by standard deviation of these two security. So multiplication of the standard deviation, minus 0.8 divided by 4.56 into 2.9. Okay, this is standard deviation of security 1 and this is standard deviation of security 2. You will get minus 0.0605. Okay, this is very, very important question, regularly asked, okay, in every 4 or 5 attempts. I feel, okay, last they have tested, I think okay, May 22 or something, it may get tested. Okay, next question number 78. Now consider the following information on stocks A and B. Okay, return on A given, return on B given. You are required to determine the expected return on portfolio containing A and B in proportion of 40% and 60% respectively. Very simple and straightforward question. Markowitz return and risk profile. This is what I called it, return and risk profile. Basic question I told you. This may be tested. See, very simple. What is the return of the portfolio? Return of the portfolio is nothing but weighted average return of the individual securities inside the portfolio. Return of the portfolio formula is nothing but weighted average return. Okay, so expected return of the A is nothing but 10 plus 16 divided by 2. Okay, 13%. And see, individually you have return of A for 2 years, return of B for 2 years now. So 10, 16 now. What is that? Okay, this is 10 and 16, 2 years return. So 2 years data given. Now what you should do? Okay, 13%, which is 10 plus 16%, simple average, 26% divided by 2. Okay, you'll get the 13%. Are you all understanding? Then B is return for 2 years, 12 plus 18, 30 divided by 2, which is 15%. So you got average return. This is nothing but expected return. See, they want expected return of the portfolio consisting of A and B in the 40-60 proportion. Now, for finding portfolio return, you need to find individual securities mean return. Are you understanding? Portfolio return is nothing but weighted average return of the individual securities. Now, individual securities returns are 1 year it gave 10%, another year it gave 16%. Now, on an average it gives how much? 13%. This I call it as nothing but X bar. Are you understanding? This is Y bar. So now, if you want to find out, okay, the portfolio's return, what is portfolio return? Weighted average return. Weight of security A, 40% into mean return of security X. How much is that? Security A, how much is that? 13%. So that is what RP. RP means portfolio return. It's nothing but 0.4 into 13%, average of X. Then 0.6 security B, X A. And then 0.6, which is the weight of security B into average return of security B, you will get 14.2%. Are you all understanding? This is all about portfolio return. Then they have asked a standard deviation of the return from each of the two stocks. Okay, now what they have done, summation of x minus x bar the whole square. Now, very simple here. Okay, x minus x bar. Okay, x minus x bar the whole square. Then they have found out the sigma of this number. Okay, and divided by n. This is what they have done. Here 1, 2, x is 10 and 16. X minus the x bar is 13. Okay. So 13, 10 minus 13, how much is that? Minus 3. Here 16 minus 3, 3. Okay, then 3 square, how much is that? 9. Here also 9. Are you all understanding? So 9 plus 9 is 18. Okay, here you got 18. Yes, 18 divided by 2. This is summation of this number is 18, which means this is the variance, this is the amount. Now, how to find out variance? Very simple. Summation of sigma, summation of x minus x bar the whole square. This number is how much? 18. Are you all understanding? Divided by n. So square root of 18 by 2. How much is that? Square root of 9 is equal to 3. 3% is the standard deviation. That's how they have found. Okay, they just substitute the numbers. You can also put it in tabular format. Are you all understanding? Stock A and stock B, you can find out the standard deviation. Now covariance, very simple. Covariance, already I discussed. Use the formula. Okay, this is the product of the deviation and summation of it divided by n. You do it, you will find the covariance. Are you listening? Then correlation, covariance divided by sigma A by A. Last question, just now we did now. Okay. Then portfolio risk. Okay. What is portfolio risk? Standard square root of what is that? Square root of, okay, W1 sigma, W1 square sigma x square, W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y to correlation of x and y. Okay, R x and y. This you can substitute the numbers. You will get the what is the number? Total number. Okay, you will get the portfolio standard deviation. Are you all understanding? You it out. So you have the calculator. Okay, you can solve it. Square root of 1.44 plus 3.24 plus 4.32. 9. Okay, this is also 3. Okay, the square root of 9 I am getting. So verify. Now you need to solve. Next, question number 79. An investor decided to invest 1 lakh in the shares of two companies, namely ABC, XYZ. The projections of return from the shares of the two companies along with their probabilities are as follows. ABC, XYZ Limited given. You are required to comment on return and risk of investment on individual shares. Compare the risk and return of these two shares with a portfolio of shares in equal proportion. Find out the proportion of each of the above shares to formulate a minimum risk portfolio. See, very simple. Comment on return and risk. Na? Okay, this is with probability. This is with probability. So probability given. Last two questions we did without probability. This questions we are doing with probability. Okay, with probability I told you. Okay, probability will be there. ABC return, XYZ return. Okay, weight average return you need to find out. Now you apply the weighted average, probability weighted return. So 0.2 into what is that? 12. 0.2 into 12. You will get for this one 0.25 into 10 plus 0.25 into 28 plus 0.3 into minus 0.2. Like this, if you do, you will get the value for. Okay, see here they've given. Okay, this is for AB. First ABC. Okay, if you do 1 and 2, you will get the ABC's average return. This is mean return X bar, and this is Y bar. Okay, this is average return for what is that? XYZ Limited. Are you all understanding? So probability weighted average we will find out. Next, expected return from ABC is equal to 12.55%. Okay, that is already found out. Next, okay, we have this standard deviation. What is the second part they are asking? Compare the risk and return of these portfolio of these shares in equal proportion. Now we need to find out portfolio risk and return using equal weights. Okay, now that they have given here in the second part. This is the average return. Thereafter, they have found out the risk of it. Are you all understanding? They are asking return as well as risk. Risk normal. Okay, you did in the first part. Only change the formula. See what happens to formula. Normally, when the probability is not given, what will be the formula? Standard deviation risk formula. Standard deviation summation of x minus x bar the whole square divided by n. When probability not given. When probability given, what will be the formula? Square root of, okay, probability into p into x minus x bar the whole square. Okay, there will be no n. Are you all understanding what I'm trying to say? So p into x minus x bar the whole square will be the formula when probability given. So here probability is given. Okay, you will have the probability column, last column 1 into 6. See, all the other things remain same. XYZ minus XYZ bar na x minus x bar the whole square. This will be same. Instead of just adding this and okay divided by n, what do you do? Respective probability is there now. You multiply with respective probability, which means 15.1 into 0.2. 4.41 into 0.25, 252.81 into 0.25. Like this, if you multiply, you will get the last column, add it up. Okay, 126.98. Okay, square root this 126.98. How much you will get? 11.27. Are you all understanding? Like this, you need to find 12.95 and 11.2. Simple, straightforward only go through. Okay, this is the when probability is not given. Here, this is the standard deviation formula when probability is given. Okay, in order to find risk and return of portfolio of these two shares, the covariance between these two necessary here. Very simple. What they're asking. See, compare the risk and return of these two shares with a portfolio of these two shares in equal proportion. What they say, portfolio, you compare the risk and return with portfolio return and risk. So you need to find out portfolio return and risk. That's the only thing. Okay, so to find out portfolio return, I know weighted average return of the individual securities inside the portfolio. Okay, I will apply and find out the return. This is the expected return. This is weighted average return of the individual securities, which is 0.25 into 12.55 plus 0.5 into 12.1, you get 12.325. This I know already. Are you all understanding? And risk formula, same. Apply the risk formula, portfolio risk formula. Here, see what you do. Okay, normally you apply the weight here, you take it as 0.5, 0.5 into 0.5 square. W1 square sigma. This is you have taken as variance. Variance of ABC Limited. How much? If you see variance here, this is variance. Variance means square, standard deviation square. Are you all understanding the standard deviation square? Now, how much is the variance here? 167.75 into weight of security 1 into weight of W1. Okay, W1 square. W1 is 0.5. 0.5 into 0.5 into 167.75. Are you all understanding? Plus Okay, W2 square 0.5 equal proportion portfolio na. So 0.5 into 126 variance of the security XYZ that you will consider plus 2 into okay covariance here. See they okay you can also use correlation, you can also use covariance. First they have found out the correlation. See the question correlation is not given. Hence they have found out the covariance. Covariance formula again. Tell me children, when probability is given, what will be the covariance formula? I see very simple. A x minus x bar product of the deviation y minus y bar. This will be there when probability is given. See, when probability is not given, how will you find out? Okay, summation of this x minus x bar into y minus y bar divided by n, like this you will find out. When probability is given, what do you do? Summation of probability into x minus x bar into y minus y. You open a new column. Okay, whatever you have found out in the last column, you just multiply with the probability, respective probability, you will get the numbers. After that, you total the number. Okay, this is summation of probability into x minus x bar into y minus y bar. How much you will get? 144.25. Very simple. Now, risk formula. What is the standard deviation formula? See, the standard deviation formula W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y into correlation of x and y. Like this it is given now. What happens? Okay, you need correlation not given in the question, so they have computed covariance. So covariance computed now. What is the use of, what is the relationship between correlation and covariance? Very simple. Here r into xy given now. Okay, now see here, what do you mean by this correlation? You already know. Correlate, what is correlation? Covariance of x and y divided by standard deviation of x into standard deviation of y. The standard deviation of x and standard deviation of y is also given in the numerator. X and y will get cancelled. Are you understanding? So simply the risk formula, if you have only covariance, you can substitute it. Okay, how you will find out? W1 square sigma x square, no change. W2 square sigma y square, also no change. But plus 2 into W1 W2 into sigma x sigma y will be vanishing. Okay, and the correlation of x and y will also vanish because that only you have expanded. Now what you got? Covariance of x and y. Are you all understanding? So weight will be there, weight of 1, weight of 2 into covariance of x and y. Very simple. Here also if you see, this 2 is here, this covariance is 144.25 into W1 is 0.5 into W2 is 0.5. Are you all understanding? This is the shortcut for the standard deviation formula. Okay, I just substitute the correlation formula using the covariance because correlation not given. If given, directly you will take correlation. If not given, you come to covariance, that is better. See, to compute correlation, you need covariance first. Why to compute correlation by first computing covariance, thereafter computing correlation, then substitute it with risk. Rather than doing that, okay, just compute the covariance, substitute it. Why you don't have the correlation number? Are you all understanding? So sigma portfolio square between sigma, okay, the portfolio risk is how much? 1.25% is the portfolio risk. Portfolio return is this much. Now I compare the individual security to the portfolio security. Question is asking me to compare the individual security risk to portfolio risk. That's what I'm doing. Hence, the return is 12.325 with the risk of 1.25% for portfolio. Thus, the portfolio results in reduction of risk by the combination of the two shares. Diversification. Okay, benefit is you are having by diversification. You are reducing the risk, which means individual securities are having higher risk. My portfolio risk reduced to just 1.25. Are you understanding? This is main discussion in this question is regarding the optimum portfolio as per Markowitz portfolio theory. This is the formula for optimum portfolio as per Markowitz portfolio theory. Are you all understanding? Forget about this. Okay, this also can be done. Anyway, this correlation given, you will use this formula. Covariance given, this you will use the formula. To remember, you just remember this formula. Okay. Now, what is the formula? Sigma square, sigma x square. See, when you want to find out the probability, this is the, see, what this is the, see here, x a by c. Here I will tell you what happened. This 46% is there. This is the proportion. This they have written as capital X. This actually the proportion of ABC. I usually in my lecture I tell it as proportion of ABC so that you don't get confused. PABC means what? Proportion or the weight. You can also use WABC. What is this W? Weight of ABC. Okay, as per the Markowitz portfolio theory, what he says, okay, for a given level of correlation, what is the maximum risk reduction can happen? Portfolio risk reduction can happen. What proportion of, what combination of these two shares I should use? What proportion of this ABC limited shares or XYZ limited shares I use so that maximum I can reduce the risk? This is the optimum portfolio. Okay, formula. What Markowitz says, okay, see, proportion of ABC is equal to sigma XYZ square, the opposite. See, you have how many securities in the portfolio? 2 security in the portfolio. Okay, try to remember it. If you are trying to find out what is the ABC's proportion, very simple, yeah. ABC, if it is 40%, only two security in the portfolio. What would be the proportion of XYZ? 60%. Are you all understanding? If it is 30%, then it will be 70%. Agreed? Now, proportion of ABC, how to find out using this formula? Na? Proportion of ABC is equal to the other securities sigma square. First, you take other securities equal. If you want to find out the proportion of ABC, what is the other security inside the portfolio? XYZ. So, sigma XYZ square minus covariance of, okay, what is covariance of these two security, which means ABC and XYZ. AX I am putting AX na covariance of security A as well as security B. Are you all understanding? So sigma XYZ square minus covariance of AX divided by sigma, okay, ABC square minus sigma square ABC, or sigma ABC square minus sigma XYZ square minus 2 into covariance of, okay, these two security AX. Are you all understanding what I'm trying to say? Okay, this is the formula for finding the proportion of ABC. Now, very simple, yeah, denominator will not change. If you notice, see, I'll show you. In these two formulas, will denominator change? Will not change? Will never change. Are you all understanding? Denominator, see here, denominator will never change. Which means, okay, the denominator will be same. Sigma square A, sigma ABC square, okay, sigma X square, that I should say sigma X square, minus sigma Y square, sigma square, okay, variance of X minus variance of Y minus 2 into covariance of AX. This will not change. Numerator also, the covariance portion or the correlation into sigma A and C. Here they have used covariance, here they have used correlation into this you should understand like this. Correlation is denoted by R. Correlation is nothing but covariance divided by sigma A into sigma B, which means covariance of AB and sigma A and B. Are you all understanding? If this is the case, you tell me what will be the covariance. Covariance cross multiply is equal to nothing but correlation into sigma A into sigma B. That is what they have used. This covariance in the first formula, both are same only. First formula they have substituted the sigma A into sigma B, okay, into correlation. That they have substituted. We just found out now is same as correlation. Now, this you need to remember. So this is the proportion of ABC. How, if you substitute the number, you will get, okay, proportion of ABC, percentage of ABC is how much? 46%. If 46% is the proportion of the ABC limited, okay, then security, first security, second security should be how much? 54%. Okay, 1 minus the proportion of ABC. Are you all understanding? So even if you do for one balance, 1 minus, okay, or 100 minus the other number, you will get the balance. Okay, this is about optimum portfolio. Okay, now this is one interesting question. Okay, there's no separate concept involved. Okay, line using the equation of the line. Okay, y is equal to mx plus c. Equation of line is there now. That we use and find out the proportion. When 3 security portfolio is given, there you need to arrange the proportion and find out the value. See here, this is a very interesting question. The institute have given one alternative solution also to this. Anyway, if you can also solve it using the equation of the line, straight line, or you can also solve, okay, the alternative solution given in the last time, which they have asked 4 attempts back, they have asked, and they have given an alternative suggested solution also. That also you can verify. I have given the original, which was given in the practice manual earlier, study mat. Now they have changed the solution also. Alternative solution. It's not that this solution is wrong. Anyway, you can use another solution also. The investor has 2 portfolios known to be on minimum variance set for a population of 3 securities A, B, and C, having below mentioned weights. Okay, here weight of A given, weight of B, and weight of C. Portfolio X, portfolio Y. Portfolio is given. Securities are there, which means using 3 securities. There are 3 securities. Okay. 2 portfolios are constructed using 3 securities. Okay, portfolio X, portfolio Y. Now, it is supposed that there are no restrictions on short sales and even short sale. Now, what would be the weight of each stock of a portfolio constructed by investing 5,000 in portfolio X and 3,000 in portfolio? In portfolio X, I invested 5,000. In portfolio Y, I invested 3,000. What will be the weight of A, B, and C individually inside it? Whatever it is, what they have wanted to find out. Very simple. Investment committed in each security. Now, portfolio X is total how much? 5,000. You see that. In portfolio X, how much you want to invest? 5,000. And weight they have given now. A, B, C, they have straight away given. So multiply it. Okay, which is 5,000 into 0.3. 5,000 into 0.4. 5,000 into 0.3. Are you all understanding how you got it? Okay. Next, portfolio Y. See what happens in portfolio Y also. ABC's, okay, the weight is given. This is not an issue. First part of the question, not an issue. Are you understanding? So 0.2 into 3,000 you will apply. You will get 600. 0.2 into 0.5 into 3,000, 1,500. And 0.3 into 3,000. Okay, how much is that? 900. That is not an issue. Combined portfolio if you do, okay, you will get how much? 2,100 as how much? Value. Okay, of both these portfolios. The 2,100 is nothing but security A's value. Value of security A. Okay, combining both the portfolio. So security A, how much invested? 1,500 invested in say, portfolio X. 600 rupees of security A is invested in portfolio Y. Cumulatively, how much is the value? 2,100. Like this 2,000 plus 1,500, you create a matrix. Okay, 3,500, 1,500 plus 100, 2,400. Total comes to 8,000. Are you understanding? This 8,000 is nothing but total money invested in both the portfolio cumulatively. Are you understanding? Now, individual stock weights. How much is the weight? Okay, this you can do 2,100 divided by 8,000. See here what happened. Divided by 8,000. How much is that? 26.25. That is the rounding off. They are put simply 26. Next to 3,500 divided by how much is that? 8,000. Yes, 8,000. 43 points rounded off to 44% and 30%. Are you all having the clarity? This is what they have done. This amount divided by 8,000, they have found the stock weights. Stock weights. The equation next part is very, very important. Mark it as important. Okay. Now what they're asking, suppose the investor invests 4,000 out of 8,000 in security A. I don't know how much I invested in portfolio X and Y, but I say that 4,000 rupees I invest in security A, including X and Y, How he will allocate the balance between security B and C to ensure that his portfolio is on minimum variance set. Are you understanding? Which means he has allocated 50% already. See, 8,000 was the total amount available. Either 50% is how much is 50%? 4,000. This 4,000. Okay, I will allocate in which security? Security A. So balance 4,000 I need to allocate in what? In security B and security C. What should be my proportion? This is what is the question. Okay, for that to answer, that we answered, you need to create this. Okay, you have the equation of the straight line. You take a help of the equation of straight line. Okay, see, very simple. This is nothing but mx plus c. You have the straight line equation. Okay, see, there will be constant and there will be variable. Okay, here what they say, substituting the weight of A and weight of B. Here, weight of B is equal to, okay, A plus B into weight of A. Now, if you see weight of A, weight of B is how much? You know that weight of B is how much? 0.4. Yes, 0.4. See, weight of B, security B, what is the weight of B? 0.4. Okay, 0.4, okay, is equal to A plus 0.3 B. And 0.5 is equal to A plus 0.2 B. Are you all understanding? Okay, like this you can get you will get the two equation. When you solve these two equations, you will get A, the constant, and the the slope and the intercept. Are you all understanding? So 0.7, okay, and B is equal to minus 1. 0.7 and minus 1. Okay, then critical line WB is equal to 0.7 minus WA. If you apply the critical line equation, you will find out the weight of C also. Are you all understanding? So weight of A, B, C you got na. Total weight is 1 anyway. So you already know that 0.5 and 0.2 are two weights. Okay, this you have got now. Weight B, if you solve, you get 0.2. Okay, then cumulatively you know that it is it is 0.5. Here you have 0.5 now. So you know that it is 0.5 and this is 0.2. You got it. Weight of B is 0.2. Now balance is 0.3. Weight of C is 0.3. Now you got weight of B, weight of C. What is weight of A? 0.5. Okay, this is 0.5. You already know that. So just to multiply with this 0.5, 8,000 into A is how much? Weight of A is how much? What is that? 0.5 na? Yes, 0.5. So how much is that? 4,000. Already I allocated. Now weight of B is how much? Weight of B is how much? 0.2. 0.2. 8,000 into 0.2, 1,600. And weight of, okay, C is 0.3. How much is that? 2,004. This is one way of solving it. Okay, alternative solution also given. That study matrix question, they have given the alternative way. I couldn't put it here, no issue, but you can easily solve it. Okay, this question, please go through this question once. Okay, this is very, very important. Next, question number 81. Okay, question number 81. A company has a choice of investments between several different equity-oriented mutual funds. The company has an amount of, what is that? What is the total amount to be invested? 100 crore, I think. Yes, 100 crore, the typographical error. 100 crore is to be there. Amount of 100 crore to be invested. The details of the mutual funds are as follows. So, beta given. And if the company invests 20% of investment in each of the two mutual funds, an equal amount of the mutual fund CDEL, what is the beta of the portfolio? The company invests 15% of its investment in C, 15% in A, 10% E. What will be the balance in equal amount in the other two mutual funds? What is the beta of the portfolio? If the expected return of the market portfolio is 12, beta factor, what will be the portfolio's expected return? The expected return can also portfolio KE also they were asking. Required rate of return is different from expected rate of return. Here they are asking expected return. I think it is required rate of return. Let us see how they have solved it. Okay. See, the company invests 20% of investment in each of the first two mutual funds and the equal amount in mutual fund CDL, which means 20% and 20% you first invest. The balance 60% you invest here 20%, 20 and 20. What is the beta of the portfolio? Beta of the portfolio is nothing but weighted average beta of the individual securities inside the portfolio. 100 crore, 20, 20, 40 invested, balance 60. Okay, 0.2, 0.2 and which 20, 20, 20 equal weighted portfolio. Okay, weighted investment will be beta into investment, weighted investment total. Weighted beta is equal to 122 divided by 100. You can also do it this way, or you can find out the proportion totally. Very simple. You can open a new column. Instead of this weighted investment, you can also see proportion. You can find out proportion of 20 by 100, 0.2, 0.2, 0.2, 0.2, like this you will find out. Then proportion multiplied with beta, how much is that? 0.2 into 1.6 plus 0.2 into 1 plus 0.2 into 0.9. Like this if you find out, okay, you will get the weighted average beta 1.22. Answer will tally. Are you understanding? So this is portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. Next, with varied percentage of investment, portfolio beta is calculated as follows. They have given like this here. See, now if the company invests 15% of investment in C, 15% of A, 10% of E, just make the adjustment here. 15% of 100 is 15, then 30% in 100 is how much? C, and 15% in A. Okay, 15% in C and 50% in A, which means here 15 and 15 in C. Okay, balance what they have, how much is that? 15 and 15, 30. So balance 70 is to be allocated. What you do? 10% in E. Okay, anyway, 10 in E also given. So E also will take it as 10. Then balance, how much is there? 60 lakhs is there. They are asking us to allocate balance in equal amount. 60 crores, equal amount, na 30, 30, which you do in B and D, I think. Yes, B and D, 30, 30. You allocate it. Again, find out the weighted average beta. Very simple and straightforward. Are you all understanding? Next. Last part, if the expected, okay, market portfolio given, RM is given as 12% and beta of the portfolio is given as 1, beta factor is given as 1. Are you understanding? If this is the case, okay, CIPM you will apply RF plus beta into RM minus RF. Okay, you will apply and find out. Now, see, okay, now in this case, okay, expected return of the portfolio with pattern of investment as in this case is 12% into 1. Okay, okay, portfolio return is 12% of how much we have found out. What is the portfolio return? Beta factor, what will the portfolio is actually both the situations given below. See what they have done. Okay, I'll tell you what they have done here. Okay, here, okay, now case 1, case 2, they have given two different scenarios they have given. Okay, okay. In the both the situations above now, in first situation, the portfolio beta, how much is the portfolio beta? Let's see, portfolio beta is 1.22. The first situation, the portfolio beta is 1.22. Okay, in the second situation, what is the portfolio beta? 1.335. Okay, 1.335. What they have done now, very simple. Okay, whatever is the market portfolio, they have multiplied with the expected portfolio of, okay, your portfolio beta. See, the portfolio beta, the market return is 12%. Now, if you apply, very simple, your portfolio, if you see portfolio beta 1.22, what is it meaning? Okay, very simple. If market moves by 1%, your portfolio will move by 1.22%. This is the understanding of portfolio beta. Agreed? So your portfolio will move up by 1.22%. What they say, if market is moving by 12%, if market is moving by 12%, your portfolio will move by how much? 12 into 1.22 and 12 into 1.335. This is what 335. This is what they have done here. Can you see? Expected return on the portfolio. Market moves by 12%. If market moves by 1%, your portfolio will move by 1.22. If beta is 1.22, that is what is beta. If market moves instead of 1%, it moves by 12%. 12 into 1.22, that is what they have found out, 14.64%. Are you understanding? Next, in case 2, what happens? This is case 1. This is case 2. In case 2, what happens? If market moves by 13%, okay, your portfolio moves by how much? 1.335%. Oh, 1 second here, 13%. They have asked for 13%. Okay, they have asked for 12%. I think it is a mistake, typing mistake again. 12%. Into 1.6 16.02. Yes, 16.02. This is 12. Okay, no, 13. The 12. It is 12. No. Question number 84. A holds the following portfolio. Okay, Epsilon Limited, Sigma Limited, Omega Limited, GOI bonds. Okay, all this given. And beta given for all these securities, shares or bonds. Okay, here Government of India bond. It can be considered as risk-free security. Initial price is there. Dividends, market price is given. So initial price, purchasing price, and dividends from these instruments. Okay, dividend, this is can be taken as okay, interest. Okay, from interest from the government bond. Market price of the bond is 50, 60, 135, and 1005. Now, calculate the expected rate of return of each security using CAPM. Simple average return of its portfolio. Risk-free rate of return is given. Now, RF given, and they have asked us to compute the average return of the portfolio and expected return of the each security using CAPM. See, here only there is no clarity here. Okay, I told you interchangeably institute uses expected rate of return and required rate of return. Let's see what they have done here. If you notice, this is the total investment amount 25, 35, 45,000, 1,105. Okay, this is the initial investment amount outflow. Then there is dividend. Okay, and there is capital gains, which means, see here, what is capital gain? This is initial amount is 25, 50 is the current market price of the year, which means 25, 50 minus 25, 25 will be the capital gains. Are you understanding? This is nothing but P1 minus P0 plus D divided by P0 is total returns. So which means P1 here is 50, P1 minus P0, the opening balance, closing balance minus opening balance, closing amount minus opening amount, 50 minus 25. And you have dividend paid during the year, how much? 2 rupees. So 25 plus 2, 27 is the total either what is the benefit? Okay, total gains divided by return divided by the investment amount 25. So which means like this for every instrument, if you do total dividends plus total capital gains. Are you all understanding? From the total investment I am computing. So expected return of the market portfolio, what they have done. Okay, they have taken these individual securities as the representation of the market, and they have solved our expected return of the market RM using this method. Are you all comfortable? Okay, this is not ideal, but anyway, they have assumed that these are all the only portfolio available in the market, and they have computed individually what are all the returns they are giving market, and total they have found out. So total capital gains from all these four security 145. Total dividend from all these security 146, total return 146 plus 145 divided by 1105, the total amount invested. How much is the return? 26.33. Are you all understanding? So 26.33, they got it as a expected return on the market portfolio. Expected return on the market portfolio, which means RM they have found out as 26.33. This is what is the understanding. They have assumed RM to be 26.33. Now, when you have RM as 26.33, risk-free rate of return is given as 14%. So apply the CAPM formula. See, expected rate of return for each security using capital asset pricing. See here. Question asks us to find expected rate of return of the each security. Here, one point. Expected rate of return interchangeably. Actually speaking, they are asking us to compute required rate of return. Expected rate on return and required rate of return are not one and same. Required rate of return only is called as CAPM KE. KE, the RF plus beta into RM minus RF. This is called as required rate of return and not expected rate of return. Expected rate of return, mean return. Okay, X bar, mean return you compute. Okay, that is called as expected rate of return. Anyway, they mean required rate of return only. Next, simple average return of the portfolio. I'll come back to the second part later. First, for computing the CAPM of the KE of each of these security, you need RM. Why RF is given in the question? Okay, and you have RM minus RM. RM is not given. Now you first find out RM. Then, okay, you have beta of these securities, which means you can apply the CAPM, find out the required rate of return. Are you all understanding? So RF given, beta given. RM you have found out in the first step as 26.33. Apply that. Okay, use the RM, the 66 to 26.33. You apply the RM, CAPM formula and find out the KE. KE is nothing but required rate of return. That only they have used as expected rate of return. Don't get confused. Interchangeably, institute uses it. Okay. Next, second part of the question. What is the average return of the portfolio? Average return of the portfolio. Very simple. See here what they are asking. This is the required rate of return. For every year, you have got required rate of return. Now, what is the average rate of return of the entire portfolio? Okay, simple average. Okay, I will take the simple average. Here only you need to understand. I can also, okay, take beta as the measure here. I can find out the portfolio beta. There are two ways, okay, in which they have also agreed both the ways they have taken as a solution. Very simple. I'll explain both the ways what they have done. See, the 4 K is given, 4 required rate of return. Here only I'm little bit, okay, not okay with the institute solution. Anyway, these are not expected rate of return. These are not mean return. These are required rate of return. This is KE for each and every security. You cannot simply find out, okay, simple average of the KE, 22.86 plus 22.63 divided by 20 point, plus 1, 20, what is that? 22.86 plus 22.63 plus divided by 4. Like this, you cannot find out, okay, simple error 20.20 is not the correct way of finding the average return of the portfolio. Why? Because first of all, what they have done now, average return of the portfolio is nothing but simple average return of the individual securities expected return, mean return. But problem is, these are not at all mean return. Okay, how can you take simple average return, simple weight of the required rate of return and then call it as average return? That is not at all possible. But okay, but one assumption we can make that the share is trading at fair price, making the required rate of return equal to mean return or your expected rate of return. Are you all understanding? When the expected and required rate will be equal, when the share is trading at a fair price, when the share is trading at a fair price, under or over valuation, portfolio management, I have made some substantial discussion there. Are you all understanding? Okay, next question number 85. The following information is available in respect of security X. Now, equilibrium return, okay, then market return is given. 7% treasury bond trading at 140. Okay, covariance of market return, security return, coefficient of correlation. Okay, covariance of market return and security return. Okay, covariance of security and market. How much is that? 225. 225 is the covariance. Okay, coefficient of correlation given as 0.75. Agreed. Next, you are required to determine the standard deviation of market return and security return. Okay, your standard deviation of market return and security return is what we need to compute. For that, first, see, compute, okay, beta of the security X. For computing beta of the security X, now first you need to find out risk-free rate of return. First, risk-free rate of return. See here, risk-free, okay, security is given 7% treasury bond trading at 140, which means very simple. What is the coupon? 7% is the coupon rate. Coupon. Now, current yield you need to compute. Now, current yield is equal to what? Coupon divided by market price. Okay, I told you in the bond valuation chapter. Coupon divided by market price. 7% apply on the face value. This market price to apply 7% on face values by 140. Are you all understanding? 7 divided by 140, 5% is the current yield. Are you all understanding? This I call it as risk-free rate. Even though 7% is the bond coupon, the risk-free, okay, the bond coupon is how much? 7%. But the yield, the risk-free yield, the current risk-free rate of return is to be taken as 5%. The current risk-free rate is to be taken as 5%, implied from the price of the bond, Okay, assuming equilibrium return to be equal to CAPM return, then now they have taken. Now, this should have been the assumption in the previous question also. Are you understanding what I'm trying to say? Now, this is not correct in the sense equilibrium price cannot be CPC. See, they themselves agree that equilibrium price, which means the mean return, cannot be CAPM return. CAPM return means required rate of return, expected return, a mean return. Now, from this, what you can infer? See, mean return is something different, CAPM return is something different. They are saying that both are assumed to be same in this question. You're understanding like this? The previous question also mentioned should be there. Okay, anyway, if this is assumed, then 15% is equal to, this is what RF plus beta into RM minus RF. 15%, how they've given equilibrium return they have given. So 15% equilibrium return you knew. And to be equal to CAPM, now you will take CAPM, which means the share is trading at fair value. Equate it, 15% is equal to RF plus beta into RM minus RF. RF we found out. Okay, already we have the equilibrium return. Like this, if you substitute the formula, you will get the beta as 1. Are you all understanding? So beta, got it as 1. Now you have the beta. Now find out the standard deviation of the market. Very simple. So why we need beta? Very simple. Okay, beta, if you have the beta formula, you already know. Beta formula, okay, we have 6 formulas, 3 correlation related formulas, 3 regression based formula, correlation related formula. See, I have the covariance of, okay, X and market, which means security in market, divided by sigma square m sigma square. Okay, or this is nothing but variance of market. Variance of market. Okay, this I call it as sigma of m. Okay, sigma m square. I can say it as variance of market. Now, this is nothing but sigma m into sigma m. Okay, are you understanding now? If you solve this, okay, beta, you already know that it is 1, which means how much is the sigma m? Sigma m, okay, you got it as 15. Are you understanding? Because you know that beta is equal to 1 and covariance is equal to 225. So 1 is equal to 225 divided by, okay, sigma m square, correct? So sigma m square is what? Square root of 225. How much is the value? 15%. You are understanding? So 15% is the standard deviation of market return. Same way, standard deviation of security return you need to find out now. There is one more formula for beta. Same beta formula. Okay, this is one of the formula. Okay, based on correlation. Another formula based on correlation is nothing but sigma x, sigma of the security divided by sigma of the market into correlation of S and M. Okay, sigma x divided by sigma m into correlation of x and m, or sigma s divided by sigma m into correlation of s and m. S means security, m means market. Okay, correlation of s and m. This is the second formula for this. Anyway, there is another formula. Beta is equal to change in security return divided by change in market return. Okay, this is one more formula. So 3 formulas based on correlation. Anyway, regression, 3 more formulas with equation I told you. Okay, anyway, sigma is divided by sigma into correlation of S and M. If you solve this and equate it to 1, you will get sigma x individual security. Why? Correlation 0.75 given in the question, use it and find out at 20. Simple and straightforward question. But you need to remember both the formulas of the beta to comfortably solve this question. And assumption is also important. That's the only thing. Okay, next question. Question number 86. Okay, this is the question based on regression model. Okay, so question number 86. The following information are available with respect of Krishna Limited. Year given, Krishna Limited market data, return on government securities given, 4 years given. Compute the beta value of the Krishna Limited at the end of the 2023 and state your observation. Okay, this question is about beta, finding beta, but based on regression method. Now, one observation is that beta can be calculated. 6 formulas are there for beta. Change in the first 3 formulas, change in security return divided by change in market return. Okay, this is formula number 1. Okay, and we learned 2 more formula in the previous question. Okay, covariance of S and M divided by sigma m square and okay, sigma s by sigma m into correlation of S and M. These 3 formulas are correlation based formula. Regression based formula we are going to learn in this question. But point is, whether you solve under correlation method or regression method, the answer will be one and same. Answer will be one and same. Because the correlation method ultimately, okay, correlation is derived from the regression only. Okay, we find out the correlation. So regression method, we use this question. If this kind of question is asked, you should use the regression model. It's recommended to use, but I've seen where institute has given marks even. Okay, if we solve using correlation method and get the solution right. If the final solution, okay, is not matching with the solution, then they may not give the marks. But I have seen papers where they have given marks even for correlation method. Using correlation, sir, can I use correlation method in this question? Possible. Yes, possible. To compute correlation also is possible. Are you understanding? Very simple. Yeah, you hear share price is given. Okay, then dividend price is given. Market data is given. Can you find out covariance by sigma m square? Now, yes, you can find out. You find out the sigma market variance. Then you find out the Krishna Limited's variance. Okay, then you find out the covariance between the security and market. You can easily find out the beta. Anyway, so we will find out the beta using regression model. Correlation also you can apply. If you don't remember the formula, you can do that. Okay, but best case scenario is that you should by heart the formula. And this is very, very important for this attempt, I feel. Okay, see. Computation of beta. First step, before computing the beta, first step is the calculation of return. So, return computation, every year you need to do P1 minus P0 plus dividend. Here, dividend yield given. No, for Krishna Limited, dividend per share is given. So, P1 minus P0, then D1, which means first year dividend divided by P0 you should do. Are you all understanding here? Even though they have given 4 years data, ideally for okay the opening balance only they have given the 20 previous years closing balance. Are you all understanding? Which means the P1 okay minus P0. Now for P0 you need to take this 245. That's what they have given. See, year 2020, 21, 22, 3 years return only you can compute, but the first okay the starting point they have given the opening the 2020 value. Are you all understanding? So tell me, children, 253 P1 minus P0. Are you all listening? See here, P1 is 253 minus 245. Okay, this is what P1 minus P0 plus D1. Okay, here I have put like this. Here also, if you notice, the D0 is useless. Are you all understanding? Given to confuse you. D1 only you should take, because current year dividend, when you are finding the return for 2021-22, okay, you will consider that this year's dividend and not the previous year's dividend. Are you all understanding? So the P1 minus P0 plus D1, ideally the first year dividend, okay, divided by P0. If you do that, you will get the percentage. 12.24% is the return from the share, return for the Krishna Limited for 3 years, return earned by Krishna Limited for the past 3 years. Are you all understanding? Next, I'll calculate the return from the market index. First, I calculate the return from the individual security for the 3 years. Then I calculate return from the market for the 3 years. Agreed? Now, when I compute the market return, okay, I use the same index at the end of the year, index 1 minus index prevailing in the beginning of the year. Okay, this you do divided by I0 plus dividend yield, which means I can directly take as dividend yield. I'll tell you what it is. See, very simple. That there is difference between dividend per share and dividend yield. I told you dividend per share, dividend is okay applied on face value. Dividend in amount terms they have given here. Here they have given directly the dividend yield. Dividend yield, nothing but dividend. Okay, D1 by assume D1 by P0. This is called as dividend yield, which I have already computed. This formula only. See, I can rewrite it. P1 minus P0 divided by P0 plus D1 by P0 plus D1 by P0. This is nothing but dividend yield. Yield will be computed on market price P0. So dividend divided by yield is given as dividend yield. How much is the 4%? Nothing but dividend per share. Or per share means index dividend, total index of the dividend of the index divided by the price of the index, which means opening index. Are you all understanding? So you don't need to do this. You should not add it with the numerator. What you should do? I1 minus I0 divided by I0. This will give you the capital gains portion plus dividend yield and all. You can simply add it because it is already computed on market value. Are you all understanding? So which means 2000 average index year index at the end of the year 2130 minus 2030. This is not year, this is 2013 number index points. Okay, 2130 minus 2013 divided by index 0 2013 into 100. You got 5.81 plus 5%. Just to simply add the dividend yield, you will get the total return from the market. Year 1, year 2, year 3. Okay, this is how you found it. So first individual securities return, then total market return. Then you have compute beta using regression model. Regression formula. This is the regression formula. Okay, summation of sigma xy as n x bar y bar divided by sigma y square minus n y bar square. Okay, you need to by heart, no other way. Okay, I have discussed it to some extent detailed in the portfolio revision video. There you can, if you want, you can see, but no need to see in the last moment. Okay, you just need to have the formula. And this formula is very easy, even easier than correlation. I'll tell you the issue. Okay, see, this in an isolated manner, if you see, it may look difficult. But what you do, create this table. This is not difficult exercise. See what you do. You have 5 columns. Here, unlimited market index, then XY product of these returns. Then you have Y square. This is all the column you need to open. Very simple, I'll tell you. Year 2020, 21, 21, 22, 22, 23. Respective real, which means annual return, you just write it down. Krishna Limited, what are all the annual limited? You found out in the working note number 1. First step, you found out this 12.24, 32 point, 16.13, like this for 3 years market return and security return. Just copy it down. Are you all understanding? The next column. Okay, what you do? Simply multiply this, find out the product of these two returns. XY. XY means X into Y. Just to find out the product of these two returns, which means 12.24 into 10.81 in terms of total. Okay, which is okay. It is assumed that it is percentage, 12.24%, 12.24 into 10.81. Simply do that, you will get 132.31. Are you all understanding? There is relevance for this. Okay, this number is important. The sigma of this xy and the sigma of this xy y square we will consider. Are you all understanding? Next column xy, you will do the product of the, so every year you will find the product of the return of the security into market return. Then you have y square. The y square, okay, I'll tell you what this xy, and you just remember. See, the XY beta is nothing but change in security return divided by change in market return, which means for every 1% change in index, what is the impact in the shares return or securities return? This is what is beta. Now, the X and Y is nothing but X axis and Y axis. I'll tell you how it is. See, very simple. In the X axis, what you get generally, okay, see, Y axis, you get the influenced variable. Y axis, you get as influenced variable. Are you all understanding? Now, see here, this is x-axis, this is y-axis. Okay, how much is the change in market? If the market changes by 1%, how much is the security changes? How much is the security changes? This is what you need to compute, correct? Generally, in this question, what happens? Okay, in this question, xy they have taken as xs. Okay, in this question, they have taken Krishna Limited as x and market return as y. Market return as y. This question, what they have done, they have taken the security value as x and market as y. Okay, I'll tell you what is the issue with this. If you take like this, okay, you're not able to connect with our discussion. Anyway, I'll tell you what it is. X axis should be written of the market. Okay, y axis should be written of security or x. Okay, now what happens? This is written of market will be the x axis, but written of the security, any security will be the y. In this case, it is Krishna Limited or Krishna Limited. Okay, there is one JK Limited in your study mat. I think that question is also there. See what happened. Really speaking, here they have found out xy, y square. Here y square means market variance. This I have found out the market variance, no issue. Here in the beta formula, if you notice, okay, summation of xy, this not an issue. X be it x as security, y as market, that is not an issue, or y as market, y x as security, not an issue. Minus n x bar y bar, that is not no issue. Here also no issue because you are multiplying anyway, you will get the same value. Okay, here the denominator, when you see the summation of y square here, they have given this, okay, this x or y, it is a debate. See, this should have been x square. The x square, if it is given, now you can easily remember that it is x-axis. X-axis security return will be there. Why I am saying this? Sometimes you may commit mistake. What you are doing, it is very important that you need to understand what you are taking here. This is market variance square, market variance, market variance. Are you all understanding? This is the okay. This is the market return square. Market return square. The y square is you are taking this is index square return square 10.81 into 10.81. This is very important. Okay, this you have to take in the denominator. Okay, if you represent x this you should put as x. What you are assuming is very important. So total of it is summation of y square minus n y bar square. N y bar square. Very simple. Denominator only market related data. Market related data. It may be x in case institute one question they have taken x, other question they have taken y. Anyway, it is there in one of the questions, security analysis, where they have used the regression based model and to solve the big question. Okay, there is one question in that they have taken x. That is correct. This is not correct. That is what I feel. Okay, y is okay. Any number x, y doesn't matter. But problem is that okay, you need to understand the y means market return square. That is what you need to understand. Okay, so summation of y square, the total of it 665 minus 43 minus n y bar square. Now you have found out xy, total summation of xy, summation of y square. Okay, if you prepare this column, you will find all these values, summation of xy. Okay, and now x bar, y bar, you need to find out mean return. That is also very simple. X, you have this total of the x 60.78 divided by 3. 3 observations, 3 years data, simple average, you will get, okay, this is x bar, y bar. In this case, in your example, this is x bar. In this question, it is y bar, y 43.93, 3 years return divided by 3, y bar. Are you all understanding? So all the data you have, summation of xy, you just put it this number, minus n x bar, y bar, n is 3, 3 into x bar is how much? Okay, 20.26, here I have calculated. Can you see this? Okay. Anyway, they have given okay 3 into 20.36, yes, n x bar, y bar 14.64 divided by 665.43, which is nothing but sigma y square minus n into okay y bar square 14.64 square. Solve it, you will get the beta as 1.897. Are you understanding? Now the observation, okay, you have got the beta. use the beta, and again, this is a required rate of return. This is required rate of return. Wherever you apply CAPM, they have applied CAPM, risk-free, RF plus, beta into RM minus, RF, they got 15.22. Okay, in this question, they've given risk-free rate separately in the question. Yes, risk-free rate of return, they've given for the 3 years, 6%, 6%, 6%. Okay, 1 year they've given us 7%, not an issue. Why? Because the issue under discussion, the 3 years, not 21, 22, 22, 23. Okay, then 2021, 21, 22, and 22, 23. The 3 years risk-free rate of return 6, 6, and 6%. Apply the RF there, RF plus beta into RM minus RF, you will get that. This is the, what is that? Required rate of return. This is required rate of return. And I already discussed what is the, how to take buy or sell call based on comparison with the required rate of return and expected return. If required rate of return, which means very simple, you require how much? 15.12% as per CAPM. KE, which is required rate of return is 15.2%. Actual return is 12.2%. Requirement satisfied or not satisfied? The shareholders required is not satisfied, hence sell the security. Are you all understanding? If it is satisfied, it is undervalued. If the requirement is over-satisfied, under-satisfied, see. If the requirement is over-satisfied, okay, which means security is satisfying your requirement, it is undervalued and sell the security. The two numbers, all the details I'm not going to discuss, just to briefly understand. Next, 920, 2019-20, what is happening? Required rate of return is 25.6. What is the security is giving? 32.41, which is over-satisfying, which means buy the security. Are you all understanding? Undervalued and buy the security. Next, 26.47 required, 16.13, sell the security. Question number 87. AS portfolio having following features. Okay, security given, beta given, random error, weight given. Okay, Sharpe single index model. Okay, regarding the portfolio standard deviation, I think you are required to find out the portfolio. You are required to find out the portfolio variance. Portfolio variance, it should have been portfolio variance. There is portfolio risk. This should have been portfolio risk. And in Sharpe single index model, I told you risk is measured in terms of variance and not standard deviation. It is very obvious. In terms of variance only, it is measured and not based on standard deviation. Okay, even if question mentions wrongly, okay, they have given the standard deviation. Instead of standard deviation square, they have given simply the risk. Now they have given risk. Now what is the understanding? In Jan 26 paper, they have given like this. Okay, they have given one column, they simply wrote it as risk. Now, some students had the doubt, the risk means it is in terms of standard deviation or how the variance or risk square. Okay, the sigma square should be there. Simply they have put risk. Don't worry. Okay, we are discussing Sharpe single index model. In Sharpe single index model, risk itself is measured in terms of variance, not in terms of standard deviation. Only if specifically question mentions your standard deviation, you should again square root and find out the standard deviation. All these things I have discussed. Anyway, now security given, beta given, random error, weight is given. How to find out the portfolio risk based on the Sharpe single index model. Also, they've given the standard deviation of the market index. They have specifically given standard deviation. Okay, so variance is 18 into 18%. That is what the variance will be. Okay, standard deviation they have specifically given. Shall we move on to the next stage? See. Now, beta of the portfolio solution. See here, beta of the portfolio. Very simple. Weighted average beta of the individual securities inside of the portfolio. First step is to compute portfolio beta. Why I told you? See what happens. Variance of the security. See portfolio risk. What is a portfolio risk as per Sharpe model? You need to segregate systematic and unsystematic risk. When I compute the portfolio risk, okay, I will get portfolio beta square. So portfolio beta square, okay, or portfolio beta square, beta of the portfolio square into sigma m square. This I call it as systematic risk. This I call it as systematic risk plus unsystematic risk I will compute. Okay, portfolio beta into error terms square of the error terms. That also weighted average error we need to find out. Okay, that I will tell you. Here what they have done, very simple. So first part, they have just calculated beta of the portfolio. Beta of the portfolio is what? Weighted average beta of the individual security. So beta 1.5 into weight of this 1.5, which means 1.5 into 0.25. But sorry, this is 1.6. Make it as 1.6. Here solution 1.6 is given. At 1.5, there is a mistake. Question or solution, I don't know. It should be either 1.5 or 1.6. You can see. So 1.6 into 0.25, weight of the security. Then you take beta of the M security, 1.15 into beta, weight of security M into this is plus, okay, beta of the security N into weight of security N plus beta of the security K into beta of the security, weight of the security K. If you add it, simply how much you will get? Okay, this is the Total 1.295. This is the portfolio beta. Are you understanding? Now the risk of the portfolio as per Sharpe single index. Okay, Sharpe index model is how much? Beta square. This is beta the portfolio square. I told you now 1.295 square into sigma m square. M square. Now the market standard deviation is 18. So standard deviation square na 18 square. Are you all understanding? Till now this is systematic risk. This is nothing but systematic risk. Now we go move on to the unsystematic risk. Unsystematic risk also, what we do, error is given, random error is 7 square. So error square, okay, EI square, what do you do? Respective weight square, weight 1 square, EI square, plus weight 2 square, EI square. Like this you will find out, okay, this is how you will find out the weighted average error. Okay, weighted average error tabla you need to find out now. So 0.25 square into 7 square plus 0.3 square into 11 square. Okay, this is nothing but random error of okay. So this is they have given not square. This is sigma EI. Sigma EI is not 1. It is EI. So sigma EI given, which means you square it up. Okay, and you will find out the unsystematic risk. This total I call it as unsystematic risk. Unsystematic risk. This also unsystematic in terms of variance. Unsystematic variance. Okay, this is what you got total. Okay, this is systematic portion. Balance is unsystematic portion. 543. Yeah. Okay, yes, sir. Balance is for unsystematic portion. If you square root it, okay, square root now 561.115, the square root, you get 23.69%. Are you all understanding the solution? Next, take question number 43. Expected returns on two stocks for particular market returns are given in the following table. Market return, aggressive and first, you market return 7%. Very simple. Aggressive stock. If market return is 7%, na aggressive stock na. So market falls and comes down by 7%. Okay, aggressive returns even further falls and comes down to 4%. Okay, defensive stock still gives 9% return. Market okay goes up to 25%. Now aggressive stock even goes further up for 40%. Defensive stock okay comes down, which means it will give you normal return of 18%. Are you all comfortable? Now, you are required to, this is two situation given and behavior of aggressive and defensive stock given. The one more question is there, I think in the past examination question. Boom, recession, okay, boom and recession, economic situation will be given like this given. Two data will be given. You are required to calculate first step of beta. Now you need to be careful. What you need to apply, what formula you need to apply. Out of the 6 formulas, you need to apply the first formula. Here only you will need to apply the first formula. No other, nowhere else you need to apply the, you will apply the generally the first form. Here, what is the formula? Change in security return divided by change in market return. I told now one of the formula. This formula you need to apply, my dear. So what you should do? Beta. Change in security return. Very simple. Aggressive stock to defensive stock. Aggressive stock. Assume this is stock 1. This is stock 2. Assume this is Reliance company. This is okay. Aggressive na. This is Tata. Assume this is Tata. Now what happens? Change in security return. 40 minus 4% divided by change in market return. This will be same under both the situation. For defensive stock also, denominator will be same. Change in security return will be 40 minus 1. Change in security will change. Change in market return will not change. 25 will say 18. So first case, 36 by 18. Okay, the beta of stock A will be 2. Defensive, aggressive stock will be 2. Defensive stock will be 0.5. Which means 80 minus 9 by 18. Okay, it is 0.5. Are you all understanding? Beta computation. First formula use and find out the beta. Next, we need to find out okay, expected returns of the two stocks. Here, expected return of the stock is the market is equally likely to be 7% or 25%. Okay, they are saying that the probability of market, I don't know what will happen. Okay, next year, market return may be 7% or 25%. But on an average, I say that I gave a probability of 0.5, 0.5. Are you all understanding? Why equally likely, which means probability 0.5, 0.5. If you apply that, you will get the expected returns. Aggressive stock 0.5 into 4% plus 0.5 minus 40%. Are you all understanding? This you will get. How much is the percentage? Okay. Aggressive stock, what will happen? Okay, this is 0.5. Okay. This is 0.5 minus 40 into 40, wrongly given. Minus 0.5 into 18%. So 0.5 into 4%, 2% plus 20%, 22% and 13.15%. Are you all understanding? Next, expected return of the market portfolio. Market portfolio, we know that 7%, it may be 25%. Portfolio return, weighted average, what is that? Weighted average return of the individual securities inside the portfolio. So 0.5 into 7%, 0.5 into 25%. Market, on an average, market may give what? If you apply the same probability of 0.5, you will get 16% as the portfolio return. Are you all understanding now? Market risk premium. Market risk premium is based on SML premium. Okay, market risk premium is nothing but RM minus RF. This I call it as market risk premium. Now, what is the RM? 16%, you know that. 16% is the market risk premium. Agreed. If see, the expected return of the market portfolio, they've asked. Yes, this is the securities. See, okay. See what they have asked. One second. The C part, okay. What happened in the C part? They have not asked the expected return of the market portfolio alone. They have really asked the security market line. Security market line. Okay, I did not read the question initially. The security market line, they have asked a risk-free rate given and the market rate equally likely to be 7 or 25%. Are you understanding? So what they have given? First, they have given the risk-free rate. They have given that it will be equally likely. I don't know what will be the RM. The RM should be average RM. That can be either 7% or 25% equally weighted. Which means on an average, what is the RM? RM 0.5 into 7% plus 0.5 into 25%. That you will find out. This is RF plus beta into RM minus RF. You will apply the RM. Are you listening? So what will you do? You will apply the formula 0.5 into 7%, 0.5 into this is the RM to be taken. So RM, what is to be taken? 16% is to be taken. Now apply the formula. I know RM. I know RF of 7.5%. What is the market risk premium? RM minus RF is 8.5%. This you agree? Are you all understanding? So I know that RM minus RF, I know 8.5%. I know RF. Now, SML equation, security market line when you want to draw. What is that? This is nothing but risk-free rate of return, which means what do you say? The SML, okay, line, assume this is RF. It looks like this. This is RF now. It will be looking like this. Okay. The RM minus RF. This is RF till now. Okay. This point, the RM minus RF will be there. Okay. RM minus RF. Now, I don't want to get deep into this discussion. See, very simple. The security market line, you will have slope and you will have interest. Okay. This is the intercept will be the RF, which means here point of interception will be RF, and then the slope will be there. RM minus the beta times the RM minus RF if you want to consider. Beta will be the slope. Are you all understanding? So beta, I will keep it as blank. Based on the beta, I will find out where exactly it falls. Are you all understanding? In the line, where exactly it falls, I need do beta. Okay, assume the beta is this much now. Beta if it is this much. Okay, I'll get K as this much. Are you all understanding what I'm saying? So it depends on beta. So beta, I'll keep it as blank because this is variable now. This is not constant. This is variable. It may change. So constant, this is 7.5% plus beta times the RM minus RF. RM minus RF is called as market risk premium. So whenever they ask a security market line, how you should write now? RF, you write the value. Value will be given, you write it. Plus beta, beta you leave as such. Why you don't know? It is the slope. So beta into RM minus RF. RM minus RF also you write the value. This will be the SML line. Or you're understanding SML equation. 7.5% plus beta times the 8.5%. Okay. Now, last part of the solution, what they're asking, the alphas of the two stocks. See, here only I have little bit of either here there is some level of ambiguity. Why I'll tell you. The alpha, see, alpha, here really I believe that they're asking Jensen's alpha. Jensen's alpha they're asking because the SML they've asked in the previous part. So SML now, this is nothing but CAPM, which is required rate of return. Okay? Required rate of return. Which means in this question, if you see, the expected rate of return we calculated in the first segment, 22%, 13.5%. Are you all understanding what I'm trying to say? Oh, the Jensen's alpha, okay, expected return minus required rate of return, that is what I believe they're asking. But again, anyway, they've solved institute answer they've given using characteristic market line. Alpha plus beta and the what is say the error term now you have the Sharpe single index model equation. Okay, characteristic market line. I call it as character. This SML is security market line, which is a graphical representative CAPM. That characteristic market line, the CML, I call it as okay graphical representation of what is a Sharpe single index model. Sharpe single index model. Now this alpha they have computed using characteristic market line. Are you understanding? Alpha, see this they have taken average RM. That is nothing but expected return is equal to, that actually is not expected return, required rate of return. But here also, if you see 22%, they have equated. That is actually required rate of return as per Sharpe model. What is that expected return? Alpha plus, okay, beta, okay, beta into what? The 16%, if you see in the stock. What is the 16%? Tell me, children. Beta times the RM bar. Beta times the RM bar. This, see, the RM bar, na, expected return of the market. Expected return of the market. This is characteristic market line, the formula for characteristic market line. Okay. What they have done, they have found out the two securities are there. They have plotted these securities. So they have done like this. Expected return 22% is equal to, okay, alpha, which means I don't know the alpha of A. So I simply write alpha of A plus 2 into RM bar. RM bar is average return of the market, 16%. 2 into 16%, 32%. Are you all understanding? Beta of the A into RM bar. Next, they have equated 13.5%. Okay, this is again what do you say? The defensive stock. Expected return of the defensive stock. How much is that? On an average, 13.5%. You equated alpha of B plus, what is that? 0.5, beta of B, 0.5 into 16 or 8%. Like this, they have put. Are you all understanding what they have done? They have got the two equations. Using these two equations, they have found out the alpha, A of alpha is -5. Alpha can also be negative. I told you. Alpha of B is, this is B, alpha of B is 5.5%. Like this, they have found out the alpha after finding two equations. A characteristic equation they have found. Thereafter, okay, they have solved the equation and found out the alpha. But really speaking, okay, here I believe since the SML return is given, we should consider the Jensen's alpha. Both are different. Okay, Jensen's alpha, I told you, this is nothing but the expected return minus required rate of return. Are you all understanding? So expected return minus required rate of return. Here, what is the required rate of return? Here, expected rate of return is 22 and 13.5%. Required rate of return, that is what you have found out. SML return, yes, SML return you will apply 7.5% plus beta 2 and 0.5 you will substitute and find out the required rate of return, then subtract it, you will get the Jensen's alpha. Are you all clear with this? Anyway, this is, I believe that that should have been the solution. Anyway, for this, if question asked, what do you do? If this question is asked, you should do using this method, because Institute has given this solution. Okay, for us, Institute is the roadmap. We need marks, so we need to solve like this. Okay, shall I proceed? Now, next, take question number 88. Question number 88. The rates of return on the security of company X and market portfolio for 10 periods are given below. Okay. Now, period security return and market return. Okay, question number 88 is simple and straightforward. What is the beta of security? Just a practice given for practice this question. Okay, what is the beta of the security? Now, very simple, my friends. What you should do? You should find, is this clear? In the last column is clear. Second, just the screen. What you should do? Very simple. 10 years given, just like you find out standard deviation, you find, okay, open the column, period, security, okay, the return of the security, return of the market, RM minus RX bar, okay, the security bar, which means X minus X bar. This is Y minus Y bar, RM minus RM bar. Y market risk also we need, okay. Then product of the deviation, just like you find out the covariance. Are you all understanding? Now, for finding beta, which formula you will use? If these years data given, which formula? Covariance of security and market divided by sigma S and sigma M. This formula you will use. Are you all understanding, my dear friends? So what you should do? You should use the second formula and find out the beta. Now, covariance already I discussed in one of the questions, same for a product of the deviation. Then there is RM minus RM square. We need here, okay, sorry, sigma S into sigma M square. Sorry, for sigma M square you will use. Why? Because that is, see, that formula is one of the formula sigma S by sigma M into correlation of S and M. Here also, if you see, this is denominator sigma M square. Covariance means denominator, what will be the formula? Sigma M square. So sigma M square, to find out sigma M they have found. Now, you don't need sigma S. Security risk you need, you don't need. That's why you don't have RX minus RX bar, RX minus RX bar the whole square. You don't need. Why? You don't need to find out the standard deviation of the security. You only need to find out the standard deviation of the market. Standard deviation of the market. Oh, okay. Solve it. You will find the sigma square M. They have found out the variance of the market. Then covariance is this much. Beta is equal to covariance divided by 35.7 divided by 70.6. Okay, this if you do, you'll get 0.505 as beta. You are understanding the first stage. Next, characteristic line. Characteristic line is nothing but, okay, the expected return, okay, which is nothing, expected return of the security, RX bar, okay, RX bar. What is the, is very important, because expected return or mean return of the security is equal to, what you should do? RX bar is equal to alpha plus beta into RM bar. This beta into beta times the RM bar. Just now we solved now. Here you have alpha bar. You don't need, you don't know alpha bar. See, you know beta, but do you know alpha? You don't know alpha. You will find out the alpha, okay, as a balancing number. Are you all understanding? Which means RX you substitute as 15, expected return of the security is equal to alpha plus beta you just now found out na 0.505 into RM bar. Market average return of the market, RM bar how much? 12. So substitute it, you will find out the alpha. Are you all understanding? Now if you put it in the characteristic market line, in the characteristic market line, which you should leave blank, RM you should leave it as blank. Are you all understanding? Very simple. Okay, what you should write now, alpha characteristic market line na x is equal to alpha na 8.94 plus 0.505 into RM. Are you all understanding what I am trying to say? It is line na, okay, it is characteristic market is nothing but line. If you are saying this is mx plus c, so there will be constant and, okay, the intercept and slope, this alpha is nothing but intercepts. Alpha is nothing but the intercept, the point where the line intercept the y-axis, okay, or it may also intercept the x-axis if the alpha is negative. Anyway, next, the 0.505 RM, 0.505 RM, this is 0.505 is nothing but beta, okay, RM to RM, where RM, return of the market, okay, will be variable. So this is the characteristic market line. Characteristic market line for the security here they have given, okay, 8.94 plus 0.505 the RM. Okay, now in the SML equation, now what is the difference now? SML equation you will keep beta as the variable there, so you keep beta simply as beta, you don't substitute, write any number for beta. So SML equation, what is the SML equation? Okay, RF plus beta, RF you will write it, beta you keep it as beta into RM. Are you all understanding? Beta into RM minus RF, market risk premium. Here in case of CML, characteristic market line, what you do? Alpha you write it down, then beta also you write it 0.505 into RM. RM simply you write it as RM. Are you all understanding? Okay. Now, question number 89. This question is about what do you say? This question is about we have arbitrage pricing theory, concept called as arbitrage pricing theory. Shall we discuss this? Mr. Tamarind intends to invest in equity. Intends to invest in equity shares of a company, the value of which depends upon various parameters as mentioned. Okay, now this is very, very important. Two questions which we are going to discuss. Okay, all the questions with regards to the arbitrage pricing theory overall I believe is important for this attempt. Okay, go through. Anyway, this two questions I'll discuss further, you can manage. Okay, now factor beta given, expected value in percentage, actual value. Now, various factors given. This arbitrage pricing theory is also called as factor beta theory. Okay, this is nothing but the formula, just like you have the required rate of return as per arbitrage pricing theory is RF. Okay, you have lambda 0, which is nothing but risk-free rate of return, lambda 0 plus beta 1, lambda 1, okay, plus beta 2, lambda 2, okay, plus beta 3, lambda 3. Like this, it will continue. Are you understanding? The beta is nothing but beta, okay, factor beta. For each factor, what is the beta? And this is factor risk premium. Factor risk premium. For each factor, what is the premium? Are you understanding? Why? Because in case of RM minus RF, where we did in CAPM, market was the only determinant, okay, which means market was the only factor which we considered, which means a beta, the denominator change in security return divided by change in market return. Market is the only factor which will influence the security return. Are you all understanding? That is the assumption of the other models, okay, Sharpe model. Arbitrage pricing theory, Ross came up with this theory that Not only market will influence, yeah, when COVID came, COVID is okay, the geopolitical issue, Russia-Ukraine war, okay, there are so many factors, GDP, inflation data, everything, macroeconomic factor, each and every macroeconomic factor will impact the, okay, security, which means actually speaking, the macroeconomic factor only impacts the market. Then market in turns impacts the security, and market is not the only reason. Market also may impact. That is what given. Stock market is one of the reason why the individual security varies, but other than that, there are so many macroeconomic factors also. That is why I call it as this model as factor beta model. Are you all understanding? This is nothing but RF. This is beta 1, lambda 1. Okay, for each, this RM minus RF, the lambdas are nothing but RM minus RF, which we used to do in, this is not same. This I call it as, this is market risk premium is RM minus RF. Okay, lambda 1, if assume the GNP premium you want, means this is nothing but, okay, how much you extra premium you pay for the this factor alone, GNP factor alone or inflation factor alone, that we will consider as lambda 1. Are you understanding? So beta 1, lambda 1, beta 2, lambda 2. Like this you will consider. How many factors given now? Respective, if 3 factors are given now, you go up to 3. Otherwise, it go up to 5 or 6, whatever given. Okay, here 1, 2, 3, 4, stock market index and industrial production index. Okay, 4, 1, 2, 3, 4, 5 data given. So lambda 5, beta 5, lambda 5. That is what they say. The beta given, expected value and actual value given. What is this expected value? What is this actual value? I'll tell you. Okay, if the risk-free rate of return is 9.25, this is nothing but lambda 0. Lambda 0. How much is the return of the share under arbitrage pricing theory? Very good. So how much is the required rate of return under arbitrage pricing theory? Now, very simple. See what happens. Expected return is this much. Actual return is this much. Okay, which means it is expected to give this much, actual is give this much. Now I don't require any premium in this regard, correct? So return of the stock under APT, required rate of return under stock under APT. Now what I will do, GNP factor, okay, actual return, the difference between actual return and the expected return is there now. This I call it as, okay, the premium. This I call it as the premium. Are you all understanding what I say? Expected return is a mean return, actual return. This extra I will require to compensate for the average return, which means here 7.7 and 7.5. What is the difference? There is no difference. Okay, there is no difference. Okay, am I audible? Suddenly the power went off. Okay, see the difference between the expected value and annual value, expected value and average value, actual expected and actual value can be taken as what? Can be taken as the lambda 1, lambda 2. Like this, you will find the difference is lambda. Then, okay, the differential amount you multiply with beta, respective beta for the factor beta, which means here for this GNP factor beta is 1.2. For this factor, the beta is 1.75, and the differential amount is lambda. Multiply this, okay, you will get the value. Are you all understanding here? There is incomplete. I'll just finish it up. See here, can you? Okay, actually speaking, the table is incomplete. Okay, you can go through. This question is available in your, I think in your study mat, or if you have any author's question bank, you will see this question. Okay, it's a past examination question only. You can see the question. I don't remember. I think May 20, not 20. November 22 or May 23, I don't remember. Okay, at least 3-4 years back, it was asked in examination. Okay, I believe you can go through, or if you have any other author's question bank, any famous question bank, you can go through the question. This question, okay, is there. Solution you can find differential amount into beta. You will find out now. Okay, this return of stock under APT now. This you will add. I think this will. You should risk-free rate of return will be there. This is the total amount. Very simple, yeah. You have beta now. This is factor beta. Multiply with the differential amount. This is C. This is beta 1, lambda 1. How much is the amount? Difference amount into beta. So this is beta 1, lambda 1. This is beta 2, lambda 2. Beta into lambda. Anyway, this is 0, 0. So done. Beta 2, lambda 3, beta 4, lambda 4. Like this, you will find out. So you will find out all the amount total of these 5 data. Then you add risk-free rate of return. Where is the risk-free rate of return given in the question? Yes, 9.25%. Add it, you will get the total required rate of return. Are you all understanding? Okay, this is all about question number 89. Shall we move on? Okay. Question number 90. Mr. Nirmal Kumar has categorized all the available stock in the market into following types. Okay, this is also APT related question. Small cap growth stock, small cap value, large cap growth, and large cap value. Mr. Nirmal Kumar also estimated the weights of the above categories of stocks in the market index. Further, the sensitivity of the returns of these categories of stocks to be to the three important factors are estimated to be factor 1 beta given, factor 2 beta given, and factor 3 beta given. Okay, factor 1 is normal beta, then there is book price, then there is inflation. Okay. Okay. Weight in the market index is given. Small cap growth, small cap value fund, large cap fund, growth fund, and large cap value risk premium separately given for factor 1. Okay, this is nothing but your beta 1, lambda 1. This lambda 1 is 6.85, lambda 2 this much, and lambda 3 this much. Are you understanding? Risk free rate is given, treasury bond return given as 4.5%. What is required? One by one, we will try to find out. Using arbitrage pricing theory, determine the expected return on the market index. Expected return on the market index. Okay. Now, see here, expected return on the market index. Now, one by one, we need to find out. See what they have done initially for each fund, which means the small cap growth fund. Let's take small cap growth fund for example. Okay. The what they have done now, first individually you calculate the return, expected return for this four. It's like to be assumed as securities inside the market, which means the four types of funds available in the market. So what you do, small cap growth, let's take small cap growth for example. What do you do? RF, okay, which is lambda 0 plus, okay, the factor 1 beta 0.80 and risk premium. Are you all understanding? This is nothing but, okay, beta 1 and this is lambda 1. Okay, plus this is, okay, into next beta 2 into lambda 2. Are you all understanding? Beta 3 into lambda 3. Like this, you will substitute each and every beta and lambda for each and every fund. So small cap growth fund is there, then small cap value fund. Like this, you will find out. So I got four numbers: 5.9925. 8.8525, 8.478, and 7.535. Now expected return on market index. If okay, 25% of your money is invested into this stock and 25% is money invested into this stock. Like this, okay. If this the market, how much is the probability given? Weight given? Yes, 25%, 10%. See here, 25%, 10%, 50%, and 15%. Like this, weight is allocated. Okay. What they're asking, using the determine the expected return on the market index. So what is the expected return from the market index? They are asking. Okay, how you should find out now? See, if market weight and see here they have given the can you see? Yes, weight in the market index. This fund has a 25% weight in the market, which means what is the overall average market return? See, 0.25 into the first one, 5.9925. Now you got the small cap growth. How much is the allocation? So weight 1 into return of small cap growth fund. Then weight 2 into return of the second fund. Weight 3 in the return of the third fund. Like this, if you get find out, you get the weighted average return from the market. Next. Method 2, okay, expected return on the market index, you can also find it this way. Anyway, this is cumbersome process. This is easy, you can note this. Okay, next. Using CAPM, determine the expected on the market index, expected return on the market index. Okay, using CAPM approach. Now, first approach using arbitrage pricing theory. Next, they are also mixing it with capital asset pricing theory. Other RF plus beta into RM minus RF. RF will be same as R lambda 0. That is 4.5. Okay, here beta. Now, which beta you should take? Question arises. Are you all understanding? Now we computed 3 factor beta power. This one factor 2, factor 3. Now factor 1 beta they again for this is for market. This you need to understand. Are you all understanding? Which means the 6.85 is the market risk premium. This is for market. That is the way you need to understand. And other factors of book price and inflation. If this is for market, now this okay factor. See here they have given factor 1 beta. Here they have factor 2 book price. Actually, the beta cannot be factor on its own. It really means that okay beta factor 1 beta for market. We can assume that it is for market. Like beta cannot be just for beta. There is no factor for beta. Okay. Factor 1 beta, factor 2 beta. This is also called as beta. This 1.39 is also called as factor 2 beta. This is factor 3 beta. Are you all understanding? So what I say is that this we can assume as market. Market is one of the factors. So this market factor beta is there now. Original beta, we can take it. So CAPM only this you will consider. Are you all understanding? So this only you will consider for each stock 0.8. Like this, you will consider. Last risk premium. This is nothing but market risk premium. Market risk. So RM minus RF you will consider it to be 6.85%. Substitute RF 4.5. Beta individually you apply. Okay, market risk premium 6.85. You find out the CAPM approach. Okay, expected return. Small cap. This is the KE. This is the K4. KEs we have. RF plus beta is 6.85 into RM. This is RM minus RF into this respective beta. Like this, you can find out. And the last step, expected return on market index, same drill. Okay, but we get the different KE. Okay, under CAPM. Under APT, we got different KE. Then expected return on the market index 0.25, weight of the small cap growth into KE of the small cap growth. Like this, you will find the expected return. Here also, there is an ambiguity. The point is that the expected return you call, see, this is required rate of return. Again and again, they mix up the concept of expected return and required rate of return. Anyways, this you always assume that it is trading at fair price. The security is trading at, or the fund is trading at fair price. But it need not be. Okay, it should be very clear. Anyway, they've given example. And C part, what is they are asking? C part, what is they are asking in the C part? Mr. Nirmal Kaul wants to construct a portfolio conducting only the small cap value and large cap. So it wants to construct a portfolio having small cap value and large cap growth, only 2 stocks. If the target beta for the desired portfolio is 1, determine the composition of its portfolio. Very simple. Target beta for the desired portfolio, which means portfolio beta. You construct a portfolio having a weight. What is the weight of this? Okay. Determine the composition of its portfolio, which means composition only they are asking. So weight only they are asking ultimately. What you should do? Okay, weighted average beta, portfolio beta is 1 they have given. And they only want to construct small cap value. Okay, small cap value fund and large cap growth fund. Only these 2 funds they want to include. These 2 stocks they want to include. So now, what do you do? Very simple. Okay, let's assume that Mr. X1 percentage. This is nothing but, okay, the weight of first fund, which is small cap value fund. And X2 percentage, proportion of the large cap growth fund in the portfolio. Are you all understanding? This is weight of security X, weight of security Y. Now you construct a portfolio in such a way that weighted average beta will become 1. Are you all understanding? So which means X1, what is the beta of large cap, small cap value? Let's see, small cap value. What is the... Yes, small cap value is given. See here, small cap value. Beta is how much? See, here you need to beta is how much? 0.9. Okay, that they have given in 0.9. And the what is that? Beta of large cap growth fund is 1.165. Is it 1.165 of large cap growth fund? 1.165. Are you all understanding? Here the beta are these 2 factors are irrelevant. Yeah, based on, okay, the CAPM only you are computing based on CAPM. Now see, you equate it to 1, which means first equation 0.9x plus 1.165, 1 minus x is equal to 1. If you solve this equation, you will get x1 as how much percentage? 0.377 percentage. X2 as 62.3 percentage, which means, see, okay, x1 as 62.3%, x2 as 37.7 percentage. In this proportion, you need to invest in these 2 securities. Are you all understanding? Clear enough? Straightforward. Next, take question number 91. The following data on 5 mutual funds given, fund given, return, standard deviation, beta. You are required to compute reward to volatility ratio and rank these portfolios using Sharpe method, Treynor method, assuming risk-free rate is 6. Reward to volatility ratio is nothing but Treynor ratio. Okay, reward to volatility ratio is nothing but Treynor ratio. Can you see this? Reward to volatility. Reward to variability ratio is Sharpe ratio, is also called as Sharpe ratio. Reward to volatility ratio is also called as Treynor ratio. Very simple. The formula, Sharpe ratio formula, this is, okay, portfolio performance evaluation. There, this topic will come interchangeably used in mutual fund. We cover in our regular lecture, we cover in mutual fund. Okay, reward to variability ratio is nothing but, okay, the risk of the portfolio minus risk-free rate of return divided by sigma of the portfolio. Are you all understanding? So this is how you compute. Next, okay, this is Sharpe ratio. Treynor ratio uses beta as a measure of risk instead of the standard deviation. So the return of the portfolio minus RF. Okay, this is numerator is nothing but extra return earned over and above the risk-free rate of return, which means risk-free rate of return is 7%. My portfolio return is 16%. Now, okay, what is the extra return? How much? 16 minus 7, 9% return, which means for 9% return, for every 1% risk undertaken, how much is the extra return be earning from this portfolio? This is what is the Sharpe ratio and Treynor ratio. But Sharpe ratio measures the denominator risk as in terms of standard deviation. Okay. But whereas Treynor ratio measures this in terms of beta, Now, Sharpe single index model, you have beta. Okay, don't get confused with the Sharpe ratio. This is different. Sharpe single index model is different. Okay, don't get confused. Treynor ratio uses beta. Sharpe ratio uses sigma. Okay, a standard deviation. Okay, now you solve this, you will get ranking based on Sharpe and what they have given. Your compute reward to volatility ratio. Anyway, we are going to variability and volatility. We are going to anyway compute. Okay, they've asked reward to volatility ratio. But then they have separately asked a Sharpe method, Treynor measure. Now, both the methods you will apply. Find out, okay, and rank these portfolios, assuming the risk-free rate is 6%. Why? Because you need risk-free rate to calculate. Now, here, return of the portfolio minus risk-free rate, you need to calculate. So, right, first step, reward to variability, Sharpe ratio, I'll find out for all these one. Risk of the portfolio, risk-free rate, RP minus RF, numerator, divided by denominator. Okay, you will get the value as 1.285. Ranking, okay, highest ratio. See, very simple. What is understanding? You should rank based on ascending order, which means first 1.6 highest number. This will be rank 1. Why? Okay, it is ranked as number 1. Very simple. Return of the portfolio minus risk-free return divided by sigma of the portfolio. If you do this, what is the understanding? See, in the numerator, what they really mean, for every 1 unit of risk, what is the premium extra return I generate over and above the RF risk-free rate of return? This is what is Sharpe, which means numerator more, okay, the ratio, the ratio, higher the ratio, better the ranking. Okay, it should be ranked as 1. 1.6 is the highest ratio. Like this you should do. Next, reward to volatility, Treynor ratio, beta you will take as measure here. Now, see here they wrongly given us sigma p. It should have been beta p. They've given a beta also. Yes, it should have been beta. This is standard deviation. This is beta. Sorry. The beta 1.25. This is what they have taken. Actually, it should be beta printing it. Okay. You will reward to variability. What? Reward to volatility ratio. This is reward to volatility ratio. Okay. How much is that ranking? Like this, you will rank. That's all. That's all. Yes, they only asked about ranking. So 1, 2, 3, 4, 5. Just rank the issue. Okay. This Miss Sunidhi question. See, this question I have covered in mutual funds. Okay. I will put it in. See what I'm going to do. Mutual fund chapter. I have given question along with the answer I have given in the PDF. Okay. When I upload this, you will have the PDF. Questions, answers, you will have the PDF. And believe me, I have put the same question. I don't want to again and again discuss the same question. It's a lengthy discussion. I don't want to do again and again. You will find it in the mutual fund. There is a folder in my channel, okay, which has all the ICAE study mat questions covering mutual funds chapter. Many students are unaware of what is put as freely in our YouTube channel. There, if you see the mutual funds chapter, all the questions I have put it as free. Okay, you can go through. This question I have discussed there. Okay, this question I have specifically discussed. You can go through. Now, whichever question, same way, the mutual fund chapter in the next chapter, which I'm going to discuss. Okay, I'm not going to discuss all the questions from the mutual fund chapter. Everything is given already. Okay. But I've given the question along with the solution, expected question along with the solution I've given. You can simply go through. Wherever you are getting stuck in a few questions, you are not getting the solution. Now, there you just go refer and okay, quickly you can refer the study mat questions. There I have given the solution. Okay, this I'm going to follow in the upcoming chapter because time is running out. We don't have sufficient time to discuss all the questions. So what I will do, already discussed now. I'm telling you the source. I'll put it in the description box. Okay, the link in the description where you will find out the mutual funds. Okay, question answer discussion. There you will find out this question. Are you all understanding? Shall I proceed? Okay. Question number 93. This I will discuss because I couldn't cover this in that area and study mat doesn't have this question, I believe. I don't know. I will discuss it here. Okay. I remember that I have not discussed there. I will discuss briefly this. Indra has a fund of 3 lakh. This is what, okay, we are discussing portfolio balancing, rebalancing strategy. One of the, there are two ways of rebalancing. There's active strategy, passive strategy. See, the passive strategy, I don't do anything. It's a buy and hold strategy, which means I buy the shares or security. I just hold till maturity or I just hold till I sell the share. I don't do anything. Thereafter, I don't in between purchase or sell the share. This is called as buy and hold strategy. Okay. Then I have some strategy called as active strategy, which means I will rebalance. In the first case, Sunidhi question, what I did, I will rebalance along with the risk-free, conservative, risk-free security and risky securities, share securities. Okay, share market, I rebalance. Now, based on this, okay, the equity-oriented mutual funds are there. This question I have done it. Now, it is one. This is called as okay. Constant ratio plan. This plan is called as constant ratio plan. Now the question which we are going to discuss is also called as constant proportion portfolio insurance policy. What is this called as constant proportion portfolio insurance CPPIP. This I'm going to discuss with this question. Are you all understanding now? See, this is also one way of rebalancing the portfolio. Indra has a fund of 3 lakhs which she wants to invest in share market with rebalancing target after every 10 days to start with a period of 1 month from now. After 1 month, every 10 days, she is going to rebalance the portfolio. That is what is given. And 3 lakhs is the initial amount invested, which means she has 3 lakhs in hand. Okay, fund of 3 lakhs. Now, the present Nifty, spot Nifty, at present the Nifty is trading at what? 5326. And the minimum Nifty within a month can at most be 4793, which means what they say. Currently, the Nifty is 5326. And the minimum, which means the floor value, okay, the maximum it can drop up to 4793, which means it can go up to 4793 on the bottom side. Are you understanding? She wants to know how she should rebalance her portfolio under the following situation according to theory of constant. Okay, anyway, using 2 as multiplier. This multiplier, okay, we will use for, okay, finding the base value, how much you need to invest in risk-free security, which means how much you need to invest in equity so that the balancing number you can put it in risky security. See, risk-free security. See what happens. Immediately to start with, 10 days later being first day of rebalancing, if Nifty falls to this much, 10 days further from the above date if Nifty touches this much. Okay. If she wants to rebalance immediately, which means even though if you want to rebalance immediately, what will happen? You tell me. Immediately, now today I have funds of 3 lakhs. Okay. Today I have how much funds? 3 lakhs. What I do? First, I have multiplier 2. Agreed. First, I need to compute how much maximum in percentage, how much the value can decline. How much can decline? Very simple. Nifty is how much? 5326. This 5326 can decline up to 4793 in percentage terms. 5326 minus 4793 divided by 5326, which means this is the current value minus the target value divided by current value. This will give you percentage of drop. Okay, how much can drop? 10%. It can drop to 10%. Very simple. The 3 lakh value if you have, how? Okay, the 10% of 3 lakh is how much? 30,000. Are you understanding? So maximum, the loss can be up to 30,000, which means the 3 lakhs value can be, okay, dropped up to 2,70,000. It can reduce up to 2,70,000, which means investment in equity, multiplier, okay, the 2 is multiplier, the multiplier rate into, okay, the portfolio value minus floor value. I call it as floor value. Very simple. Floor value is nothing but the maximum amount, okay, which can happen the maximum reduction which can happen to the portfolio. Like 3 lakh you invested, from there maximum how much it can reduce? Okay, how much it can reduce? 2,70,000 it can reduce. Now what is the differential? What is the amount in what is the amount can be dropped? Not to 30,000 it can be dropped from 3 lakhs, which means how much it can be reduced? Not 30,000. Are you all understanding what I'm trying to say? Portfolio value minus floor value. Floor value means the maximum value it can reach, which is 2,70,000. Upon 3 lakh minus 2,70,000, the 30,000 is the maximum amount it can be dropped. Now, this 30,000 you invest in what? You invest in equity. You invest in equity, multiply it with multiplier. This multiplier, okay, I apply the 2 multiplier, 2 into 30,000. Now, what they say, even though 60,000 you can incur loss, now the maximum you should put in equity is 60,000. Are you all understanding? So 2 into 30,000, 60,000 you put it in equity risky asset. Balance you should always keep in risk-free asset, which means the 3 lakh, if I have 3 lakh in hand, I should do, okay, 2 into 3 lakh, 30,000, which is 60,000 in risk-free security. Then I should put the balance 2,40,000 in risk. This 60,000 in risky security. Okay, Reliance Tata risky security, and here I use risk-free security. Okay, to invest the balance amount. Are you all understanding now? This is today, right? After 10 days, tell me children, after 10 days, what will happen? What they say, find out after 10 days. But the first day of rebalancing, if Nifty falls to this much, see, here you expect Nifty to fall this much. Here you will expect to fall this much, falls to 5122. Now, again, you will compute the percentage loss, apply the percentage, find out the floor value, then the differential value between portfolio value minus floor value, multiply with multiplier. That will be the equity value. Balance, okay, risk-free asset should be balanced. Are you understanding? Now what you do? Value of equity 6 lakhs into 5,122.96 divided by 3, which means 6 lakhs if you had. Oh, okay. This is not 6 lakhs. This is 60,000. Printing mistake, 60,000. Okay, those 60,000 into this value, which means earlier you put 60,000. If you invested initially 60,000. Now at present what happened? From 5326, the Nifty dropped to 5122.96. So 60,000 value of the equity will come down to 57,713. If equity drops, now do the rebalancing. Again, do the rebalancing. What is the portfolio value? Portfolio value becomes, okay, 57,773. Now earlier, see, very simple. Now revised portfolio value. What is the portfolio value? Portfolio value is equal to value of risk-free security plus value of risky security. Agreed? Value of risk-free security, how much it was? 2,40,000. Earlier we put 2,40,000 plus, okay, value of risky security in the previous segment we found out now 57,713. You add it, you will get 2,97,713. This is the value of the portfolio minus floor value. Again, 2,70,000. Once we compute the floor value, that will remain unchanged. Okay, maximum, because 1 month maximum it can lose up to 10% now. So 2,70,000 is the floor value. What is the differential amount? 55,426. What is the what is the differential amount? 27,000. Okay, 930 into 2. You apply the multiplier, you will get the 58,426. Are you all understanding? What is this 58,426? This is the revised amount to be invested in equity. Now, earlier, how much you had in equity? Tell me, children, how much you had in equity? See, you had equity 57,730. Now what they say, revised equity should be 55,426. Revised equity should be 55,426. Risk-free security should be how much? 242,287. Which means what happened? Earlier, what is the position? Risk-free security, risky security. What was the position? 2,40,000 was the risk-free security, and here 57,713. Agreed? Now what do you see? You rebalance it and make it, okay, I say, what do you do? You make it to 2,42,287, 55,426, which means this total, this plus this, okay, should give you how much? 2,97,713. That only I rebalance now. Are you all understanding what I'm trying to say? This is risky security. Now risky security 58,425. Yeah. Risk-free. Now, earlier you had 2,40,000, here 57,000. What you do? What is the strategy? Very simple. 57,000 earlier you have equity exposure. This is equity. Okay. You sell equity and reduce the equity exposure. Are you all understanding? To the extent of how much? 57,713 377 plus 5,288. What do? You reduce this equity, sell the equity to the extent of 2,288, buy risk-free security and add it to 2,288 to 2,40,000. Are you all understanding? 2,40,000 plus 2,288. Okay, rounding up 2,288. It should be matching. Are you all understanding? So value of the risk-free investment should be 2,42,287. Total portfolio value now. Okay, total portfolio value will become what? See here, what will be the total portfolio? See, okay, this is after 10 years. Again, this is the total portfolio value, 2,42,288 plus 55. Now, total portfolio value, 2,97,713. After second adjustment, after another 10 days, what will happen? Again, value of the equity will compute. This much will be the value of equity. Again, apply the formula. You will find out the revised value of equity. Now it is increased. You need to purchase equity shares. By selling the risk-free asset like this, you will revise. Are you all understanding? The investor should offload this much risk-free security and buy the equity, divert to the equity, buy the equity instruments. Are you all understanding? You can go through. This is all about the CPPIP. Okay, shall we move on to stock lending scheme? Question number 24. Mr. A is holding 1,000 shares of face value of, and Mrs. ABC Limited, each of Mrs. ABC Limited, he wants to hold these shares for long term and have no intention to sell. On 1st January 2023, Mr. XYZ Limited has made a short sales of Mr. ABC Limited shares and approached Mr. A to lend his shares under a stock lending scheme with following terms. Shares to be borrowed for 3 months from 1/1/2023 to 31/3/23. Lending charges free of 1% to be paid every month on the closing price of the stock quoted in the stock exchange, and bank guarantee will be provided as collateral for the value as on 1/1/2023. Other information given, cost of bank guarantee given, and declared dividend of 25%, closing price of the stock exchange. Other these ABC Limited shares on various date, bullish scenario, bearish scenario, two different scenarios given. The share price. You are required to find out earnings of Mr. A through stock lending scheme in both the scenarios, total earnings of Mr. A during this period in both the scenario. What is the P&L versus XYZ Limited by shorting the shares using through stock lending scheme for the scenarios. No, calculations to be done on per share basis and total basis both. Okay, this is a question that is being asked. One by one, we will compute. See, Mr. A, what is the situation? As a stock lending scheme, what happens? Okay, generally, when you want to in the share market, you can also short sell. I've explained in the portfolio management arbitrage pricing theory. Very simple. Even see, generally in the real asset and all, can you sell the house properties? Assume you're a house property. Can you sell it before without owning it? No. Transfer of Property Act doesn't allow it. Like this, you cannot sell the the investment without actually holding it. But in case of shares, what you can, there is a process called a short selling, which means without even having the shares physically, you can sell the shares. Okay. Either the broker may provide you, either broker will lend you. If broker holds the shares, he may lend you directly, or if some other person is having a demat account with the broker, he may agree to lend the shares, and the broker may give you through the broker you may get the shares. Are you understanding? You may short sell the shares. Later on, whatever dividend is provided, now that person will get the dividend, which means the person who is lending the shares will receive the dividend. Dividend belongs to him only. Original owner, dividend belongs to him only. Now, the profit and loss, if any, will be adjusted through this account. Are you understanding? The person who is short selling, the margin account will be adjusted. Shall we see the question? So here, what happens? Mr. A is a short seller. Now he is selling, but without owning the shares. Who is the owner of the shares? Who is owner of the shares? See, very simple. Short seller approach here has made short sales of Mrs. XYZ Limited. ABC Limited is the shares under discussion. A is the owner of the shares. Mr. A is holding the shares. Are you understanding? Mr. A is not a short seller. Sorry, Mr. A is holding the shares. Original holder of the share. He is the owner of the share. Here, what happens? Mr. A is the holder of the share. Now, what is the Mrs. XYZ Limited? Short selling the ABC Limited shares, which means who is the short seller? XYZ Limited He short seller. Are you understanding? He short sell the ABC Limited shares. ABC Limited's share. Which company shares are being short sold? ABC Limited. Okay, now we one by one will compute. Okay, adjustment we can see. Earning of the Mr. A through stock lending scheme in both the scenarios. But what happens now? Earnings of Mr. A. See, what Mr. A, what he does, he lends the shares. He lends the shares. He will charge something called as lending fee. He will charge something called as lending fee. Okay, on the market price, which means market share price. If share price becomes 1,000, now 1%. See here, what happens? See, lending charges fees to be paid every month. The closing price of the stock quoted in the stock exchange. See, say for 3 months you have taken the short position. The closing price for every month. So 1/1/2003, 31/3/2000. The 1/1/2003 is irrelevant. The 30, which means 31/3/2003 23. 31/1/2023, 1020, 980. This is relevant. So 1020 and 980 you will consider here. Okay, and 1020 and 980. Why? Bullish scenario, bearish scenario. Both the scenario they are asking us to compute the receipt of Mr. A. Now, tell me children, what will happen? Lending fee 31/1/2023. This will be the lending fee. Okay, second month lending fee, third month lending fee. Total lending fee per share, because this is applied on per share. Okay, market price per share. So this is the per share lending fee applicable. Total number of shares this much. What is they have asked per share basis? What is the lending amount? Which means the profit amount, and the total basis, and on total basis. So total number of shares is how much? 1,000. Here also 1,000. So 31,000 and 20,800 total earning from the lending. Next, total earnings of Mr. A during 1/1/2003 to 31/3/23. See, very simple. See, the total earnings. First part they are asking. Okay, through stock lending scheme. Through this lending arrangement, what you earn now, only lending fee I will earn. The total earning now, total earnings means, okay, I have a lending, I earn through lending fees. Okay, this is one of my earnings. Another earning way is that, another way of earning is dividend. Another income you will receive is dividend income, which is directly received from the company. Are you understanding? Dividend will be because he is the real owner, so dividend will be credited there. Okay, so what will happen? You already found out the lending amount fees. You find out the dividend declared. Okay, 25 is the dividend given. Yes, 25 is the dividend declared per share. Total earnings 25 plus 31. Here also 25 plus 28.8. How much is that? 53.8. Here 56.1. Total earnings comes to divided by, okay, into number of shares. He will give you total earnings 5600. Here 53,300. Extra profit or loss to Mrs. XYZ. Gain or loss on shortening the shares, 1,000 minus 1,050 and 1,000 minus 940. Okay, see, the profit or loss, last part, they are asking what is the benefit to Mrs. XYZ. He is a short seller, XYZ short seller, whether he is gained or not. After all, he did all the transaction for gaining. What happened, you tell me? Okay, under bullish scenario, bearish scenario, because both are possible. So, bullish scenario, what happened? Gain or loss on short sell, 1,000 rupees you sold. How much ultimately he realized? 1,050. If you see this, what happens? What is the... See, initially he sold at this price, 1/1/2003. He sold at this price. At the end of third month, what is the share price in the bullish scenario, bearish scenario? See, both the scenario, today share price 1,000. This will not change because today's share price, it will not change. But after 3 months, bullish share price appreciates to 1,050, bearish depreciates to 940. In this case, what is the differential amount? Okay, here 50 is the he has sold here short sell and the price is appreciated. Stock price increase, which means loss. First case loss. Bullish case, if you are a short seller, you will incur loss due to the upside momentum. Okay, this is 50 loss. Why? 1,000 minus 1,050. Lending fees also he paid 31.1 per share. So this is also per share. This is also per share. Apart from that, bank guarantee charges also 8%. Are you all understanding? Okay, you need to give some bank guarantee. For that, charges also given as 8%. That also you will consider 20. Okay, on a per share basis, this is 20. Where they're given? See, very simple. See, cost of guarantee. Can you see this? Cost of guarantee is 8% per annum. Hence, it is per annum basis. Okay, this is per annum per share. 1,000 rupees if you want to have the guarantee. which means 1000 into per annum, what is that, 8%, na? 80 will be the amount, total amount. Only 3 months, I have taken only, I'm lending for only 3 months, na? So which means 1000 into 8% into 3 by 12, 3 months. How much is that? 20, that they have considered, and they have found out gain or loss, because bank guarantee you have to give. This is also outflow. Lending fee you have to pay. That is also outflow. Net outflow. Apart from that, there is a loss from the lending. Everything is loss. Okay. If price appreciate, if I am a short seller and price appreciate, now gone. Okay. Total loss here 101.1. Next, price depreciate. Now you will benefit from the okay, the short selling, but you have to pay the other both the fees. Okay, other two fees you have to pay, which is lending fees and bank guarantee. These two you have to pay. So from 60 you have to reduce 28.8 and 20, you will get 11.2 net gain. Are you understanding? Is it per share? Total number of shares 1000, you will get the total loss or gain. This is all about portfolio management. A stock lending scheme also important this setup. And with this we are through with the chapter. Very important. Okay, every attempt 16 marks is being taken from portfolio management. Now we'll move on to the mutual funds chapter, shall we? Okay, so for mutual funds chapter, as I told you, okay, all these questions covered, link will be provided. The study mat, ICA study material questions discussion, all these questions are not discussed there. I will discuss here. These questions have been discussed there. Is this question has been discussed already? And 98, 99, this bonus ratio, different plans, everything I've discussed there. Okay. Question 100 alone, I will discuss. This one question, this question, I will discuss. Okay. Now, the following particulars related to Vishnu Fund Scheme. Okay. Given particular and value on crore. So, investment in shares across 79, pharmaceutical companies 79, construction industries, service sector companies, all these are value. Okay. At cost, value given, which means initially fund invested in these shares. Okay. At this value. 79 code 31, 56, 34, and 10. Now, investment in bonds. When it comes to bond, it has invested in listed bond. Okay, 8,000, 14% bond at 1,500 each, 12 crore. The value of it is 12. Okay. Unlisted bond, okay, 7 crore. Next, number of units outstanding, 4.2 crores. Expense payable this much. Cash and cash equivalent, 1.5. Market expectations on listed bond. The expected return from the market. Okay, market expectation. Okay, this is the required rate of return from the market expectation, expected return from the market. Okay, on the listed bonds, which means you have to discount the bond using this rate. That is what they are saying. Anyway, particulars related to each sector as follows. Particulars pharmaceutical company, index on the purchase date for this much, and index on valuation date, which means this has appreciated to this. We need to find the market value at the end of the year. Now, for that, this is given. Construction industry, okay, and service, IT and real estate given. Now, the fund has incurred these expenses. This you have to reduce, okay, from the net assets. You are required to calculate the following: net asset value of the fund, net asset value per unit. Okay, then you have, if the period of consideration is 2 years and the fund has distributed rupees 3 per unit as cash dividend, ascertain the net annualized dividend. This is the question that is being asked. See what is it? Calculation of NAV, value of shares. You need to find the value of the shares, okay, on the maturity date now, which means the valuation date now. How you will find? Very simple. 79 crore initially invested. What is the index at the end of the period? 489. Index at the beginning, which means the value invested into index at the year end divided by index at the year beginning. You will get the appreciation. Get the maturity value of the 79, which means the 79 value, initial value, how much it at the end of the period, 141.288. Construction industries, okay, 31 into 450 divided by 21. This is index at the year end divided by index at the year beginning. You will get all these values, equity values. Now come to the bond. Investment in bond. Okay, this is one of the important adjustment. Listed bonds, what they have done, very simple. Value is 12 crore. Value is 12 crore. They say the required rate of return is how much? 8.842%. Required rate of return for the investment is 8.842%. Okay, the bond is giving how much return? 14% return. Okay, and the required yield is 8.842, which means bond is giving more than what it is required. Less than what it is required, more than what it is required. Are you all understanding? Which means the bond value should be only 12 crore, more than 12 crore, more than 12 crore. Are you all understanding? Okay, very simple. Yeah. if it is giving 14%, and if you require only 8.842%, which means to that extent the value is actually more, which means a 14. Okay, that is what they've given. 14, both are percentage. That's why they've taken 14 by 8.842 into 12 crore, which means 19 crore. Are you understanding? Okay. Next, unlisted bonds. Unlisted bonds value 7 crore. Okay, then cash and cash equivalent. Total value of the assets 419.165. Less expenses payable, you reduce it, you will find the 415.665 is the NAV of the fund. Total net assets of the fund. Now here, you see the expenses payable. Okay, they have where it is. Yes, expenses payable is 3.5 crore. So 3.5 crore is the expenses payable that they have reduced. Okay, now what is the total NAV of the fund? Yes, 415.665. Next, NAV per unit we need to find it. NAV per unit. So NAV of the fund is 415.665 crore. Number of units 4.2 crore given in the question. Divided NAV per unit. Next, NAV return na initial. Okay, see here, initial cost per unit. Initial investment 10 crore. Total bond 19 crore. Total of it comes to 229 crore. This is the initial investment. Number of units is this much. Okay. Now, what is the cost per unit? If you unitize it, you will get the cost. How much is that? 54.52. And what is the return? You return, you will gain capital gain 98.97. Was the closing NAV? 98.97 closing NAV. NAV1 minus NAV0. How much? 54.52. The cost element. Okay, if you reduce it, you will get the return as 44, which means 54.52 per unit is the cost. For this, you have received how much return? 44.45 extra return. Are you understanding? This is 44.45 in terms of rupee, which means for every 54 rupees you are earning 44. Now, how much is the total return? Actually speaking, what is the return? See, this yes, apart from the dividend is also there, 3 into 2, which means per unit rupees dividend. Now, okay, for what is that? For 2-year period. Yes, for 2-year period. 3 per unit is received. Now, what do you do? Okay, 2-year period, you will multiply it with 6. So, plus 6. How much is that total? 44 plus 44.45 plus 6, 50.45 is the total return, which means 50.52 per year cost. In that, this much is return. Okay, for that, this much is the return, 50.45. Nearly double. Okay, nearly double. Okay, 100% should be the annualized return. Approximately 100% should be the annualized return. But the return for both the years, not annualized return, sorry, both for cumulative 2 years, you have return of nearly 100%. What you should do? 50.45 divided by 54.52. 54.52 is the cost for which this is the return earned. Okay, and this is earned in one single period, 2 years period, 2-year period. Okay, simple 1 by 2, half they have multiplied and found out the return. This is not the correct way to find out. Okay, you have to find out something called a CAGR, capital compounded annual growth rate, which means what you should do actually, the 50.45 is the initial cost, which 50.45, 54.52. Correct? This is the cost element. This you invested, and the maturity value. What is the maturity value? 50.45 plus 54.52. Calculate. 50.45. 54.52. 104.97, which means 54.52 became 104.97 in 2 years time. In 2 years time, future value above. When you find out the rate of return, CAGR is equal to square root, which is square root, not 2 years, so square root, which is future value divided by present value minus 1. Future value is 104.97 divided by 54.52. Okay, this you square root, very simple. 104.97 divided by 54.52. 1.92. Okay, 1.9253 square root 8 minus 1. Square root of, okay, 0.92 is the square root. What is the number? 1.3875. 1.3875 now, minus 1, which is 0.3875. How much is the value? 338.75%. This should be the rough CAGR. Are you all understanding? So with this, we are through with the mutual fund chapter. Only one question I discussed here, because all the other question solution has been discussed in the ICA study module video. Okay, you can go through that. Next, mergers and acquisition. See, in this chapter also, there are so many questions, and even further new questions can be framed easily. So there are a lot of 100 odd questions are there, 120 questions are there. Very difficult to select few questions and give you. Okay, what I have done is I have selected 5 questions and I have given you, so that if you do these 5 questions, you will be able to solve all the other questions. Okay, which means you will be able to comfortably solve all the other questions, is what is my understanding. All the adjustments are covered in these 5 questions. That is what I have done. And the questions are also very simple and straightforward. Mergers and acquisition questions I don't want to discuss in the marathon. Okay, you can simply go through. Just 5 questions are given. Okay, it's not technical, easy accounting number. There is no time value of money involved, no technicality involved. You can easily go through. Okay, and lack of time, so hence I cannot cover this 100%. Okay, these 5 questions, can you go through? Now, I have given the solution also. Please go through. Now, in the last segment, see, I will discuss this miscellaneous topic. I have 2 questions to discuss, 2 or 3 questions we discussed in the miscellaneous topic. This I'm not going to skip, because this is not like mergers and acquisition. This is totally new and very important. Okay, and last we are discussing these in last few minutes, so you should not ignore this. Okay, it's very, very important. Now, take question number 106. ABC Limited is considering a project which is normally distributed and has a mean return of 2 crore with standard deviation of 1.6 crore. Okay, in case ABC Limited loses on any project more than 1 crore, there will be financial difficulties. Determine the probability the company will be in financial difficulty. Given standard normal distribution, Z-score is provided, area between mean and Z-score given, and the area is given, but probability percentage. Okay, this is 1.85. For a Z-score of 1.85 is nothing but, okay, there is a 46.78% chance. The area coverage, see the normal distribution table. Okay, always the Z-score, Z value is nothing but X to X bar table. It is also called as X to X bar table. It is a distance between the mean. Okay, in the standard deviation table, mean will be in center, X bar. Okay, this will be left and right corner. Now what happens? This is the target area. Assume this is X. This I call it as X to X bar table, because it will give me a probability, okay, for an event to happen, which falls in between the X bar and mean to the distance between mean to the target value. Very simple. In this question, through the numbers, we can easily understand. ABC Limited is considering a project normally distributed mean return is 2. What is the average return from the project? 2 crore, which means the center point is 2. You are understanding? On an average, the project may give you 1 crore, the project may give you even 3 crore, but on an average, I predict that the project will give me a return of 2 crores. Agreed? Now, what they say, this project will give me an average return of 2 crore, but whether it is certain or uncertain or uncertain. So uncertain means it can deviate. Okay, it can be even less, it can be even more. What they say is that the deviation can be 1.6 crore, which means from 2 crore, it can be only 40 lakhs. It can either be 40 lakhs, or it can also be like upper end 3.6 crores. Are you all understanding? So 1.6 deviation can happen from the mean overall deviation. Now, in case ABC Limited loses any project more than 1 crore, there will be financial difficulty. See, the project can either go down, the project return can either go up. Upside, it can go up to 3.6 crore. Downside, it can come up to 40 lakhs. The point is, the deviation is 1.46 crore, but I can bear the losses up to 1 crore. I can bear losses up to 1 crore. Are you all understanding what I am trying to say? Which means the ABC Limited loses any project more than 1 crore, there will be financial difficulties. Okay. If it is loses more than 1 crore, now very simple. What is the 1 crore loss minus 1, which means left side or right side? It would be left side. Okay. You have to see the losses now, left side. I'll just redraw this. Our target value will not be at the right side, will be on the left side. Target value will be the left side, which means this is 2 crore. I go to the left side, negative value, I go to the left side. around this point it is minus 1 crore. Are you all understanding? Somewhere around here is minus 1 crore. Are you all listening? Okay. Now what they say, this is the maximum loss. For this, you need to find out the probability. So what they say, on an average, okay, the return from the project is 2 crore. But what is the probability for the project to earn, okay, from 2 crore to 1 crore? Now, financial difficulty means what is the probability? You need probability for this area. Okay. You need probability for balance area. Very simple. Yeah. When will you see? When will you have financial difficulty? If the project return crosses below 1 crore, which means if it is less than 1 crore. Can I tell? See, I am taking green color here and I show you. See, if I go beyond this point, till this point I can bear the losses, but beyond this point I will be troubled. I will be in trouble, financial difficulty. Okay, I will be in financial difficulty. After what they are asking, what is the probability of this? You are understanding all the left side. So this is the probability. Now, for that to happen, first you need to find out the z-score. Now, what they say for z-score given na, yes, okay, z-score for various possibility they have given. First, this is nothing but normal table value, NT table value they have given. Now, you need to find out first how to find out z value. Now, z value is nothing but, okay, you have to find x minus u, which is, see here, x target value, okay, and this is mean divided by standard deviation. Okay, x minus x bar. I didn't say mu. It is nothing but standard deviation. X minus x bar. I can say this. X minus x bar divided by standard deviation. Now, tell me, children, what is x? My target value, which is minus 1 crore, minus x bar means mean return. Mean return is how much? On an average, how much it is earning? 2 crore. So minus 1 minus 2, how much is that? Minus 3 divided by standard deviation. What is the standard deviation they have given? 1.6. So minus 1 minus 2 divided by 1.6 minus 3 divided by 1.6 crore. How much is that? 1.875. Now I get that this is nothing but z score. This is nothing but z value. This is I call it as z value. X to x bar table. From the x to x bar. Okay, this I got it. How much is that? Oof, 1.875. I'm tired of this. Anyway, we'll finish this. Only 2 questions. X to x bar from here we need to find the value of z score. Now you got 1.8. How much is the value? 875. Yeah, 875. Now they have asked us to do the interpolation. Can you see 87? This is the value. 88. This is the value. They could have directly given the 875 value. I don't know why they are playing with the small numbers. Okay, 0.4693 and 0.4699. It is something in between. Now, if you increase this by 0.01, okay, how much it is increasing? 0.4693, 469. Now 0.06 it is increasing, but we only need a 0.005 increase. So what we need 0.03, which is half of the 0.06 increase. Are you all understanding? So 0.4696, 0.4696 or 0.4697 also you can round it up. Are you all 4696? This is what they have done. So 1.87, z value for 1.875 is equal to 0.4693, which is value at 1.87, but you want 1.875 value plus 0003, 0.4696. Do the interpolation, you will get the 0.4692. Thus, what is the understanding? Probability of the company, okay, shall be in financial difficulty is 3.4%. Very simple. Now, how do they get 3.4 now? Very simple. What is this value for 0.4696 now? It is nothing but, okay, probability now 46.96%. There is a chance, okay, 46.96% chance for the company to earn a profit of, okay, in between 2 crore and minus 1 crore. Are you all understanding here? This normal distribution. Here, if you see, it will be perfectly skewed in the center. Forget about my, okay, assume that this is the mean. This is 2 crore. Okay, we found out that we want a value of minus 1 crore. This is the target value. Are you all understanding? Now what they say, okay, the normal distribution table, always you understand that this will be 50% and this portion will be 50%. Why? Mean will always be in center. The probability of this occur left to tail to center and center to the right tail, both will be 50%. It will be in center. In median mode, everything will be in center. Now you see, if the total left side to center will be 50%, and this is called as z value, which we found out. X to x bar table. Okay, this is the target value to the x bar. If this value, if this distance is how much? 46.96. The total distance is 50%. Now, we need which distance? We need a distance, okay, the value probability for this distance, okay, which means left to tail to target value, left tail to target value. Okay, this distance is probability is how much? 50%. If the total is 50%, minus 46.96, now 3.04% is the probability. Are you understanding? Next, value at risk. Okay, two questions are there, I think. Yes, two questions are there regarding VAR. Then we have one question. Okay, two more topics are pending. VAR and EMA will try to quickly cover. See, value at risk. Support you hold 2 crore worth of shares of X Limited, whose standard deviation of market price is 2% per day. Assuming 252 days, trading days a year, determine maximum loss level over a period of 1 trading day and 10 trading days with 99% confidence level. Assuming share prices are normally for level of 99%, the equivalent z-score from normal table of cumulative area should be 2.33. Calculations may be rounded off. See what is happening. VAR, okay, the formula for VAR, okay, the value at risk. What do you mean by VAR? VAR means, okay, value at risk means if you are trading in the share market, okay, for every one single day, what is the maximum amount you can lose? What is the maximum amount you can lose based on the, okay, the volatility of the share, okay, how much it can decrease, or based on which they have found out that maximum amount you can lose from this investment, which on a given day, if you make some 1 lakh rupees as investment, so you have one investment value, now. Out of this investment value, how much maximum you can lose for each day is called as VAR per day, value at risk. And it can also be traded for 1 trading day or 10 trading days. I mean, for 10 days, how much will be the loss? Like this, we will try to find out. So VAR value at risk for 1 day, assume for 1 day. Now, what is the formula? Total investment value into the standard deviation of the security. Standard deviation, volatility. Okay, standard deviation captures the volatility now. So into standard deviation of the security, okay, into the z-score, cumulative value of z-score. Are you all understanding? Now, this you need to find out. Okay. For example, in this question, now let's say what is the investment value? 2 crores you have available for investment. What is the investment value given? See, 2 crore. You hold a 2 crore now, but investment value is 2 crore. Into the standard deviation of the securities of market price is how much? 2%. So into 2%. What is the see the investment amount into standard deviation alone? I call it as what? Okay, I call it as volatility in terms of rupees or in terms of money. Okay, volatility in terms of rupees. Are you understanding? So 2 crore into 2%, how much 4 lakhs I can. Are you listening? So this will be the volatility. So the prices or the value can be even 4 lakh upside or downside, like this they are saying. Okay. Now next, multiplied with z-score. Very simple. The z-score I told you, it can be found out for various confidence level. 99% confidence level. Now, okay, the probability of the occurrence of this event, cumulative probability is 2.33. Cumulative probability z-score I told you. Okay, z-score is x to x bar. Cumulative probability, which means if you find out the value x to x bar, z value plus 0.5. If the z value is positive and if you add the plus 0.5, okay, you will get the 2.33. Are you understanding? It will be given in the question. It will be given in the question. This cumulative area value will be, z-score value will be given in the question. Now, what you should do, you should multiply. Simply, now in this case, what happens? Volatility in terms of rupees is 4 lakhs. Now, maximum loss for 1 day, this 4 lakhs into 2.33. How much you will get? 9.32 rupees, which means 9.32 lakhs, which means out of the 2 crore of investment, maximum loss I can incur for each day is 9.32. For 1 day, one single day is 9.32. Why this is important? They have asked volatility for 1 day, which means they have asked the maximum loss VAR for 1 day or 10 day and 10 days. For 10 days, how to compute? The same formula will be there into, okay, VAR for 10 days. Assume VAR for 10 days you want to compute now, into simply root of t. Root of t na number of days. Okay, root of number of days. In this case, 10 days na into root of t 10. Okay, that is what you need to find out. Are you understanding? So expected maximum loss for 10 days cumulatively is how much? Root of 10 into 9.3. 29.4. I trade for 10 days keeping a money of 2 crore in hand. Okay, in a security which is having a standard deviation of 2%, okay, I will incur a maximum loss of 29.47. That is the understanding. Next, this is very, very important question. It was asked in, okay, one of the previous May 2023, okay, 2.5 hours since they asked this question. I think this can be tested. Okay, the story might be different, but the one more question is there. Anyway, reverse working question, that also you can find. This itself is a reverse working question. Shall we find out? Okay, see, Mr. Bull is a rational risk taker. He takes his position in a single stock for 4 days in a week. He does not take a position on Friday to avoid weekend effect and takes position only for 4 days in a week. This is all relevant. All other things are story. Okay, just read on Monday to Thursday. He transfers the amount on Monday morning and withdraws the balance on Friday morning. He decides to make a maximum investment where VAR should not exceed the balance lying in the bank account, which means he started trading on Monday. On Monday, when he starts trading, whatever is the balance amount, okay, that should be the maximum VAR, which means he should not, okay, should not be in a position where, okay, after paying all the bank balance, then also he will left with some amount. Okay, that should not be the case. So maximum bank account amount should be the VAR, maximum loss, possible loss. The position by his manager as per the standing instruction is taken with free balance lying in the bank account in the morning, Monday morning on each day. Anyway, that is already given. On Monday morning, before opening of capital money, he has transferred amount 11 crore. 11 crore rupees he has transferred. Next. A FD also matured on Monday. This maturity amount, this much was also credited to account bank in the morning of the Monday itself, which means that he deposited 11 crore. Apart from 11 crore, he received, okay, the matured FD matured, that is 63 lakhs 42,560 FD matured. So total amount available for trading is 11 crore plus 63 42,560. And but however, Mr. Bull received the intimation of same in the evening. The bank needs a minimum balance of 1,000 at all the time, which means apart from this, okay, it needs a minimum balance of 1,000, which means only tradable amount. What they say, bank needs 1,000. Now, tradable amount is 11 crore plus 63 42,560 minus 1,000. Are you listening? The value of Z score as required confidence level 99% confidence level. It can be also found out using 95% confidence level. 99 question will be giving you the values. Okay, 2.33 is the value now. Other information related to the stocks X and Y, which are under the X, Y, return and probability given. Now, ex ante data given, ex post data given, ex ante data given, probability. So you will find out the expected return, mean return, and the deviation. You are understanding? That's why this given is given. Security X, you will find out the mean return, deviation. Standard deviation security is required now. That is why they have given. Now, you are required to recommend a single stock where maximum investment can be made. This is the question that is being asked now. For every security, for security X, you will find out the average. So return, probability, weighted return, then X minus X bar. Okay, X bar, you will find it out 8%. Then X minus X bar the whole square, probability into X minus X bar the whole square. So that is the variance, okay. Now, standard square root of this 1.3, you will get 1.14. This is a standard deviation of X. This is a routine computation from portfolio chapter. You can understand. So this is just to compute the standard deviation. Now, come to the security Y. Here also return, probability, okay, weighted return. Then you will find out the standard deviation. This is the expected return, mean return of this security Y. Then variance, the square root of this variance will give you standard deviation of security Y. So you have standard deviation of X as well as standard deviation of Y. Shall we discuss what is happening? Okay. What the question asks, you see the question requirement, you are required to recommend where maximum investment can be made. Are you understanding? Whichever option. See, very simple. VAR per day is equal to what? Okay, maximum investment amount. This is max investment amount into what? Maximum investment, possible investment amount into, okay, you have the Z value. Oh, that is the standard deviation, which means the variability, okay, into Z score. Z score for 99% cumulative level. This is what is the formula for 1 day. If number of days given, assume 10 days is given. In this case, 4 days given. Yes, in this question, Monday to Thursday, 4 days given. So, maximum VAR, 4 days. Now, what you will do? Apart from that, you will multiply with, okay, square root of T. T na 4, which is 2. Are you understanding? Now, see, we'll start from the beginning here. Maximum investment amount they are asking. They are not asking VAR. Why VAR is given in the question? VAR is nothing but, see, amount transferred to the bank is 11 crore plus maturity proceeds of the fixed deposit. That also will be credited in the bank. That also we will add. This will also be added. So maximum amount, okay, 11.6342 crores. This amount is there. Are you understanding? 1,163 lakhs 42,560. This is the amount. Now, but balance amount should be kept in the bank 1000, you will reduce it. So this becomes 1163, 41560 are your understanding. So amount available, maximum amount available for investment for trading. Now, maximum loss for 4 days at 99% level. Okay, see for 4 days, what is the amount? This is the amount. Why they say, this is the maximum amount you can trade for 4 days. It's for 1 day, 4 days or 4. What you should do up a 4 day, per day, how much I need to do? Very simple. What you do, divide it by root of t. Are you all understanding? If you divide it by root of t, you see, this is the VAR. This is nothing but VAR for 4 days. This is nothing but VAR for 4 days. This sum. Okay. If you want VAR for 1 day, maximum loss, possible loss for 1 day. Okay, see, here they said that whatever is available in your bank account, okay, maximum you can make the loss, not the investment amount. Question is asking about investment amount. You're listening now. To make this as maximum loss, now this is loss for 4 days. I divide it by sigma, I divide it by root of t, which is 2. So I divide it by 2, get 581.70. Here also I get 581.70, 780. This is nothing but maximum loss for 1 day. 1 day. Are you all understanding? Divided by sigma. Multiply with sigma root of t, you will get the VAR. VAR divided by root of t, you will get the maximum investment amount. Now, Z score at 99% level, how much? 2.33. Z score at 99.03. So volatility for this given level of this amount for 1 day, what is the volatility amount? 249,66,000. This is the volatility. Now, what is the standard deviation given in the question? You have found out now 1.14%. If you write in decimal 0.0114, here for security Y, this is the standard deviation. Very simple. Yeah. Okay. VAR for 1 day is equal to, what is the VAR? Maximum investment amount. Okay, into what is that? Standard deviation into Z score value. Okay, Z score value, cumulative value of the Z score. Now, what is happening? In this case, VAR is given. Okay, maximum investment is what you want to find out. And you, okay, the standard deviation is also given. What is the standard deviation? We have found out as 1.14. And Z score also given as 2.33. Now, what is happening really? You have VAR. If you, okay, you have the VAR now. If you have the VAR, divide it by this 2.33. If you divide it by this Z score, what will you get? Maximum investment into standard deviation. Again, you divide it by standard deviation, you will get the maximum investment amount. Are you all understanding, my dear friends? Very simple. Okay, VAR is equal to, okay, for 1 day is equal to, what is that? Max investment. You have 3 components now. Max investment into, what is that? Standard deviation into Z score value. Now what they say, first they, okay, divide it by Z score. You will find the maximum volatility. Correct? Again, you divide it by standard deviation, you will get the maximum possible investment amount. Okay, in this case, which one is highest? Okay, 2190. How much is that? Okay, lakhs, 21,900 lakhs. 21,900 lakhs. Here we have, okay, 11,400 lakhs. 11,400 lakhs. Which one is the highest maximum investment possible? Which security will allow you to maximum invest the amount? Here, security X, or your understanding position should be X. There's a question. Okay, next question number 109. This is the last question we are going to discuss. Exponential moving average. Very, very important. Listen. EMA bullish signal. Okay. May 24 also. May 22. Every 2 years they keep on asking this. Hence, May 26 just intuition. It may be tested. Closing value of Nifty index from 3rd to 12th day of the month of January 23. Whereas, see here. Days given for 1, 2, 3, 4, 5, 6, 7, 8. 8 days, 8 trading days data given. Closing value of the Nifty given. Closing value of the index given in this side. Okay. The simple average, moving average of Nifty index on the month of December 22, which means you start from January and December, okay, 22. Last moving trading day, it was 17,174. This is nothing, okay, great. This is the last trading days, okay, moving average. EMA, last trading days, exponential moving average. Are you all understanding? This is the previous last trading days, EMA. That's to be noted. Now, you are required to calculate value of exponent for 15 days EMA. See, value of exponent now, very simple. You have a formula for value of exponent. What is that? 2 divided by n plus 1. Now in the market, there are, okay, I can show you, okay, regular lecture I used to show you. No, don't worry. Here, what happened, you would have seen the chart patterns. Okay, they say 15 days EMA, 50 days EMA. Common is that 50 days EMA and 100 days EMA. Okay, now what is the understanding now? It is a replica of the stock prices. It's an average. Okay, it's exponential moving average. It will just, okay, try to find out the pattern of the stock price. Okay, how it moves. If it is to be okay, if it is trying to give a bullish signal, it will be going up by some prices, and it will go down. It is giving a bearish signal. You can find out by the numbers. Okay, in reality, the chart will be there. You can click the either there are screener website are there, and if you click it, you will find the red line and blue line. Okay, which will be 100 days moving average, 50 days moving average. You can find out. Very simple. Now, if you want to find out the exponent value, if you want to find out 15 days EMA, so what do you do? 2 divided by n plus 1, 15. So 2 divided by 15 plus 1. This is important. Now, if 50 days EMA, how to find out 2 divided by 50 plus 1? Are you all understanding like this? Number 2 divided by n plus 1. The formula for exponent, value of exponent. In this case, 2 divided by n is 15. So 15 plus 16, you will get 12.5% or 0.125 value. Okay, this is the value of the exponent. Next, EMA we need to find out. This is value of exponent we have found out. Next, exponential moving average of Nifty during the above period. So all 8 days you have. 8 days EMA you need to come. 8 days stock prices are there na, Nifty prices are there na. EMA. Next, after finding the EMA, analyze the EMA and tell me that is buy signal or sell signal. Okay, bullish sentiment, market, it is bullish sentiment or bearish sentiment. Bullish means price going up, expectation is up, price going upwards, and bearish sentiment now expectation is going, expectation of the price going downwards. See, now let's take this date. Okay, 3, 4, 5, 6, 7, 8 days taken. Now, see, there is a formula given. You don't need to mug up the formula. Just understand tabular method. I'll simply make you understand. Don't worry. Don't need to mug up the formula. See what happens. Every day, you first column day. Okay, write down the days. Next, Nifty. This Nifty. In this question, they have given straight away closing value. Sometimes I've seen questions where they give you opening price, high price, low price, and closing price. Just like we did one question in futures now. So what you should consider, always closing price is superior data. Okay, closing price you should consider the 17,626, 17,805. All these are closing numbers, closing Nifty. Next, EMA for the previous day, which means EMA for the previous day. December last, EMA was this much. The question mentions, correct? This is the previous EMA. Whenever you are starting the current period EMA, previous EMA will be the starting point. What is that? 17,174. This is column number 3. Are you column number 1, 2, 3? Yes, column number 3. Are you all comfortable? Here it is given as 1, 2, 3, 4, 5. Okay, it starts from the day they have not counted anyway. So second column like this, you need to understand this second column. Forget about the date. Okay, now see. Now Nifty given, you have found out the previous day EMA. First Nifty given closing value EMA you have. Now find out the difference. Find out the difference simply. Nifty 1 minus 2, Nifty, closing Nifty, current Nifty minus the previous day EMA, previous trading days EMA. You will get the differential value, differential amount 452. Are you all comfortable? So third column is nothing but 1 minus 2. Next, fourth column there, you have computed exponent, value of exponent in the previous working note. Yes, you have computed the first part, value of exponent as 0.125. This differential amount into value of the exponent, that will be your fourth column. Are you all understanding? So 452, the difference between the Nifty and the closing price and previous day EMI multiplied by the exponent value of what? 0.125, you get the value as 56.5. Are you all understanding? Is the new value to be added to the previous exponent value. So previous day EMI was 17,174. This is 56.5. This you add to the previous day EMI. How much is the total? 17,174 plus 56.5, 17,230.5. Are you all comfortable? This you got it as new EMI, current day EMI. This means 3rd January EMI. Are you all EMA? Now, this EMA, what you should do? Again, you should next day, again closing price. Previous day EMI, this is the previous day EMI you will consider 17,230. Again, repeat the process. Difference between the closing price, current price, and the previous day EMI, you will get 574.5 into value of the exponent. That will be constant. That will not change for a given level of either. The value of exponent will not change. If you are finding 15-day EMI, always it will be exponent value will be 0.125. 50 days now 1 divided by 51, 2 divided by 51. Like this, you will find that will be constant throughout these days for computing. Okay, so 71.81. This 71.81 plus 17,230. Okay, you will get 17,302.31. Again, you will put it. Okay, you will put it here. You will find the differential amount 622.69 into the EMA value, the exponent value, and you will get the closing EMA. Like this, you need to find out. Now, this is EMA computation. You have computed. Come to the part C. What signal does it give now? Now, what do you do? You compare the Nifty with the EMA. You compare the Nifty. The first column Nifty is there. For 8 days, you see what is happening. 17,626, 17,805, 17,905, 17,756, 17,800, 18, 18, 18, 12. If you see, okay, the Nifty has been steadily increasing. The Nifty has been steadily decreasing, like increasing. Are you all understanding? As and when the, okay, the days pass by, the Nifty keeps on increasing. What happens to EMA? Carefully, EMA, see, carefully observe the EMA. 17,230, 302, 380, 425, 474, 540, 604, and 680. EMA is also increasing, which means the share price is like this, it is increasing. Okay, the EMA is also increasing. EMA is also increasing. But what happens now? EMA, if you see, it is also increasing. If Nifty reaches 18 to plus 17,680, are you all understanding? Okay, now see here also, since this is also an increasing trend, okay, the EMA also follows the share price. EMA is also following the share price. It's also showing the bullish trend. Very simple terms. I'll tell you what happens. The EMA, what is the closing EMA? 17,680. Now, the real Sensex is more than this EMA. Now, if you see the chart, okay, the real Sensex will be above this EMA line. If the Sensex is above the EMA line, it is said to be bullish signal. Are you understanding? A bullish signal is generated when the actual price of Nifty rises through the moving average. It's the moving average. Okay, Nifty is also moving up. Okay, while the sell signal is generated when actual Nifty levels declines through the moving averages. In the present case, the price is 15 days. Therefore, bullish buy signal is generated. Recommended to buy the security. Okay, this is all about this security analysis question, EMA based. Very, very important. Okay, so with this, we are through the marathon. All the 3 parts have been completed. Apart from, okay, the mergers and acquisition is predominantly question, numerical questions you can easily solve, I believe. High question, and any type of question can be asked with that. There is no set pattern. Okay, they can, and also the question basic equity valuation. If you are thorough with equity valuation and business valuation, I think mergers and acquisitions is a cakewalk. The pre-merger EPS, PE ratio, free float market capitalization. There is nothing to be discussed. Okay, it can be self-study, not an issue. Anyway, apart from that chapter, all the other questions, important questions, solution have been discussed. Okay, and you need not see through all the complete, all the questions and answers video. You can skip the portion. Only the question answers for, okay, which is required for your, which means you require some explanation. Now go through the video. Otherwise, you just skip the video and you can directly solve the video. So all the best from my side. I've done from see, I've done around say 16 to 18 hours of this revision. All the very best for your examination. And in the comment section, please put me what are all the observations you came across through the marathon. Thank you. The session.